Good morning and welcome to the Fall Brookings panel. This is our third conference of 2020 and following our special conference in June, it's the second focusing on the effects of COVID-19 and the economy. This is a global webinar, so all of the presentations and comments are on the record. In each of the sessions, the authors will present for 15 minutes, followed by a discussant with 12 minutes to present, and then we'll have an open discussion. And I'll repeat these instructions when we get to the open discussion, but to be prepared, if you're in the Zoom session, you'll be able to raise your hand so that we can call on you. And if you're in the webinar, you can use the Q&A and the chat function in order to ask a question that can come through the moderators. Let's begin with our first paper, which is Business Credit Programs in the Pandemic Era. And the presentation will be given by Adi Sudaram.
Great, thanks very much for putting us on the program. It is great to be with you all virtually. So this is joint work with Sam Hansen, Jeremy Stein, and Eric Zwick. And the motivation for the paper is the unprecedented amount of government support for non-financial businesses across the world that we've seen in the last few months in response to the COVID-19 pandemic. This kind of support for non-financial businesses is pretty unusual. In the typical recession, we would expand social insurance programs for households. We may support the financial sector to maintain the flow of credit, but we don't typically actually directly support non-financial businesses. So what we're going to try to do in this paper is provide a conceptual framework for thinking about why we may want to intervene and directly support businesses in this recession, what's different about this recession, and then try to shed some light on kind of the right way to design business credit programs. For concreteness, we're going to focus on two U.S. programs, the Main Street Lending Program, which lends directly to firms, and the corporate credit facilities, which buy corporate bonds. These are both joint ventures between the Federal Reserve and the Treasury Department. And I should just say that at the outset that as the fiscal authority, Treasury is really in the driver's seat here with regard to the design of these programs. So the kind of main overarching point of the paper is that in the global financial crisis, we used multiple equilibrium kind of lender of last resort logic as the central kind of conceptual framework, and we don't think that's the right way to think about the COVID crisis. So in a financial crisis, self-fulfilling prophecies are very important. I run on my bank because I think other depositors will run on the bank too. And that logic means that government announcements of support can be incredibly powerful. If the government announcement that it will backstop a bank is credible, my incentive to run disappears, as does all of the other depositors' incentive. And we can shift to the good no-run equilibrium without the government actually doing anything much beyond the announcement. And so that's how people tend to think about the financial crisis, in part because in the US, our investments in banks actually made money. People interpret that as saying that there really was no fundamental problem, it was just a run. We think the COVID recession is likely to be quite different. We're facing a large loss of economic output, some of which is likely to be permanent. And these economic losses are likely to be mostly determined by the path of the pandemic, not by kind of feedback between the financial markets and economic fundamentals. And so there's just less scope for a kind of multiple equilibrium logic. That doesn't mean that there's no reason for government intervention today. We're going to highlight two distinguishing features of the COVID recession that we think motivate support for firms, but crucially, unlike the multiple equilibrium logic that we used in the last crisis, we think that rationales for intervention in this crisis really suggest that it's important that the government be willing to take credit risk, that it's willing to take some risk of losing money on the investments it makes in firms. And then we'll close by arguing that markets today, which are quite buoyant, seem to be overestimating the government's appetite for this type of credit risk taking. Okay. So we're going to make these points in two models. The first model is about highlights rationales for intervention and has 3 periods. So in the first period, we get some initial bad news, say that a pandemic is spreading and we'll have to do social distancing, which is going to adversely affect firm cash flows. There's aggregate uncertainty in this first period, which is resolved in the second period, and it can resolve favorably or unfavorably. Think of favorably as meaning, we get good news that a vaccine is possible in the short term. Unfavorably is that it's not, that we're going to have to wait a long time for a vaccine. Okay, and then there's a new steady state is the last period. So that's the timing. We're going to have a continuum of firms that differ in their exposure to the shock, and each firm has the option to exit at each of these time periods. To motivate government intervention, we're going to think about 2 separate frictions. One is a credit market friction at time 1 that will limit the amount that firms can borrow at time 1. The second is that there may be aggregate demand externalities at time 2. Specifically, what we're going to assume is that each individual firm's cash flow at time 2 is increasing in the total number of firms that are operating at time 2. And you can think of that as a reduced form for demand spillovers at the zero lower bound, or labor market congestion, things like that. Okay. So with this setup in the private market equilibrium, we should first note that even in the private market equilibrium, some firms that have negative cash flows at time 1 are going to continue to choose to continue to operate. And that's just because there's private option value to delaying the exit decision to see whether the aggregate uncertainty resolves favorably or not. So some firms that are taking losses in the first period are going to survive in the private market equilibrium. With these other frictions, the planner is going to want to keep even more firms alive than the private market. Why is that? So let's think about credit market frictions. There are going to be some firms at time 1 that have negative cash flows, but are expected in the long run to have positive cash flows. And in a frictionless world, they would borrow against that expected value of positive future cash flows in order to remain operating at time 1. With credit market frictions, they just can't borrow enough. And so this highlights, we think, one difference between 2020 and prior recessions is we think there's just many more such firms today. So, in a typical recession, the fact that a firm has zero revenue is a pretty good signal that the firm is not going to be viable in the long run. But in the current pandemic, that's less the case. The fact that our daycare has zero revenue today doesn't really tell us much about its long-run viability. The second reason the planner keeps more firms alive at time 1 is that there's quote-unquote social option value to doing so over and above the private option value of delaying exit. And the reason is that if the uncertainty resolves favorably at time 2, more firms are going to survive and there will be larger positive spillovers. So if the planner chooses to keep more firms alive at time 1, it's essentially preserving for itself an option to have very large spillovers at time 2. And so that's what we think is a second distinguishing feature of the current recession, is that there's just much, much more aggregate uncertainty today than there is in a typical recession. Okay. And so in addition to generating these rationales, the model also gives us some kind of specific prescriptions for program design, and I'm going to compare those for concreteness to the actual design of the Main Street program. So a first implication of the model is that aid needs to be widely available in the sense that the government should be lending to firms that the private market will not lend to. In contrast, the Main Street program actually involves the government co-investing with private banks. Banks make the loans and then they retain a part of those loans, which means that ultimately the only loans that get made are those that are profitable or attractive to private lenders. Second, the model suggests that the government should be willing to lose money on investments in some firms. The planner in our model faces the same kind of frictions the private market does. It's just maximizing a different objective function. And so it's willing to lose money in order to kind of generate higher social welfare. In contrast, the Main Street program is quite restricted. It's only going to lend to relatively low risk firms, and therefore it's kind of not targeted towards the right marginal firms. And a third implication from the model is that it's quite important to stage financing. We need to be able to change course as uncertainty about the pandemic resolves. That means lending a little bit today and then lending more if we get good news and less if we get bad news about the path of the pandemic. In contrast, in the Main Street program, firms can take out relatively big loans now, and that's kind of it. So there's not really much capacity to respond as conditions evolve. And just putting these last 2 points together, we think it's quite important that the right way to control risk in these programs is staging, not careful underwriting. We should retain the ability to cut back on support if we get bad public health news. We shouldn't really be trying to make fine-grained distinctions about which firms are viable and which firms aren't at this point. Finally, the model suggests that loan terms should be soft in the sense of giving borrowers flexibility in when they pay back the money as opposed to hard. But in fact, the Main Street program's lending terms are relatively hard. The loans are senior, they're relatively short maturity, there's not much flexibility. I will note that in some respects, the Paycheck Protection Program, which we'll hear about more later today, is closer to model design in some respects, and maybe we could talk about that in the Q&A. Now, despite this divergence between kind of what our model says is the right way to design these programs and their actual design, the programs have had a huge effect on financial markets. So this graph shows the evolution of credit spreads on risky high yield corporate bonds this year. Spreads rose dramatically in March as the pandemic really got going and have been coming down ever since. And as you can see from the graph, there's some suggestive evidence that the recovery in spreads has been driven in part by government announcements of support. So you can see that announcements for the corporate credit facilities and Main Street in March and April coincided with significant declines in spreads, as did a May 29th speech by Fed Chairman Jay Powell, where he said, you know, we've crossed a lot of red lines, but we're committing to do whatever we can for as long as it takes. Now, if you look at the longer history of credit spreads, so now I'm going back to 1996, you might be worried that markets have overreacted to these announcements. So credit spreads, as you can see, normally rise in recessions, which is quite natural because corporate defaults rise in recessions. But you can see here that spreads are actually at their average level over the last 25 years, not at elevated recession levels. So our second model in the paper is about thinking about the possibility that markets have reacted so strongly, in part because they're overestimating how willing the government is to support the bond market. So again, a simple 3-period model, and we're going to think about a risky corporate bond. In the last period, the third period, that bond's risky cash flow is going to be realized. At time 2, there's fundamental news. So there's news about that ultimate risky cash flow. There's also non-fundamental news, which you can think of as capturing things like noise trader risk or leverage-induced fire sales. Now, that means that at time 1, the bond's price will be the expected cash flow at time 3 minus a risk premium that compensates investors for these different risks. The risk premium both includes a risk premium for fundamental risk as well as a risk premium for non-fundamental risk. Okay, so what happens if the government now comes along and introduces what we call a purchase reaction function? So depending on exactly the realizations of the shocks at time 2, the government is going to buy more or less bonds.
Adi, you have about 2 minutes left.
Perfect. Now at time 1, if investors understand the government purchase reaction function, they'll charge a lower risk premium because they understand that the government's going to be offsetting some negative shocks. Right? What we think might be going on, though, is that investors are misperceiving the purchase reaction function. So they think that the government is going to purchase more aggressively than it actually is. That means that prices are even higher at time one than they would be if the investors correctly understood the government's reaction function. And now there's kind of the risk of a big price crash, because if we get negative fundamental news at time two, prices will fall both directly because of that news, and indirectly because investors will realize that the government is less aggressive than they were hoping for. So is this really what's going on? It's hard to say so definitively. In the paper, we provide two bits of evidence. The first is that the corporate credit facilities are largely, though not entirely, prevented from buying the riskiest, lowest rated bonds. But as I showed you in the previous graph, spreads on those bonds have come in significantly. We also think the second kind of piece of evidence is that it's unlikely that the government will offset true fundamental cash flow risk. So it's unlikely that the government is going to buy defaulted bonds to prevent investors from having to absorb those losses. And yet, prices have risen so much for bonds that are quite likely to default. And so we have a conservative estimate in the paper that suggests that the risk premium on bonds, just comparing current prices to historical default rates, the risk premiums on low-rated bonds are actually negative. Investors should expect to take losses because they're not charging enough for the defaults that are potentially coming down the pipeline. There is an alternative hypothesis, which is effectively multiple equilibrium for non-financials. Essentially, the market rally has now allowed firms to raise enough cash by issuing stocks and bonds that they can survive, so there won't be any defaults. This is certainly a possibility. I think what we think is that feedback loop is probably not strong enough to take the large majority of defaults off the table. So just to conclude, government interventions in financial markets are often motivated by multiple equilibrium logic. The classic example of this is Mario Draghi's whatever it takes speech. We think that this ability to make an announcement and then follow it up with little action and yet shift the equilibrium is unlikely to apply in the current environment. There are real economic losses that need to be borne. There are nonetheless compelling rationales for government intervention. We do think the government should be intervening. It's just that the government needs to be willing to take credit risk for these interventions to be fully effective. So thanks very much.
Thanks, Adi. The discussant is Nellie Lang.
Give me access. Okay, thank you. I'm trying to get a full screen here. Okay, so thank you very much for asking me to discuss this paper. It's a terrific paper. It's very constructive, provides many useful insights. I think, the overarching message that Adi mentioned is the 2000 pandemic crisis is not a financial crisis, and government needs to embrace a greater risk of credit loss. So the paper, as Adi went through, offers two different models for government support and uses them to draw some, to highlight the Main Street facility and the corporate credit facility. So my discussion today, I'm going to, while these programs are joint ventures between the Fed and the Treasury, the Fed has limitations. And in particular, the Fed has limitations about credit risk. What can a lender of last resort do when there is credit risk? And just 2 points to just sort of give the picture of why they have issues. Generally, first, borrowers must be solvent. And two, the security for emergency loans needs to be sufficient to protect taxpayers from losses. So you can kind of see up front when there's the prospect of high credit losses in government business credit programs, how the Fed engages will affect some of the decisions. In the end, I agree with the paper. I'm going to argue that the Fed actions have bought time and reduced the potential for a doom loop, but they really can't be a substitute for fiscal responses. Through that lens, Main Street is an odd fit. I think I may find it a little odder than this paper does. And then the corporate credit program is manageable, but the Fed really should clarify its objectives, its reaction function. So let me start with Main Street. Adi presented the paper very clearly, so I don't need to go through this, but there are two frictions that lead to differences between the private market and the planner's outcomes. So the predictions for the government is it should invest in riskier firms. It should expect to lose money on some investments. And one of the nice innovations of the model is it predicts staged financing, which I think is a new element to it. And that is basically to support firms initially to get to the next stage, which is especially important when aggregate macro uncertainty is high. And that is an element that is not currently in the Main Street program. And what we know about the Main Street program now is it was very hard to set up. They announced it in March. It didn't come out till a couple months later, and it's been revised multiple times. And there's been very little take up so far. Maybe $1.5 billion of loans have been made. Now, the Fed, because of its constraints, needs banks to help make these loans when you have private market information and you want to ensure that the firms getting the loans are solvent. And then it wants the banks to keep a share of the loan, in this case, in this particular program, 5%. So that's going to, the other constraint is that you want to design the program so that the borrowers will borrow, but many borrowers may not want more debt. So there are some hard constraints on designing this program. It's not a trivial thing to do. The staged finance is nice because it can encourage borrowers. If borrowers are really uncertain about what the path of the pandemic is and the macro economy, they don't want to take on a lot more debt. Staged financing gives them some choices. They can take a little. If things go badly, they might be able to take more. It also helps the lenders, but it may not help the lenders sufficiently. Because of the share, the lenders may not be willing to make any riskier loans than they might otherwise. They're just going to make the same loans since they have to keep some on the books. And to illustrate this, I'm just going to highlight two things. Banks, this is the net lending standards for commercial banks from the Senior Loan Officer Opinion Survey. And that blue line at the end there, that blue sharp rise is the July observation. So banks definitely are tightening standards. They don't want to make loans that are exposed to the same risks they already have. It's about as high as it was in 2000 in the global financial crisis. But at that point, banks couldn't make the loans. I think right now the banks don't want to make the loans. I agree with the model that under softer standards, more equity-like features to the loans that they propose could help and be within the financial constraints. And I think staged financing could help as well. But I think it may actually need more fees to the banks to encourage them to make some loans, basically to offset the risk of the share they have to hold. Probably better, a more fundamental change, in my view, than the marginal changes would be for Congress to recognize this is really a fiscal program. Perhaps one could do loans with conditional forgiveness if macro conditions deteriorate. This has some features common with stage financing, but I still think there's also some political risk for banks. And if the Fed is involved and needs to have banks retain a share, there will be some issues with getting this program effective. I want to turn to the next program, I think, which is probably less well understood. At least I agree with the authors that it's definitely may not be understood by market participants. So in contrast to the Main Street program, the corporate bond purchase programs have dramatically eased financial conditions, even before, and this all, much of it occurred before they actually bought any bonds. The model in the paper suggests, though, that this is still not a credit risk-free program, especially if investors misperceive the Fed's reaction function. And if you, the language around the introduction of the secondary market credits facility is that it is to support credit to employers by providing liquidity to the market. And so it suggests its aim is to fix dysfunction in the markets, but that will also boost asset prices. So I think there is clearly room for ambiguity about what the Fed's reaction function is. Just to highlight again what the alternatives are, under a traditional lender of last resort reaction function, the Fed would offset technical factors that push prices away from fundamentals, but it wouldn't interfere with the adjustment of prices to new fundamentals. The paper argues this still could require the Fed to take on some credit risk in bad states of the world at T = 2. Alternatively, the Fed could be viewed as pegging the risky bond price at T = 2. And in that case, the Fed would definitely need to purchase risky bonds very aggressively in response to negative news at T = 2. So the paper offers some evidence that investors believe the Fed is focused on prices, basically the kind of the pegging, sort of more of a monetary policy function than the traditional lender of last resort. And they show that spreads are compressed relative to the past 25 years, and that they're well below recession levels. And I agree with that, but I want to offer some evidence to support a traditional lender of last resort motive, suggesting that these transition costs down the road could be, in fact, quite big. So the left panel is just the corporate bond spreads. You can see March 23rd event and bond prices fell. What the right panel is just the ratio of the investment grade to the high yield corporate. And it just says that the investment grade spreads rose a whole lot more than the high yield spreads during this episode, suggesting there were some real technical factors going on in the investment grade market. This is a different illustration, and it's from a paper by Haddad, Marrera, and Muir, which shows for investment grade, it shows a scatter plot of the CDS spread for a particular bond against the bond spread for that bond. And the blue dots are the investment grade bonds. And it shows for a given CDS price change, a CDS change, the bond spread went way up. So they're way above the 45-degree line. The orange marks are high yield bonds, which tend to follow the 45-degree line more. So this is suggesting that the spreads for investment grade bonds are reflecting much more than fundamentals. And there's some additional evidence that suggests bid-ask spreads on investment grade bonds went way up, even above those for transacting in a high yield bond. So again, the investment grade bond market showed some serious signs of illiquidity. And just one more chart.
You have about a minute left, Nellie.
Okay, great. Perfect. One more chart, which is that the outflows to investment grade bond mutual funds were unusually large. That the outflows from high yield bond funds were large, but that hasn't been unusual. The investment grade was very. So the implication of this, so I think there is strong evidence there were technical problems in the investment grade corporate bond market, which supports the need for the secondary credit facility. I think, though, markets may be misperceiving the reaction function, as the paper says. The implication of that is prices may be too high. and they will fall more if fundamentals deteriorate. First, because fundamentals deteriorate, and then second, investors have to adjust their perceptions of this reaction function. And so, but I do think there's clearly a role the Fed could clarify their objective function to reduce expected losses if fundamentals deteriorate. And so just to summarize, the Main Street staged financing could help a lot, but I do think that there would need to be higher fees for banks to participate. Again, because the Fed requires banks to participate in the program, there needs to be something. But if pushed, I would say it actually needs a much more fundamental change. And the corporate credit, the paper highlights the potential cost, which is just a very useful lens to look at this problem through. But I do think the Fed could reduce this misperception to help ensure that this program continues to be a successful one. Okay, thank you again. Thank you again for inviting me to comment on this paper.
Okay, thank you, Nellie. That was really helpful, and it really sets the stage for the discussion now from the audience. So attendees here, you can put your hands up to ask questions of the authors or of Nellie. We have a few questions in the chat, so let me start with those. There's a few questions that are in the direction of designing the Main Street program, which is a theme of the paper. And let me group two of them together here. One is thinking about the long run impact of the Main Street program, and in particular debt overhang, which was emphasis of a paper that we saw in June. And so how do you think about the design of the program if you think about the long run costs? And in particular, there's a second question that says, if you're encouraging taking on credit risk, are loans really the right instrument, or would you think about grants or some other program designed to try to address those issues? So let me turn it back to the authors after we take a few more questions. It gives you a little time to think about them too, and maybe group together some of the answers. So from among the attendees, when I call on you, you won't have video, but you should have audio. So let me start with Gabe Chodorow-Reich, and then we'll go to Steve Davis.
Thanks a lot, and I enjoyed the presentation and the discussion a lot. It seems very useful. I wanted to suggest or sort of ask about a role for regulatory forbearance in this, and in particular, what I have in mind is that most mid-sized and large firms have credit lines, and these credit lines mostly have maturities well into 2022 or beyond, and firms have not exhausted them. And so this seems like potentially a useful way to complement new liquidity programs. But many firms are going to be violating covenants because sales are just way down. And so it seems rather important how banks are going to react to those, and that there maybe is a role for regulators in encouraging the treatment of existing pre-committed liquidity as a complement to new programs.
Okay, Steve Davis. Steve, you are unmuted. You should be able to go ahead. Okay, Steve, we can't hear you. I'm going to go ahead and go to Wendy Edelberg, who has her hand up, and we'll try you back in case your audio improves. Wendy, go ahead.
And I'll offer to Steve that just before, when Jan was saying that, I got a pop-up saying that I had to click unmute. So I wonder if Steve didn't see the pop-up to click unmute.
No, sorry. Can you hear me now?
Yeah, go ahead, Steve. All yours.
Sorry. So I've got a question about the political economy of staged financing for firms that the paper sets forth. So it seems to me the political logic for support often runs as follows. Some company or sector and their employees were hurt through no fault of their own, and therefore they need and deserve government support. This is a political argument, not an economic one. But that logic argues for more support to adversely hit sectors and firms if and when the pandemic worsens. And so it strikes me that as just a matter of political economy, it's unlikely that the government will pull back its financing support in the way the paper's policy recommendation envisions. And I would just like to get the authors thinking about that and whether we should think about those political economy concerns in the design of policy.
Okay, now let's go to Wendy. Thanks, Wendy.
So the CARES Act put up substantial money to fund the Main Street lending program, and appreciating that, of course, the Fed's requirements is, or at least the way I understand the Fed's requirements is that the Fed can't lose money for taxpayers in expectation. The way I understood that this was working out in real time is that the Fed interpreted things that they should use that pot of money to leverage up the Main Street lending program so that still it would not lose money for the taxpayer in expectation. I'm wondering why they didn't instead say we're going to leverage it up less and use that pot of money to absorb losses in expectation. Would they have been allowed to make that choice?
Okay, thanks, Wendy. Next, we have 3 questions, which will probably use up most of our remaining time. Shebnam Kalimliaskan, Michael Kellett, which might be Mike Kiley, and Don Cohn.
Yes, can you hear me?
Yes, go ahead.
Okay, so just very quickly, I would like to draw a distinction between large firms and SMEs. So especially, smaller SMEs who are not in the corporate bond market. And if we are about losing money, do you think subsidizing these firms directly through grants, not through loans, would be the way to go? And since you did talk about clawing back some of it, just doing it through the tax system, would you think that would be appropriate? Thank you.
Thanks. Now, Mike Kiley.
Hey, Jan, thanks. Yeah, it is me. A very interesting paper, and I really enjoyed it. It focuses very much on the macroeconomic aspects of emergency government credit support, and in particular, the importance of assuming greater credit risk. I wonder if the authors have views on certain microeconomic aspects and whether or not those are particularly critical in program design and may affect sort of overall efficacy and take up. I think I would ask about at least 3. So first, the primary market corporate credit facilities and the Main Street lending program have a set of restrictions on capital distributions, compensation, and other activities of borrowers. Such restrictions, obviously make a great deal of sense from the taxpayer's perspective and in the public interest. However, is there a risk that the incentives of firm insiders may fail to take into account of, for example, the role of aggregate demand externalities in a way that significantly lowers the efficacy of these kinds of programs, and what sort of features might be incorporated to alleviate those challenges? Second, any government credit program involves a long-run relationship between the non-financial borrowers and the government as a lender. The Main Street program overcomes this challenge by relying on private lenders, but private lenders may view a partnership with the government, as substantially risky, at least from a political sense, or supervisory sense. And I wonder, whether or not this is a major challenge, in program design and how that might be addressed. And third, or perhaps relatedly, the paper very much focuses on originating loans and the need to be willing to originate riskier loans. But borrowers and lenders may be especially concerned about the sort of back end. What happens when a borrower is under distress? What is that relationship going to look like? And is the government going to be acting in a economically efficient manner according to certain social interests or political interests? Might such issues, both the political but also the administrative complexity, point to issues with program design, and for example, a greater role for grants relative to loans or even equity participations.
And we'll take the last question from Don Cohn and then back to the authors. Don?
Thank you, Jan. Great paper, interesting discussion. I think this responds partly to Wendy. It's the Treasury that really needs to clarify what its appetite for risk is. And the Fed, I agree with Nellie, the Fed could be clearer about its objectives here, but I think in the end, it's the Treasury that needs to say that it's willing to put money at risk. A second point, it's not clear to me that the compression of spreads is a consequence of misperception. It could well be, I don't deny that, but it also might be a consequence of optimism about vaccines and that the better outcome is not that far away. I don't know how one differentiates that. If the authors have any idea, that would be interesting. And the third point is, how do you figure out who to lend to? So some firms won't, even in a good outcome, some firms won't be viable because the economy will have shifted. Some sectors will never get back to where they were before. So it's hard to figure out who's going to be viable, even in the good outcome state of the world. Now, the Fed and other, I know the Bank of England has done this too, have gone in part by saying if you were investment grade going into the pandemic, even if you're a fallen angel, we'll lend to you. So they're using the investment grade going into, and I think partly this partnering with the banks is trying to get the private sector to help figure this out. But it's not the case that that there are a lot of firms who won't be viable even in a good outcome. And I'm not sure, I'd be interested in your thoughts about how to deal with that issue. Thank you.
Great, thanks. We'll turn back to the authors now. You have at most 5 minutes to respond. Sorry, it was a very good discussion, but we know you can be focused in your replies.
And maybe I'll just take a second. First, thanks to Nellie, and thanks for a terrific discussion, and thanks for the questions. Let me just take one piece of this, which is, I think there's quite a bit of ambiguity about exactly where the constraints lie and exactly what the Fed's authorities are. I think we all agree that at a minimum, the Fed has to be secure to their satisfaction so that they think that they're not really going to lose money. Now, that can be done, as I think as Wendy observed, just by having a big enough equity contribution to the special purpose vehicle from Treasury. So given the size of the CARES allotment, basically, that shouldn't be a constraint if Treasury is willing to put up enough. A second thing, I think there's a little ambiguity, but maybe we should stipulate, is whether the securities have to be debt. As somebody else pointed out, I think maybe it was also Wendy, I forget, but like debt causes a lot of problems with debt overhang, with then worrying about workouts, who's going to do the workout, all that kind of stuff. It would be easier if these weren't debt securities. We basically have argued for something that looks more like preferred. Preferred is sort of nice because it doesn't have the kind of hardness of debt, and it's not equity, so the government's not in kind of controlling, owning a voting stake in firms. I'm not sure. There's a little bit of legal ambiguity about whether the special purpose vehicle can own preferred, but you can surely do your best to approximate that within the letter of the law by making it extremely junior debt with deferrable interest payments, and essentially doing everything you can to soften it and to approximate that. And of course, they haven't done that. I think, as Don pointed out, this is the Treasury's insistence. They've hardened the debt, senior position, collateral, all that is going to make the workout tougher because the banks are going to be well secured and be inclined to kind of pull the plug. So there's that point. The one thing where I'm not sure I agree with Nellie, or at least I'm not sure, is that there's any constraint on the Fed that, given that these are debt securities, that they have to have also been underwritten by the banks. And it's quite clear in what's happened so far that the banks have been a bottleneck. So I think, we might argue that you'd be better off not having the banks as underwriters. And even if Nellie, we require that in some way, putting them pari passu, putting them equal with one another is really just totally inimical to the idea of the program, because we want to be able to do things. The whole point is to do things that the private sector won't do. So one little trick you could do here, and this might be helpful for alignment, is, you know, if there's whatever 3% interest coming in, lop off the top 1% and say the banks get it if the firm survives for 5 years, something like that. So banks have some incentive to underwrite, but they have better economics in a sense than the Fed. So you want to at least kind of deal with the fact that we want to do more than just make loans that are available in the private market. I think there's scope for doing it. Obviously, agree with you that congressional action would be helpful, but I think a little bit more optimistic than maybe you are about the scope for doing, you know, sort of clever stuff. If the Treasury Department has to be willing, I think of them as kind of the key binding consideration.
Agree.
Right. Thanks very much. Terrific discussion, paper presentation, on the Q&A from the audience. So we're going to flip over to the next paper now, which is epidemiological and economic effects of the lockdown. The presentation will be given by Alex Arnon. We'll just take a minute to switch over the panel and give Alex a minute to share his slides.
Right. So as I just all right. Are the slides up? Pretty soon.
Yep, good to go.
They are. You're all set.
Okay, so thank you so much for having us here. And in this paper, basically, we are taking a look at the first 3 months of the pandemic, so March through May of this year. And you may recall it was a pretty crazy time. And so to start us off here, in these plots, each thin blue line is a US county and the thick black line is the national average. On the left, we have the contact rate, which is how likely is a person to be in close physical proximity to another person other than the people that they live with. So in the middle 2 weeks of March, the contact rate fell more than 80% nationwide, just a complete transformation of American society within 10 or 20 days. And contacts collapsed pretty much everywhere at roughly the same time, although we start to see some divergence thereafter in the rate of recovery. On the right, we show a measure of employment. This is the number of people working in a county on a given day. So employment fell at an unprecedented 20% in the space of just a few weeks. And although the declines were really historic pretty much everywhere, note that there's quite a bit of variation in the extent of the decline across the country. And I'll talk more about where these measures come from in a little bit. So state and local governments responded to the pandemic with a whole array of non-pharmaceutical interventions. In this paper, we're focusing on 3 major NPIs that were specifically aimed at combating the pandemic by reducing contact rates. So those are school closures, which were typically enacted earliest, stay-at-home or shelter-in-place orders, and then non-essential business closures, by which we mean a universal, all non-essential businesses must close order, so not just any business restriction. And by the beginning of April, basically the entire US population was covered by one or more of these NPIs. They were issued largely by state governments, but also often by county, municipal, or school districts. So our main goal in this paper is to sort of evaluate the relationship between the collapse shown on the first slide and the policy response that we showed on the second slide. And to preview our results, we're going to find that NPIs explain only about 7% of that dramatic decline in the contact rate we saw, as averaging over March, April, and May. And they explain a somewhat larger 15% of the fall in employment. If we translate that into a number of jobs, that's a reduction of about 3 million, a little bit less than 3 million in employment. Now, despite these relatively small effects on the contact rate, we estimate that without NPIs, COVID deaths at the end of May would have been higher by 33,000, or almost a third higher. And then drawing on these results, so with the benefit of hindsight, we argue that policymakers could have achieved the same or better health outcomes with much better economic outcomes if they had deployed these 3 NPIs differently. So to summarize how we're going to get there, we start from a pretty standard model of infectious disease, a SEIR or SEER model, and we're going to expand it in a few ways that are critical for both the simultaneous epidemiological economic analysis we want to do and for thinking about policy. In order to estimate and run this model, we're going to need high frequency measures of contact rates and employment at the county level. These do not exist in general. So we pull together information from a whole bunch of different sources and combine it all to construct the measures that we need. And then once we have these measures, we are going to estimate key model parameters like the response to NPIs in a diff and diff framework that conveniently falls right out of the model. So I'm not going to spend too much time on the model here. You can, there's some appendix slides or check out the paper. Just going to focus on the main component of the model that we are expanding. So in the SEER framework, disease transmission depends on the contact rate. So again, that's being physically close to other people, and on the infection rate, which is how likely an infectious person is to actually transmit the virus given a contact with a susceptible person. Normally in the SEER modeling, both of these factors are just taken as external. There are a couple of big problems with this though. So first, it assumes that behavior is independent of the severity of the epidemic, which does not seem consistent with what we've seen. And second, if you want to think about NPIs in the model, you just sort of need to jam them in from the outside. So what we're going to do is make the contact rate depend explicitly on both how bad is the epidemic where you live and what NPIs are in effect where you live. So to be a little more specific, we make contact rates and employment depend on 3 components of behavior. The first is a response to perceived infection risk where you live. So if the epidemic is better or worse and people become less or more worried about getting infected, they can adjust their contact behavior accordingly. The second component is a response to NPIs. And the third is a precautionary response, which we allow to vary based on the demographic and economic characteristics of a state or county. And this precautionary component really is nationwide common trends that are not related either to local epidemic or to the 3 NPIs. Given our empirical approach, the precautionary term is going to end up picking up some stuff that we might not think of as just people being cautious, like if people change their behavior because of CDC guidance, that'll get picked up as a precautionary. Okay, the first data issue that we face trying to actually use this model is we need historical estimates of the dynamics of COVID-19 and in particular of the transmission rate. The problem is we don't actually know how many people were infected at any given point in time. We only know how many people tested positive, so confirmed cases, and we know how many deaths were attributed to COVID. So our first step here is going to be to estimate the case confirmation rate, and that's the share of the actual true infections that show up as confirmed cases. We do this partly based on test data and partly based on deaths data combined with estimates of the fatality rate. And then, so once we have the true number of infections, we borrow some methods from empirical epidemiology, which along with a state level calibration procedure, we estimate the COVID reproduction number, and from that, the COVID transmission rate. Okay, for the contact rate and employment, I mentioned before that there are not direct measures for these things at the frequency and geographic detail that we require. So what we do is pull together from data from a whole bunch of different sources. And this includes some direct measures for the things that we care about, like the extent to which people are congregating in common places, or how many people were working for a particular set of businesses on a given day. But these direct measures are narrow in scope, they're not representative. And then we have a bunch of indirect measures, stuff like how much time are people spending at home, Google searches for the forms you need to fill out when you hire somebody. So we are going to collect all these proxies, and rather than try and sort through them and work with them each individually, we combine a set of proxies for the contact rate and a separate set of proxies for employment. We take the first principal component of each of those sets, and that gives us a time series of common variation across all of the different indicators that we use. This also has the nice feature that it allows the relevance of different indicators to vary geographically. Some measures, some of our employment proxies might be more useful for tracking employment in some counties and less useful in others. So for the contact rate, we don't actually have really any way to assess the resulting measure since there is no independent data. But for employment, we can compare our index with the monthly frequency official estimates from BLS. So on the left here, we aggregate up everything from the county level to total US employment. On the right, we show the monthly change at the county level in 2020. And so, we are reasonably satisfied that our measure does a good job of tracking the official estimates. Okay, so getting to our results, our first main finding is that most of the fall in both contact rates and employment was voluntary. So this is either the precautionary response or infection fear response, but NPIs played a pretty small role. So here, this illustrates that we disaggregate the total change in contact rate and employment relative to the beginning of March, and these are in log terms. And so we disaggregate these into the three components of behavior. And you can see that especially early on in the pandemic, the precautionary response completely dominates. NPIs had almost no effect really until the last week of March. And for both contacts and employment, the infection risk response explains about a fifth, but again, the precautionary response dominates. And so I had mentioned earlier that the precautionary response can vary based on population and economic characteristics. And so I'll just highlight here a couple of the most significant dimensions of that variation. So here we plot the precautionary change in the contact rate broken out by the Republican candidate's vote share in the 2016 presidential election. So these are quartiles of county level vote share here. And we see that the initial precautionary response was pretty much the same everywhere, the very sharp, rapid decline in the middle of March. But by the end of that month, we start to see some significant divergence along partisanship, and that only grows over time. By the end of May, the precautionary response was basically over in the most Republican-leaning counties, but it was still holding contact rates down by around 50% in the least Republican-leaning. And I'll note here that if you do the same thing by education, age, density, or other correlates of partisanship that might also be driving differential responses, you don't see nearly as large or consistent a pattern. So it does strongly suggest that politics are playing some independent role here. On the employment side, here we show the precautionary response of employment broken out by the share of county employment that is in leisure and food services. So at the lowest point in mid-April, there is a difference of around 5 percentage points between the most and least concentrated in these industries. So this is a huge factor in driving that variation in the employment response that we saw in the first chart. And if you noticed in that chart, some counties had declines of up to 40%, and those are really the tourism-dependent economies of Nevada and Hawaii that have huge shares of employment in these industries. Okay, so focusing in now on the effects of NPIs, we estimate that the NPIs reduced daily COVID-19 deaths by about 500 per day in April and May. And that's relative to actual deaths of between 1,000 and 2,500 over that period. At the same time, again, NPIs lowered employment by close to 3 million. So before we talk more about those numbers, I'm going to jump back really quick to the contact rate. And just note here that, again, on the left, you see a reminder of this, the contact rate explains really only just a sliver of the decline relative to March. And on the right here, we disaggregate that sliver into the impact of the 3 NPIs. So a couple of things to note here. The first is that the earliest NPI-induced declines were driven by school closures, which typically came about a week before the other two, and then overall about half of the total decline over this period is attributable to stay-at-home orders.
Alex, you have about a minute left.
All right, thank you. Okay, so if we take that, run it through our model, and translate it into an effect on deaths, we see a couple of big differences. First off, the effect is much larger, and school closures play a much larger role in here. And what's going on here, the difference is really highlights the critical role of timing in epidemiological dynamics. So the early declines in the contact rates are accounting for most of the effect that we see, and because school closures came early, they are accounting for a larger share of deaths than of the contact rate. Turning to employment, again, about 3 million jobs. And here we see, again, a very different distribution. About half of the decline in employment is attributable to non-essential business closures. This is much larger than their share of the contact rate. So drawing on the implications of that discussion, we're going to consider some alternative approaches that might have led to better outcomes. And the key takeaway from our discussion earlier is that early action is critical. So cutting contacts early in the pandemic has enormous payoffs. And then the second takeaway is that, maybe not surprisingly, business closures have high employment costs relative to the other ones compared with their epidemiological benefits. And this just highlights that difference. But I will not stop there since I'm short on time. So I'm going to consider two types of counterfactuals very quickly. First, we ask what would have happened if on March 13th, the day that the president issued an emergency declaration, he had also issued a nationwide stay-at-home order and a nationwide school closure. We find that in that scenario, deaths would have been lower by more than 4,000 at the end of May, and employment would have been higher by about 1 million. So, better epidemiological outcomes and significantly better economic outcomes just by acting early and focusing on stay-at-home orders and school closures. And finally, we consider a more targeted response where counties impose these two policies depending on their local circumstances, basically an aggressive response to the number of cases per capita. And we find here, you get somewhat smaller epidemiological benefits, somewhat larger economic benefits, but sort of the small difference between the national and local response, what that highlights is that we often don't actually know what the true case count is because we are not detecting many of the cases. So, the takeaway from this is that it is better to act broadly and early, even if you're not sure, even if there might be some waste in that. Okay, and more in the appendix. Thank you.
Great, thanks, Alex. The discussant is Alessandra Fogli.
So first of all, let me say thank you so much to Jen and Jim for this great opportunity. It's been a real pleasure to read this paper. And it asks a very important question and is also presenting some very provocative results. So the question thereafter is, how effective are NPIs? And this is such an important question, especially now that we're facing, in Europe, the second wave of infection. So how effective are they in saving lives? What are their costs, for employment? And they're using an impressive data set, microdata, and an integrated approach to separately identify the effect of policies from the endogenous behavioral response of individuals to infection. So how does this integrated approach work? Well, first of all, they are looking at the effect of MPI directly on contacts, on the decline of contacts, measure using cell phones and different other measures. And then they model the effect of contacts on infections and then eventually on death. And first, they estimate the parameters, directly the parameters that affect the policy, affect contacts. And then they also introduce this feedback effect from infections to contacts and identify separately the endogenous response. So given these two estimates, the effect of MPIs on contacts and the effect of infection on contacts separately, they incorporate these into an AP model, and they can actually come up with estimates of the total effects of policies on death and the effect of the endogenous response on death. So they use a different approach to estimate the direct effect of MPIs and separately identify from the fear component. So the main results are that the local policies explain only a small fraction of the decline in contact rates. Most of the effect is actually captured by this precautionary motive. And however, because of these non-linearities, the MPIs can avoid about 30% of the death during the first 3 months. And business closures, as Alex was just saying, is the least effect of the MPIs. Large costs in terms of employment compared to the deaths that are saved. However, let's put these results, which are provocative, in perspective, in international perspective. I was looking at another couple of papers that were just recently published in Nature that are using a similar approach to identify across Europe the effects of MPIs on death and infection cases. So if we put this paper, the results of this paper in perspective, we see that looking at the ratio between averted cases to actual cases, they find about a 0.3 ratio of saved lives compared to actual death. In these other two papers, the Xiang paper published in Nature and the Flaxman paper also published in Nature recently, we find an order of magnitude different effects. MPI seem to matter much more. If we look at US, Xiang and co-authors find about 13, this ratio is about 13. In Italy, even 16. And in the Flaxman paper, it doesn't look to US, it looks to Europe overall. They find that MPIs have saved 3 million lives with a ratio of 23. So the question is important. I mean, how do MPI, how much do they matter? And why do we find such large differences? So this is a very important question. And what I'm gonna do in this discussion is to think about possible ways in which these estimates can differ. So one possible way, and I'm gonna say this up front, is that in these other papers, they do not implicitly include the individual behavioral response. So that is definitely something that this paper is doing that the other papers are not doing. But let me also, as I discuss, bring up other possible explanations that have not been incorporated and that can be useful to think about. So my discussion will be about the estimation of the fees. There are the parameters that govern the effect of NPIs on contacts. And in particular, I would be thinking about the role of heterogeneity in local responses to NPIs. And then the second part will be about the AP component and how contacts translate into infections. And some heterogeneity in the type of contacts can also play a role there that is not being considered here. So let me first think about how heterogeneity in local responses may matter in this estimation. So this is the equation they estimate where the contact rate depends on some time effects interacted with the county characteristics. And then there is the effects of policies, which in their paper is homogeneous across different localities. And then there is a fear effect, which is the endogenous individual response to the confirmed cases, to the infection level in their place. So what I've done here is to run a Monte Carlo simulation and think about the possibility that the fees in the model are really heterogeneous across different counties. And think about some variation, in coefficients, and instead assume that the precautionary motive, the omega T's, is constant over time. So no time varying precautionary motive in the real model, in the true model, but heterogeneous response across counties. So what happens? So in the true model, of course, the precautionary model, the motive, which is the blue component, has no effect because there is no time variation. And a lot of the effect is actually due to the NPIs. However, in the misspecified model, the NPIs have much smaller role, the fear has much smaller role, and a lot of this heterogeneity is captured by the time effects that is interacted with county characteristics. So if location I and J have same policies but different declines in contact rates, the model is trying to fit these differences using the precautionary motive that is interacted with the county characteristics. But this is going to imply an underestimation of the effect of policies that can be actually quantitatively important, depending how much heterogeneity there is underlying. So why can we expect heterogeneity in local responses? And one possibility could be differences across different states and counties in compliances, in enforcements, other policies that can be implemented in one county and not in the other can interact, but also differences in the initial structure of contacts. So this is something that I've been working on, thinking about how the structure of contacts can be different across different countries or different states. And think about the network structure of contacts, so put some structure on these contacts. And think, for example, about how in a small world war where you have some number of contacts and contacts can differ in terms of how close they are and how random they are, this can be important. So think about, for example, New York and Minnesota, and think about the different level of initial contacts. New York is much more connected. Maybe you start with a situation of 8 active contacts per node. Minnesota, well, you can see around my windows, it's not so connected. So we actually can think about having a much lower, initial number of contacts. So if both locations introduce a stay-at-home order where you only can see 2 people, maybe your close, your nuclear family, then the same policy implies different reduction in contacts right away, just because the initial number of contacts was different. So here I'm just plotting how the contacts are changing because of the same initial policy, is being introduced in 2 places that start with a different contact structure. And so there is a difference in the effect on contacts directly, which would be misspecified in a model where fees is homogeneous, and in particular will be underestimated, and can have important effects when mapped into the number of infections. So same policy can have very different impacts in different locations because they start with a different initial number of contacts and different contact structure. So
Alessandra, you have about 2 minutes.
Yeah. So the last part instead is about how the effect of the AP model in their model. So the other ways in which heterogeneity can matter is because these contacts are different and they actually transmit infection maybe far away in the network, and maybe they're more random and not repeated. So one thing is to see the same person over and over again, and one thing is to meet one person, but every time different, and maybe far away from your common, normal circle of friends. So this paper assumes that all contacts, the last part is like how contacts map into infection, have the same effect on infections. However, we know that there is a lot of heterogeneity in how much these contacts translate into infection, depending on the type of contact. Whether this is contacts with a small group of close nodes, it will have little impact. Random contacts with faraway nodes will have a very large impact. So, for example, this is important for policies because if you think about business closures, maybe closing some large events can be very important because you are cutting down some long links with a lot of random interaction. So here, for example, I'm mapping how the two policies are reducing only long contacts versus reducing all contacts can have, very different implications in terms of infections. Conclusion, it's a very important paper that challenges the common wisdom about NPIs. The consensus view is that these policies have a large impact. This paper finds a much more limited impact, quantitatively important difference. The contribution, which I think is great, is to allow for this behavioral response that is important. People get scared by the increase in infection and endogenously reduce their contacts. But on the other hand, I just want to suggest that this heterogeneity in local responses and this heterogeneity in the kind of contacts can also be important when thinking about policies. Thank you.
Great. Thanks, Alessandra. So thanks for a really clear presentation and a really constructive discussion. We can take questions in the Q&A, and if any of the attendees have questions, please put your hands up. And so we'll start with the first question from Olivier Blanchard.
This is a really nice paper, and I must say I'm surprised by the conclusion. And I hope you reconcile your findings with the alternative findings that Alessandra mentioned. But this is about the introduction of NPIs. We're now in the removal of NPIs stage, and all governments, national, local, and so on, are playing with various changes in the rules, thinking that they may have a big effect. And so the question is, should we just assume symmetry? And basically NPIs removal is not going to make much difference, only a decrease in the infection rate will, or is there an alternative? Is it asymmetric? And do we know anything yet? I mean, I realize you can't do the econometric work you've done on the exit rather than the entry, but if you have anything to say on that, I would be very happy to hear.
Next question from Ben Friedman.
Thank you. I enjoyed the paper as well, and I was curious about an aspect of identifying the difference between the effect of the NPIs and what you're describing as the behavioral precautionary actions that people would have taken on their own anyway. And I can't figure out whether in your procedure, take the example that I observe that in my community, the schools are closed. I observe that in my community, the non-essential businesses are ordered to remain closed. And because of those NPIs, I therefore on my own choose to act in a way in which I would not otherwise have acted. And I can't figure out whether from your I haven't read the paper, but I can't figure out from your presentation whether my endogenous response to the NPIs is washed into your estimate of the NPI effect, or whether my response, because I'm taking it on my own wicket, so to speak, is considered what you're just calling the precautionary response, in which case there would be an effect of the NPI, namely on my independent behavior, that you're putting in the precautionary category. So my question is, which way does it go? And whichever way it goes, I think it informs how we should respond to your estimate of the size of the NPI effects. Thank you.
Thanks, Ben. I'm going to take a question from Jim Stock.
Thanks. This is, as the authors know, I think this is a terrific paper. I think the question that about sorting out these endogenous things is really important. I think what my sense is what's driving this here is as if random seeding of initial conditions at the county level. And that seems like a fairly reasonable assumption at the level that we're going at, but fleshing that out would be great. It does seem like this cries out for some sort of instrumentation, and that's beyond the scope, but that would be a good thing for the next research. One comment is this not, are these, to what extent are is the NPI itself or the endogenous behavior causing the decline? I think that the papers we had at the last Brookings conference, the Gupta paper and the Rothstein paper, were pretty much on the side that the endogenous response, the people getting nervous, was a big piece of it. And those two Nature papers simply exclude it. I mean, they have actually fairly crude diffs and diffs, and there's no endogenous response. So they just capture that a bunch of stuff happens when you shut down the buildings. And that's very much, subject to what Ben Friedman's critique just now was. So I don't put nearly as much faith in those Nature papers as in some of these much more fine-grained studies that we've seen here.
We have a question from Mervyn King.
Myself. Fine, I think I'm now unmuted. My question is how far information about cross-country differences would help to disentangle the point that Ben Friedman raised, which is, if you take Sweden as the obvious example, where they didn't have as many NPIs, but they certainly seem to have had an endogenous degree of caution on the part of households. And of course, that also feeds through to the underlying economic cost. The second point is that I think Alessandra's point on heterogeneity is of enormous importance. We know that in terms of an epidemic, there are super spreaders, the so-called R value to which politicians attach so much weight varies across individuals, locations, and the idea of just having a single parameter here seems to be potentially very misleading.
All right, thank you. Let's turn it back to the authors and give them a chance to respond to Alessandra's points and the Q&A from the audience. So Ken, Alex, John?
And let me just note that the first paper of the next session looks at the international evidence.
Right.
Alex, why don't you go first?
Alex, there, go ahead.
So, to the question on symmetry of reopening, we have done a little bit of preliminary work here, and I think a big issue with this is the heterogeneity, the treatment heterogeneity seems to be much harder to, a much bigger deal here. It is a lot harder to match up a given reopening event across different jurisdictions. So I mean, I think on so I guess the short answer is I don't expect there to be, to the extent that we can estimate it, I don't expect it to be symmetrical. I think that there's just so many differences in both what the actual policy is and how it'll affect things. So to Ben Friedman's question on NPIs, so the effects you're talking about, you see that schools are closed, you change your behavior, we are going to pick that up as a response to NPI. So, an interesting thing about this that sort of speaks to the treatment heterogeneity issue as well is that there's not a ton of enforcement, as we can tell, anywhere in the US. You can almost, even though these policies, we are restricting to policies that were, the language said, this is a mandate, you are required to follow this by the law. We really think of them more as almost informational advisory. This is just a more aggressive form of information that governments were pushing out on people. So yes, I think that's I'll hand it off to someone else.
Kent or John, do you want to add any comments?
Yeah, I mean, just very big picture and only one quick comment is that obviously we allow for heterogeneity by location a lot. This is really about the marginal effects, and just want to make that clear. Yes, we're going to be exploring a bit more if we have the data and ability to think about kind of a heterogeneous treatment model in more detail. So I think that's a great comment. And we'll, our prior right now is that it's probably not a huge effect, but that could be wrong. And so we're going to be definitely trying to see if we can explore that in the final draft.
So, yeah, sorry, well, I had one more thing on the general question of the response. So, I think we've now seen a number of studies that are mostly looking at stay-at-home orders only for the US. And in those studies, they generally find estimates that are very close to what we're coming up with, about a 10% immediate impact on whatever measure of contacts you're looking at. It's generally within the same ballpark. So yeah, a number of papers at the previous Brookings, and then also some work by Austin Goolsby and Chad Syverson finding very similar effects, even using I think census block group level data. So, at least for the US, I'm much less familiar with the international evidence. I look forward to the next session. But at least for the US, I think the stay-at-home orders, we seem pretty in line with other estimates that I'm familiar with.
Terrific. Thanks very much. So I want to thank Alessandra for her comments and the authors for a terrific paper. We will take a very brief break. We'll be back at 11:35 Eastern Time for the next paper, which, as was mentioned, is on the international aspects of this same set of questions. So we'll see you in 9 minutes. Thanks very much.
And we're good to go, Jim.
Okay, welcome back to the Brookings Conference for the second session. Our first paper this morning in this session is by Jesus Fernandez Villaverde and Chad Jones, Macroeconomic Outcomes in COVID-19, a Progress Report. So I understand, Jesus, you're starting off?
I think I'm actually starting off, but you can hear me?
Okay. Yeah, good.
Great. So this paper is Macroeconomic Outcomes in COVID-19, a Progress Report. What we do in this paper is focus on data on two outcomes that we care enormously about during the pandemic, namely lost economic activity, so as measured, for example, by GDP or unemployment, and we'll also look at the Google mobility data, and then obviously deaths from COVID-19. So we're going to look at data on these two key outcomes across countries, key international cities, and also US states. And then also over time, we'll look at dynamics and see what lessons we can draw out. And I guess if I had to summarize it in one key lesson, I think one of the key things we learn is that there are a heterogeneous set of places, Seoul, Tokyo, Germany, and Norway, that have good performance on both of these dimensions. And we should look particularly closely at what those places have done to figure out how to get these good outcomes in future pandemics. Okay, so to start, let me show you the COVID death outcome that you're all familiar with, but I think it's helpful to put it in context. Throughout the paper, we're going to look at deaths per million people. And what you see when you look at the data is just an enormous, tremendous amount of heterogeneity. I didn't put Taiwan on this chart, but Taiwan has fewer than 1 death per million. New York City has 2,800 deaths per million. So, 2,800-fold difference. If we look at Seoul in New York City or Tokyo in New York City, these are both key global densely populated cities. And one of the messages from this heterogeneity is that density is not destiny, right? You can have densely populated cities with global contacts, and they can have very, very different outcomes in terms of COVID deaths. And then you can look at every place in between. Germany, 100 deaths per million, the Bay Area and San Francisco, 200 deaths per million. Mississippi, 800, Miami and Philadelphia, 1,000, Madrid and Stockholm, 1,400, and then again up to New York with 2,800. So a very simplistic view of these two outcomes that I've mentioned that we care about, the deaths from COVID and losses in economic activity, say associated with GDP. A very simplistic view is kind of shown in this chart, where you could think about shutting down the economy, and that will result in a large loss in GDP, but maybe with the benefit of saving a large number of lives. Alternatively, you can keep the economy open. That'll minimize the loss associated with GDP, at least in the short term, but perhaps result in a large number of COVID deaths. Now, we know this simplistic trade-off is just, highly imperfect. It doesn't really capture what's going on. And one of the reasons is that there are dynamics, right? So if we follow this keep the economy open path, we get a lot of deaths. We may then be forced to shut down the economy and end up with both large GDP losses and a large number of deaths. And so, in some sense, there's a shifting of this red curve back and forth, associated with dynamics, associated with policy, and associated with luck. And so because of some combination of good policy or good luck, it may be possible to find yourself in this lower left quadrant with few deaths and a small reduction in economic activity. Conversely, with some combination of bad policy and or bad luck, you could end up with a large number of deaths and large losses in GDP. And so you put these things together and you realize that if we look at the data, we're very unlikely to find sort of a nice smooth relationship between these two things. We're much more likely to see a cloud, and disentangling the dynamics, the bad policy and the bad luck is an extremely challenging exercise. It's one we don't even attempt here. Instead, we're just going to show you the data and talk through the outcomes. Okay, so here on the horizontal axis, you have COVID deaths per million people. This is the international country level evidence. On the vertical axis, I've got the GDP loss. And just to give you a sense of how to measure the GDP loss, here's the United States. You remember that 2020 Q2 saw a loss of about 10%, Q1 maybe a loss of 1%, but that's only for a quarter and a half or 2 quarters. And so if we asked how much of our annual GDP have we lost so far in the United States, that turns out to be just around 3%. So the US loss in economic activity is the equivalent to losing 3% of annual GDP. Okay, so now go up here to the upper right of the graph, and you see, the usual suspects, Spain, the United Kingdom, Italy, for example, that experienced large deaths from COVID and also large losses in economic activity. So losses equivalent to 6 or 7% of a year's worth of GDP. A country that has been talked about a lot already some today is Sweden. Sweden, when you compare it to the United Kingdom, looks much better, right? So similar numbers of deaths, around 550, 600 deaths per million people, similar deaths to the UK and Italy, but much smaller losses in GDP, equivalent to about 2% of a year's GDP instead of 6 or 7%. And so looked at that way, Sweden seems like a success story. On the other hand, it's very important to come over here to the lower left corner of the graph, where we see a remarkably large number of countries concentrated, including Norway, Korea, Taiwan, Japan, Denmark, and Germany, where Norway's a natural comparison to Sweden. And when you compare Sweden to the UK, they look great. When you compare Sweden to Norway, it looks like much, much less successful. Norway has a similar loss in GDP, around 2% of a year's worth of GDP, but with 50 deaths per million people instead of 500 deaths per million people. And so one takeaway from this graph already is that there are a large number of countries in this lower left quadrant that experienced good outcomes on both dimensions. For the state level evidence, our economic activity measure is excess unemployment. And so let me highlight California here in New York State. Right, both California and New York State experienced similar losses in economic activity as measured by excess unemployment. And the way to read this graph is it's as if California and New York have had unemployment rates that are 4.5 percentage points above normal for an entire year. Okay, that's the amount of excess unemployment they've experienced. And it's similar numbers. Both states were hit very early by the coronavirus. Both states shut down early, and both states have lost a lot of economic activity. On the other hand, you look at the death outcomes, and they really are strikingly different. 1,700 deaths in New York per million people versus 300 deaths per million people in California. Again, if you look at the lower left quadrant here, there are a lot of states in this, but it starts to make you wonder about the role of luck versus policy. So that's a theme I'll come back to. Okay, the GDP unemployment data are great, but they have obvious drawbacks. Namely, they're released with a substantial lag. And so we also turn to the Google Mobility Reports data. We're going to use the retail and restaurants component. And there's a pretty good correlation with the GDP loss and the excess unemployment numbers I've already showed you. So we think these data are a useful measure of economic activity. They have the huge advantage that they're available, at a daily frequency, updated quite frequently, and at an enormous geographical disaggregation. So you could see Seoul and Stockholm and Tokyo, which had much smaller sort of shutdowns in economic activity, losses in economic activity, relative to Lombardy, Paris, Madrid, New York, and London. We could look across states, and you see, New York and California, Florida and Arizona, Texas, DC. This other gray line is Hawaii. And then, the Google mobility data, as you've appreciated, is just great for the sort of subtleties you could capture. And so, this bump up here in early August is the Sturgis motorcycle rally, Harley-Davidson rally in South Dakota. So there's a lot to be learned from this mobility data. Here's a parallel graph using the mobility data. So cumulative reduced activity at an annual basis. For the countries, and you can see this graph looks very much like the GDP graph I just showed you, sort of confirming that this high correlation between Google mobility data and GDP gives us a similar message. A nice thing we can do with the mobility data, though, is look at the cities. So key global cities around the world. And we saw New York State and California. You can also look at New York City versus the San Francisco Bay Area. And there, the difference is even more striking. Again, similar losses in economic activity, but radically different mortality outcomes. So the Bay Area's lost 200 deaths versus 2,800 deaths per million in New York City. But again, there are these sort of key global cities. Seoul struck early by the pandemic and yet has had much, much better economic outcomes and death outcomes, even than California. And so the Bay Area looks good. The Bay Area is kind of the parallel of Sweden and the other side. The Bay Area looks good compared to New York City, but we have lost a lot of economic activity. And perhaps learning from Tokyo and Seoul and Germany and Norway, we could have done even better. In the next few minutes, let me focus in on another advantage of the Google mobility data, which it allows us to look at dynamics. So horizontal axis is the same one you've seen, only now on a ratio scale to make it easier to read. The vertical axis, this is monthly data now. So this is just the monthly Google mobility report, how much activity was reduced each month. And look at the green, that's the UK. So this is March and then April. So April is kind of the peak loss in Google activity across many, many regions, states, countries, and cities. May, June, July, August, and then September is in blue and has the country or city name after it. So what you can see here is that the pandemic hit, deaths increased rapidly, and then deaths kind of stabilized. And as deaths stabilize, economic activity starts to resume. And you can see in Norway or Germany or Italy or Sweden, they're at 10% reduced activity in September rather than 40 or 50 or 60 or 70. Bunch of other countries. Let me just highlight India and Mexico in this graph. India's in green, and you can see, first of all, a lot of countries have this sort of vertical movement as death stabilized, but not India and Mexico. India's still moving to the right. Mexico in purple is just moving to the right. And interestingly, as these countries move to the right, they're moving down. So they're not shutting down economic activity. Instead, economic activity is resuming as the number of deaths continue to rise in Mexico and India. And that's an interesting dimension to the crisis. Let me skip this global cities to focus on a few other cities. San Francisco Bay Area, Los Angeles, Miami, and Houston are kind of like India and Mexico in the sense that they're still moving to the right. You're not seeing this vertical move that you see, say, in Chicago or Boston or New York or Philadelphia or other places. They continue to move to the right. And then finally, let me highlight some states. Again, the state level evidence from the Google mobility reports, same thing. It's stabilized in many places, not quite in Washington, not quite in California. And then a few other states where we've seen, again, this sort of continued increase in deaths. So Florida and Arizona lie on top of each other here. If you see the vertical axis is changing, so it might have been better to keep that the same, the activity levels are lower, or the reductions are lower. So activity is even higher in Florida and Arizona, Texas and Georgia, Alabama. And then finally, Montana and South Dakota are interesting states to look at. Again, in April, everyone shut down quite considerably in terms of activity, but resumed quite quickly in Montana and South Dakota. And you've seen deaths continue to increase. And South Dakota is an interesting contrast with the Bay Area. South Dakota, not densely populated at all. We're not seeing the effects of the Sturgis motorcycle rally yet. It's a little too soon maybe, but that's what this dot is here. But South Dakota has more deaths per capita, 250 instead of 200 in the San Francisco Bay Area. And so again, I think there's lots to be learned from the dynamics in these data. Let me turn it over very quickly to Jesus to tie things together and bring out some nuances.
Thank you. So the evidence to date can be summarized in this figure where we have the 4 quadrants created by the Cartesian product of 2 variables, COVID death and GDP losses. As Chad explained before, in the upper right quadrant, we have New York City, Lombardy, Madrid, etc., with high COVID mortality and GDP losses. Below them, we have Sweden with a moderate GDP loss but high COVID deaths. In the opposite quadrant, we have California with high GDP losses and low COVID deaths. And finally, we see a number of regions from Germany, Norway, Taiwan, Kentucky, Montana, with low COVID deaths and moderate GDP losses. And probably the most important lessons for us from this paper is how many observations we have in this lower left quadrant. Our current reading of the evidence is that luck may have played a role, but the heterogeneity that exists in this quadrant suggests that there must be something more than just luck. We have places like Seoul and Tokyo that are large, immensely dense cities, and we also have Montana and Norway that are low density locations. We have countries like Taiwan and South Korea that had been scared in the past because of SARS and MERS, and we have countries like Germany and Norway that had not been touched by previous scarce health epidemics. And yet, all these countries seem to have been doing much better than their neighbors. Norway seems to have done much better than Sweden. Germany has seemed to be done much better than the United Kingdom or France. And while the evidence is still not fully settled, and as you probably know, right now, Europe is starting to go through a very, very serious second wave with countries like France and Spain back in a very tight spot. And hence, where each country may end up in 6 months is still something that remains to be seen. At least our reading of the evidence is that we want to spend a lot of time thinking about what Germany, what Norway, what Taiwan may have done right to stay in that lower quadrant instead of falling in any of the other 3 places. That's it. We finished right on time, I think.
Okay, great. Thanks very much. Discussant is Andy Atkinson. We're getting set up. Andy has, I think, the first paper in this area for economists back in March.
Thank you very much for having me here and to discuss this paper, and I'll look to get through in my allotted 12 minutes. Many of us have been watching both the economic outcomes and the death outcomes associated with COVID. We see rich dynamics. Deaths fell in many places between March and April, and then are slowly recovering. And then we have various patterns of deaths, some steep increases and falls. And then, as pointed out, I guess for India and Mexico, but here I'm showing India and Brazil, slower growth and maintaining high levels of deaths for long periods of time. And this paper usefully organizes these outcomes into this summary plot, where we might think of the roles of luck and policy in determining which quadrant you end up in. And what I want to do in my discussion is just give like a back of the envelope model related to the one we saw just in the previous session to maybe interpret what do we mean by luck and what do we mean by policy. So if I want to think about what's driving the data, let's think in terms of a behavioral SIR model, similar to what we saw in the previous session. And I'm going to think about 2 sources of differences across locations. There will be just a fixed effect in what is the disease transmission given the level of activity. And we'll see that is something, it could be determined by the disease itself. It could be determined by density, cultural practices, do you bow versus shake hands? Who knows what? Do you ride on the subway? There's been a lot of things discussed. And then a second source of heterogeneity across regions would be in the behavioral response. What is the elasticity of the response of activity to the level of infections that are prevalent at the moment? And I'm just going to think of those 2 differences as an interpretation for luck and policy, where the first one I'll just call luck. There's not much you can do about it. And the second is policy. And I picked a behavioral SIR model just because it's going to be consistent with key facts we've seen about COVID worldwide. I documented work with Karen Kopecki and Tao Jia that we saw initially high and highly dispersed reproduction numbers across locations in the world right at the start of the epidemic. And then quite rapidly, those reproduction numbers fell essentially everywhere, down near, close to 1, and have stayed there since. So the model that I write down is taken, Gianluca Violante, I think, used it in a previous discussion. The equations on the left-hand side are the standard equations for an SIR model. And what augments the model to make it behavioral is on the right-hand side. I have 2 equations. Y is the level of activity, and beta IT is the transmission rate. So this gives a function that says higher activity will result in faster transmission of the disease, but there's this fixed effect beta bar I that might differ across regions. So that shifts the transmission rate given the level of activity. And the second equation that in the behavioral model is the behavioral part, given the level of infections, capital IT, how does fear or policy responses or whatever get people to reduce their activity? Why? And we're going to think of that elasticity, sigma I, as potentially differing across locations. So that could be, the political differences that were highlighted in the previous session affecting the endogenous responses of individuals, or it could be how aggressively authorities respond in terms of lockdowns to the disease state. And so what I'm going to do is 2 experiments. I'm going to just have 3 stylized regions. The first thing I'm going to vary is the beta bar term. The second thing I'm going to vary is the sigma I term. And so first I'm varying the beta bar. What is transmission given activity? And so I simulate the model for 180 days. We get a decline in activity early on and a slow recovery, a spike in daily deaths and a fall. In the lower left quadrant, we see the effective reproduction number start at initially dispersed levels and then fall close to 1 for the remainder of the time. And in the lower right quadrant, I just did that dynamics graph that they showed, that Jesus and Chad showed previously, but I guess with log cumulative deaths on the x-axis. But the key takeaway from this experiment is that if you look at the cumulative loss of life and the cumulative loss of activity over 180 days, you get a very nice upward sloping line. There's a region up here that has a lot of death and a lot of lost activity, and a region down here that has very little death and very little lost activity. And in the model, that's chalked up to this fixed effect that just says, in your region, a given level of activity translates into a higher infection rate. So in the second experiment, where I make instead the elasticity vary, we again see these early declines in activity and recovery, different shapes of the deaths across the regions. The fall in the effective reproduction number happens again, the dynamic patterns that we saw before. But now the slope of the line goes the other way. So we have a region that is not very responsive, and it gets a lot of deaths, but less lost activity, and a region up here that is very responsive, and it has fewer deaths and significantly more lost activity. And so it's natural, if you think about it, that you could combine, these 2 sources of heterogeneity, and you could get a cloud. I guess this is an older version of the graph that was shown, where we have on the x-axis the COVID deaths per million people and some measure of cumulative lost activity on the y-axis. And let's think about Sweden, which everybody likes to talk about. As pointed out, Sweden looks quite bad relative to the United Kingdom, and Sweden looks quite good relative to the United Kingdom, and it looks quite bad relative to some of its neighbors. I'm not going to focus on the names, but let's think about, well, actually, in this case, I will. Let's think about how could we tell how much of this is luck versus policy. So a hint, I think, comes from the data on daily deaths. If we look at, this is a plot that shows new deaths per day on a logarithmic scale. It's actually a 7-day moving average for these 6 countries that we mentioned. And if you look carefully at this plot, the UK and Sweden seem to have in common that the increase in deaths was very steep early on in compared to these other countries. You can't quite see in the beginning here, but you might estimate a basic reproduction number before policy kicks in that's higher for the UK and Sweden than it is for these other countries. And then how fast this death rate comes down would have to do with the elasticity of the response. So let me just give a caveat. This is not an estimation. This is something I made up. But here's some parameter values that I'm going to call this dot Sweden. The UK, and it has a high, what I call a basic reproduction number, how the epidemic's going to grow right at the beginning. Sweden down here has a little bit lower than the UK, but the UK has a higher elasticity than Sweden. And this gives us, this thing that the UK has essentially much more lost activity for the same number of deaths as Sweden. And then over here, we have these a representative of these countries in the lower left-hand side that they benefited from having a lower effective reproduction number. The hint at that is that they had a lower growth rate of new deaths right at the beginning of the epidemic. And then they have the UK's elasticity. And so we see Sweden has essentially the same GDP loss or activity loss and many more deaths than them. So on the basis of this, I haven't done it. This would be related to what went on in the previous session. You could do counterfactuals and say, what if Sweden had Denmark's, beta bar I, or what if Sweden had the UK's elasticity? You could do a lot of different counterfactuals. When I look at the data that they're showing in this paper, and I interpret it in the context of this kind of very simple model, the fact that a lot of the data seems to line up on this, upward sloping line suggests to me, well, I should step back. The first point is simple comparisons of outcomes are probably not very informative. We need to do some kind of more structural analysis to figure out what's going on. But this suggests to me that luck is actually playing an important role. And I think the way you would verify that is to go back and say, are the regions up here, did they have evidence of a high basic reproduction number right at the beginning of the epidemic, very fast growth? And did the regions down here have evidence of a low basic reproduction number, or when they got hit by the epidemic, they had relatively slow growth? So that's my discussion, and thank you very much.
Thanks very much, Andy. We have a question. We'll go to questions. I see Caroline Hoxby.
Hi, thanks very much for this paper and the discussion. I thought it was terrific. I learned a lot from it. I wanted to ask a question about compliant or non-compliant behavior, because that seems to me like an important mediating factor in in how much you need to shut down economic activity and contacts and mobility and things like that in order to reduce the spread of the coronavirus. For instance, when you look at the difference between Northern California, the San Francisco Bay Area, and Los Angeles, they're really under very similar regulations the entire time. They're being told to do the same thing. So what's the difference? What's the explanation? It's probably not a density explanation, because in fact, if anything, San Francisco's a somewhat denser city than Los Angeles is. But my understanding is there's quite a difference in how compliant the behavior is. So one thing when people have said this about Sweden is that you can do things in Sweden that you couldn't do in the United States because Swedes are more likely to be compliant with the rules that are made. So I wonder whether there's any data that you can get out of Google or something else that suggests how compliant people are, how many masks are being purchased, other types of things that might be a bit more like surveillance almost to try to determine how compliant people are.
Yes. So let me.
Jesus, let's collect questions.
Oh, sorry, my mistake.
Okay, Martin Bailey.
Can you hear me now?
Yep.
You used deaths. In one of the studies that I looked at, they were looking at confirmed cases in relation to deaths, and there were very, very wide differences in the ratio of deaths to confirmed cases. Now, maybe, and I don't know the data as you guys do, but maybe that simply reflects differences in reporting, but it did appear that the differences were so wide that one of the things that's going to affect the outcome is how many people die given relative to the number of actual cases. So in this data that I looked at, the US actually did fairly well. It has a huge number of cases. So whatever policy or behavior, we have a very large number of cases, but the number of deaths is actually muted because the number of deaths per case is much lower than most of the other OECD countries. Same is true for Germany. Same is true, I think, for Japan. I didn't look at Korea. And when you looked at France or the UK, the number of deaths in relation to the number of cases was much larger. So I just wondered if that was an intermediating factor that should be considered, or whether the data is not good enough. Thank you.
Ken Rogoff?
Just one question and a comment. So the question simply, to what extent are the outcomes very heavily affected by nursing home protocols, which seem to be a huge issue in looking at variation in the United States, or even the commonness of nursing homes, which they don't have so much in developing economies, which has been held out as one reason it didn't spread as fast. I guess a second point is, in a few years, it'll be obviously interesting to think about life expectancy, morbidity, as opposed to just deaths, which is a very crude measure of the health outcomes. Thank you.
Mervyn King?
The data discussed so far are for COVID-19 deaths. Even that internationally is not easy to make comparisons on, because the definition of a COVID-19 death varies from one location to another. And that's why a number of people have looked at excess deaths relative to, say, a 5-year moving average, monthly excess deaths. That has one advantage, which is you can look at the period before COVID. And what is very interesting is that countries which had low excess deaths in 2019 had higher excess deaths in 2020, which we now attribute to COVID-19. And that's a particular factor that singles out Sweden and the UK, in addition, I think, to the nursing home point that was made. But it's also highly relevant to a comparison between Sweden and Norway, because one of the big differences between those two countries was that Norway had a lot of deaths in 2019 relative to their expected number. Sweden had fewer. And so Sweden caught up in 2020 when COVID-19 hit. And I think this is very relevant to Andy's point of interpreting what's happened in terms of luck. It's not so, luck in quotes can also refer to the starting point and the prevalence of countries in terms of their vulnerability to an epidemic of an infectious disease, as opposed to just policy issues. Now, it'll be a long time before we know the answer to it, but I think there's some merit in looking also at excess deaths, because that enables you to look at the period before COVID-19 and not just what's happened this year. But there were excellent presentation and an excellent discussion too.
Thanks. Jason Furman?
It's a great paper and discussion. I have a mental model that makes sense of some of the lack of correlation and wanted to see what you think of it, which is economic performance is a function of two things. One is when there's more virus, that's worse for your economy. The second is when you're more averse to the virus, you take bigger steps for any given amount of virus, and that is also worse for your economy. So you look at a place like New Zealand, they should be reaping huge benefits from how little virus they have, But when they get just a few cases, they start to do pretty extensive shutdowns. And that something like that might explain why over the summer, when Arizona, California, Florida were spiking in terms of the virus, economic activity there was just the same as it was in Connecticut, Maine, and Vermont, because those states were less averse to the virus than the northeastern states were. So do we think there's some like underlying parameter there that some places do more, some places do less in response to the same amount that's inversely correlated with the virus, and that's why you sort of cancel out and don't see a strong relationship between how much virus and your economic performance?
Thanks. Bob Hall.
Okay.
Yep, Bob, I think you're good.
Okay, great, thanks. In terms of randomness, there's been an interesting speculation on the relationship of COVID to tuberculosis, which is negative. Countries like India, where tuberculosis is endemic, have very substantially lower COVID death rates. And there's some speculation, Jesus assures me that the speculation is bogus, but that this relates to treatment of vaccination against tuberculosis, which is widely practiced in third world countries like India. And there's some indication, maybe not, that treatment or that drug has some effect against COVID.
Thanks. Tristan Reed. Okay, Tristan, you should be up.
Hello? Can you hear me?
Tristan? Okay, can't get any audio. We're going to move on to Elaine Buckberg. Okay, Elaine.
Can you hear me now?
Yep, you're good.
Wonderful. Thanks for this great paper. I saw Jesus's comment that trust in government didn't work well, but I wonder if part of the question is actually more willingness to behave in the interest of the common good versus individualism. And one way to get at this, at least for some countries, might be looking at some fiscal variables in terms of size of government budget or size of transfers. Although that might not work as well for some Asian countries, which of course have this historical behavior of wearing masks to protect others. But you might go down that alley.
Okay, Tristan, are you online?
Can you hear me now?
Yeah, now you're good.
Okay, great, thank you. So in my paper at the last Brookings panel with Penny Goldberg, we did some of these cross-country regressions as well and found a lot of explanatory power of health covariates, the age distribution, obesity, and then actually population density. So I wondered if you'd throw those in and maybe, that's a few ways to at least project luck onto a few observables and see how much you can account for with that. Thanks.
Yeah, I'll endorse that. That's a terrific suggestion. Let me make, I don't see any more hands, so let me just make one comment myself. I think this paper and the previous one both, I'm going to step back to a higher level comment here. This paper and the previous one focused on lost economic output versus lives in one way or another. Either it's through shutdowns, mandated in local areas, or here, we're just thinking about that chart that you have. I think that's a reasonable framing for much of what happened in March and maybe in April. I think that starting in May and certainly where we are right now, we know that there's much more going on. And this gets at the point Mervyn King raised one of them, I believe it was, which is thinking about protections for the elderly, although maybe that was somebody else who raised that. But there's many, many, many other rich dimensions in which the virus can be contained at the same time as really not impacting the economy. So masks is an obvious one. Testing and quarantine is another obvious one. But it seems to me that if we think about what the lessons are from these papers going forward, the focusing on actually adhering and doing the things that are both good for deaths and good for the economy make a lot of sense. In every one of these papers, the preferences are such that people would rather live than die, and they'd rather work than not. And there are NPIs that go in that direction. And that's what we need to remember for policy. And if anything, here I'll editorialize, the tragedy is that we've decided that that's not the direction that we want to go. And we want to leave the local officials only with one option, which is not a terrific one. Okay, back to the authors. And you don't have to respond to that. That was just editorializing.
Yes, don't worry. So first of all, also let me then return with a meta comment, if I may. Had I done this presentation 2 weeks ago, I would have leaned a little bit more towards luck. Having seen the second wave in Europe and having followed the second wave in Europe over the last 3 weeks in a lot of detail, it really strikes me that policy makes a huge difference. You are seeing countries like Italy versus Spain. Spain, the epidemic is again totally out of control. ICU units, beds in Madrid are over 100% capacity, again on September 23rd. ICU units in Milan are not. So, maybe what happened in San Francisco versus New York was due to bad luck back in February. What is happening in Milan versus Madrid right now is, I think, in my opinion, very clearly due to some policy decisions. And I think that if we can have a follow-up in 6 months, 1 year, some of these ideas will be much clearer. With respect, there were a lot of fantastic questions. For instance, the issue of excess debts came out. Chad and I have another paper where we do a little bit more of formal econometrics, and over there we actually use excess debts instead of measured debts by Johns Hopkins University. Things do not change that much because actually there is some indication that countries that have had the worst death scenarios, like Spain or Italy, were also the countries that undercounted the most. So if anything, using excess debts make things much worse. And both Spain and Italy did not have excess debts in 2019. Actually, I can tell you because I look at both countries in a lot of detail, both Spain and Italy had relatively good mortality in 2019. So this may explain a little bit of Norway versus Sweden. You are not going to get very far to explain Lombardy or Madrid versus Bavaria. It will be great also to have good measures of compliance, social trust, etc. I think this is very important. And I think that as it has been pointed out, even in the US, you see states like Vermont or Maine that have done much better than other similar states. And I hope no one take offense that, if you have this very stereotypical view of people in Vermont and Maine being very well behaved and following the rules more than perhaps people in Philadelphia, if I might say so. And in that sense, it will be fantastic if maybe in 1 year or so we have a little bit of better measures of this type of compliance issues. There is some data on mask use. I'm not sure how much of this data we can believe. Maybe if we live in a totalitarian society like China, where everyone is recorded, we could actually check videos and measure things. But we have, I think, a graph about mask use in the paper, and we make a little bit of discussion about it. And also, finally, let me, because I don't want to run out of time, I fully agree with Ken and Jim comments about other outcomes, long-run health consequences, etc. And unfortunately, I will be the first to be able to say a little bit better about this. It's just too early. We just don't have any of those data. And this will be something that maybe in 5 years, when we do the Brookings 5-year retrospective on COVID, I will be able to give you a better answer. Chad, I don't know if you want to add something else.
And I think that was great. I think the only thing I would add that hasn't really come out yet in the discussion so much as I think it deserves to is sort of the luck involved with timing. So if we'd written this paper back in May, for example, Arizona would have looked great. Montana and South Dakota, still look great, but you could see them in the graph moving to the right. And I think, I think there's an element of luck which is not always obvious in the slope of the death curve, because Arizona didn't have a big slope for a long time, and then they started to have a big slope. Or Miami, Florida looked good early on, and then didn't look good. So I think there's also a bit of a luck involved with timing. And so, as Jesus was saying, 6 months or a year from now, we may look back at things and see a different version of these graphs. So thanks very much for all the comments and Andy's great discussion.
Okay, Andy, you get the last word, but it's got to be brief.
Yes. Well, I guess a small thing in response to Jason Furman's question, I interpret the elasticity of the response of activity to infections as capturing what you were discussing with regard to New Zealand. Is this a very aggressive response to the disease state? But I think the broader question of luck versus policy and what Chad just said, I think one of the big lessons from the Spanish flu is that, some places were hit in the first wave hard and others not. And then other places were hit in the second wave hard, and sort of that element of luck and, density is not a good proxy. There's something else going on that's determining how you get hit, and disentangling that from policy is going to be hard. Thanks.
Okay, thanks very much. Let's move on to the next paper. And Matt, I believe, Norton-Ricto is presenting.
All right, is that on?
Yep, yes, we don't see your slides. Okay, looks good.
Sorry about that. All right, thanks to the organizers for having us. This is going to be a somewhat narrower paper, I think, than the previous ones. We're focused entirely on labor market dynamics, and we're trying to understand the role of temporary unemployment and trying to both understand what's happened in the last several months, and then we're going to try to do something a little more ambitious, which is to try to come up with some forecasts for the future using a calibrated model. This is joint work with Jessica Gallant, Corey Croft, Fabian Lang. They're all in Canada right now, and I'm Matt Notowadigdo, and I'm at University of Chicago Booth School of Business. I'm going to do one slide to motivate the paper. So I think this is pretty clear to everybody, but the COVID-19 recession is a very unusual recession. It's had an extremely rapid increase in the unemployment rate, record-shattering UI claims. What I think is a little bit less remarked on is that the increase in unemployment has been much larger than the corresponding drop in job vacancies, breaking the beverage curve, the historical relationship, the negative relationship between unemployment and job vacancies. This is most colorfully shown by this recent tweet by Catherine Rampell, who writes that the beverage curve is drunk. She's showing here the enormous increase in unemployment, but a much smaller corresponding drop in vacancies. And that's something we're going to try to understand in this paper. The other way that the recession is unusual is that typically recessions begin with a large increase in job separations, followed by some period of time of relatively low job finding rates. But in our analysis of the data, we actually find that job finding rates have remained relatively high during the first several months of the COVID-19 recession. And so the motivation I'm trying to give here is we want to see the extent to which temporary unemployment can account for some of the trends that we've been seeing. And I want to just define temporary unemployment right off the bat. These are workers who've been laid off, but believe that their unemployment is going to be temporary and that they'll be recalled to their former employer. So what we do in this paper is we develop a search and matching model building on some of our own prior work that distinguishes between temporary and permanent unemployment. And the key idea, which I think is pretty intuitive, is that if workers believe that their unemployment is temporary, then they're going to impose less congestion on the search and matching process. Basically, they'll be waiting instead of searching. And that might have implications for the job finding rates of other unemployed workers. We're going to develop that model, and then we're going to calibrate it using current population survey data. And all of the calibration is going to be using data prior to 2020, i.e. prior to the start of the pandemic in the United States. And then going back to the motivation, we're going to use the calibrated model to try to adjust the Beveridge curve and make sense of what's going on there. We're going to adjust based on the composition of the unemployed along a number of dimensions, including whether the unemployed are temporary or permanent, and also building on our previous work, whether they're short-term unemployed or long-term unemployed. And then I'm going to conclude by giving some forecasts of the unemployment rate over the next 18 months under different scenarios, i.e. different assumptions about the path of job vacancies, job separations, and the recall rate of the temporary unemployed. Okay, I want to just highlight a couple papers to give some background on where we're coming from. There were 2 Brookings papers by Ellsby et al. On the dynamics of recessions, both historical recessions as well as the Great Recession. I think these are good papers to compare to our work just to see how the Great Recession is different. And then we're building on our own work, Croft et al. Here, as well as Kruger, Kramer, Cho, which is another Brookings paper, in that we're going to have a search and matching model that we're going to write down. And the main distinction is that we're going to add temporary and permanent unemployment. And then finally, in terms of our data and measurement, the way that we think about the temporary unemployed, we're building on 2 recent papers by Forsyth et al. Okay, so our data is going to be 2 main sources: the current population survey data, that's monthly data, which we're going to use both the cross-sectional dimension and panel data. We're going to use that to measure labor market states, and we're going to use it to divide the temporary unemployed into 2 different groups. The waiting temporary unemployed, those are workers that we're going to assume are not actively searching. And then there's going to be a subgroup of the temporary unemployed who are actively searching, TA, and they're going to behave somewhat similar to the permanent unemployed in the model. Each month, we're going to measure stocks of each of these groups, and we're also going to measure month-to-month transition rates between these groups. We're going to combine the CPS data with job vacancies data from JOLTS, just as we've done in our previous work. The way that we measure the temporary unemployed is going to draw on these papers by Forsyth et al., as well as guidance from the BLS. And one thing I want to highlight off the bat is that we're going to include in the group of temporary unemployed workers who say they're employed but are absent for other reasons and unpaid. This matters for sort of capturing the early dynamics of the COVID recession. I've already described how we divide the temporary unemployed into the waiting and active temporary unemployed. And then we're going to estimate the month-to-month transition rates in the same way we've done in previous work, which is we're going to estimate them in a way to impose consistency across the measured stocks each month. And you can look to the paper for more details on how we do that. All right, I'm going to go through in just about a minute or so some motivating figures to understand why we wrote down the model the way we did. So everyone listening has seen the trends in unemployment rate. I'm now breaking out unemployed into permanent unemployed and temporary unemployed. And what you see is that during the Great Recession, most of the increase in unemployment was permanent, whereas in the COVID-19 recession, most of the increase in unemployment was due to temporary unemployment. That's what I'm showing you here. Vacancies dropped very rapidly during the Great Recession, and they dropped as well during the beginning of the COVID-19 recession. But what we found interesting is that they have begun to recover and actually have already recovered a lot of the initial drop. Job separations, that is people going from employment into unemployment, most job separations have been transitioning into temporary unemployment during the first several months of the COVID recession. And so as a result, the share of unemployed workers who are temporary unemployed spiked during the first few months of 2020, has remained relatively high. It's gone down slightly, but it's still much higher than any time in the last couple of decades. We also see job finding rates remaining relatively high in recent months, certainly higher overall than compared to the Great Recession. And a lot of this looks like a somewhat of a composition effect, is that temporary unemployed workers always historically have higher job finding rates than workers who've been permanently laid off. And if a lot of the unemployed are temporary unemployed, then just mechanically, you'd expect to see a higher overall job finding rate. That's our interpretation of the data here. Our model captures negative duration dependence. That's what really we got interested in this during the Great Recession, which is this idea that the longer workers are unemployed, the lower their job finding rates are. This figure shows that that's true in our data, both for permanent unemployed workers as well as those who are temporary unemployed. And that's going to be captured in our model because as workers remain unemployed longer, their job finding rates are going to decline according to functions fit to the data that I'm showing you here. That in our intuition was that this would lead to a kind of hysteresis where if the recession is prolonged, the longer workers are out of work, the lower job finding rates are going to be both for permanent and temporary unemployed workers. Here's one last motivating figure, which I think shows another way that this recession is unusual, which is that there are always temporary unemployed workers in recessions. But as the recession goes on, there's a rising transition rate between temporary and permanent unemployment. You know, intuitively, if workers aren't recalled, then eventually they end up on permanent layoff and they have to start actively searching for a job. That's what I'm showing you here at the top. On the bottom, what's been interesting to us is that we don't see much evidence of a rising transition rate between temporary and permanent unemployment. If anything, it looks like the transition rates have actually switched, where there are some workers who report being on permanent layoff and then end up reporting on temporary layoff the following month, which I don't want to make too much of that because that could just be mostly a measurement issue. But what I think is very clear in this figure is we're not seeing rising transition rates from temporary to permanent unemployment yet. And I think I'm going to use Justin Wolfers and Betsy Stevenson here as representatives of, I think, this conventional wisdom that the labor market has moved on from temporary layoffs to permanent layoffs. And we are not just seeing that in our analysis of the CPS data. And our analysis lines up with a recent working paper by Hall and Kudlak, who also note that there's been no visible increase in transitions from temporary to permanent unemployment yet. Okay, so those are our figures for motivation that lead us to develop the following search and matching model. This slide is just reproducing the model that we developed in our previous work. It's a standard matching model. Market tightness here is given as the ratio of vacancies to total job search, and job finding rates for those who've been permanently laid off, as well as the job finding rates for non-participants, is given by this following function, which is a function of market tightness. What we add to this model is job finding rates for the temporary unemployed, those who are waiting around and those who are actively searching. Those who are actively searching, that's the TA, they find jobs either through being recalled, or if they're not recalled, then they start actively searching and find jobs at the similar job finding rate as the permanent unemployed. What else? The other thing that's new about this model is that we can then write down an expression for the total search of all of the non-employed workers, that is the unemployed workers and non-participants. It's given by the sum of the search effort of the permanent unemployed, the temporary unemployed that are actively searching and not waiting, and the labor market non-participants. And so when we adjust the Beveridge curve, we're going to adjust it in the way given by this expression. And you can find more details of these formulas in the paper. Okay. We calibrate the model by using our CPS data to measure stocks and transition rates. We estimate duration dependence, the negative relationship between unemployment duration and job finding rates. We're going to assume that that's stable over time so we can pull all the data together. And then we're going to estimate the remaining model parameters, that is the parameters of the search model, using minimum distance over the pre-2020 period. We're going to minimize the distance between job finding rates for each month, and that's all going to be done using pre-2020 data. So if you look in the paper, what you'll see is that we find model parameter estimates that are pretty similar to the estimates we reported in our previous work that used only pre-2008 data. We find that reassuring because it suggests that the matching model parameters, the duration dependence parameters, are fairly stable over time. So here's the way we're going to assess the fit of the model. We're going to compare the model predicted job finding rates to the actual job finding rates for the all unemployed. So here we're combining the permanent and temporary unemployed together, and the paper shows the fit separately for the permanent and the temporary unemployed. So the model fits quite well. That wasn't that surprising to us because the model fit quite well, before, during, and after the Great Recession, even before we added in this distinction between permanent and temporary unemployment. What I think was more interesting to us is the model fits well out of sample all through 2020. And in particular, if I compare the results of our model to a off-the-shelf model, the same model that we used in our previous work, the model used by Kruger et al. In the Brookings paper in 2014, we call that the single unemployment state model because this is a model that doesn't distinguish between permanent and temporary unemployment. Then the job finding rates that we predict out of that model are actually predicted to be falling during the last several months. And that's actually counterfactual. It doesn't match up with the observed job finding rates. And so this is our sort of first piece of evidence that the composition of unemployment, that is the share that are temporary and permanent, is important for understanding the recent path in job finding rates during the first few months of the COVID-19 recession. A model that just assumes that all of the unemployed are as if unemployed in previous recessions is going to end up understating the actual job finding rate, and then in turn over predicting the overall unemployment rate. Okay, so now that we've calibrated the model, shown the fit, we're gonna do two things. First, we're gonna reassess these movements in the Beveridge curve. So here's the Beveridge curve as its standard form, vacancies over population on the y-axis and unemployment over population on the x-axis. And you see this huge outward shift that only begins to come back in the last several months. If you replace on the x-axis unemployment over population with what our calibrated model says is an appropriate measure of total search effort divided by population, then you see a much less of an apparent outward shift, and you see a much more well-behaved Beveridge curve during this time period. It suggests that market tightness, at least as measured by the ratio of vacancies to total search effort, may not have changed that much in recent months. And in fact, if you look at these massive points here in 2020, they're right around where the points are in 2015, right around which we historically would not have thought of as being a particularly weak labor market. Okay, I'm going to use the remaining time I have to then go through some predictions. These are forecasts from our model. What our model has endogenously is the job finding rates. What the model treats as outside of the model, the exogenous, or what we call the forcing variables in the model, are the path of job vacancies, job separations, and the recall rate. So if we make different assumptions about the paths of those variables, then we can come up with different predictions or projections about the path of unemployment. What I'm showing you here is our baseline prediction, where we assume that those forcing variables gradually recover to the pre-2020, 2019 levels over a period of 24 months. And according to that, our baseline model here, which I'm showing you in this dashed line in blue, predicts a pretty steady recovery in terms of the unemployment rate. And importantly, it's more rapid than a model that doesn't distinguish between temporary and permanent unemployment. I want to remind you that our calibration here is all based on 2020 data, and our predictions are based only on the model and those forcing variables that I described, vacancies, job separations, and the recall rate. So if you look in the early parts of 2020, what I'm showing you here is that our model does a pretty good job replicating the path in the unemployment rate over the last several months, and it does much better than a calibrated model that doesn't distinguish between temporary and permanent unemployment. That calibrated model predicts unemployment much higher for the last several months and would continue to predict unemployment much higher than our baseline scenario. You can compare our predictions to some forecasts, and we thank our discussant Gabe here for giving us some of these forecasts that we can use for comparison. These are CBO forecasts and the Fed forecasts. In our baseline scenario, we end up predicting something somewhat more optimistic than all of these scenarios, particularly as you go out into 2021. In order to match these scenarios, as we go through in the paper, it needs to be the case that we either see more pessimistic trends in job vacancies or separations, or what we call our stalling out scenario, where there's no recovery in any of our forcing variables over the next 24 months. So the summary of that is that we find that unemployment declines more rapidly, and I sort of see this as an internal consistency check of the professional forecast. For those forecasts need to be correct through the lens of our model, it needs to be the case that we need to see some deterioration in either vacancies, job separations, or the recall rate of the temporary unemployed. We cite some survey evidence in the paper that when you ask workers whether jobs are hard to get, their answers are nowhere near the levels that were reported during the Great Recession. And so if I can be provocative here, it suggests that the jobs may not be scarce for the set of unemployed workers that are actively searching for a job. So in my last slide, I want to just highlight the fact that our model indicates that temporary unemployment can provide one explanation for some of the unusual patterns in the data during the COVID-19 recession. And I think what we take away from the model is that it suggests focusing somewhat less on the headline unemployment rate and instead looking more carefully at the composition of the unemployed alongside measures of job vacancies and job separations. Thank you very much.
Thanks, Matt. The discussant is Gabe Charter-Wright.
Okay. Jim, give me a thumbs up.
You're good.
Okay. Thanks a lot for inviting me to discuss this very interesting paper. GKLN, as I'm going to refer to the author team, provide a very nice summary of the COVID labor market to date and a somewhat optimistic forecast of the path forward. In my discussion, I'm going to play a bit of the skeptic's role and give some reasons to temper their optimism somewhat. To get there, I'll start with a brief overview of the COVID labor market, then I'm going to review the GKLN exercise, and finally present 3 key questions about the future of the recovery, where I think their forecast emits potentially adverse forces. So I'm going to start by laying out 4 crucial aspects of the COVID labor market to date. The first is that for all of its unusual features, the matching process has remained relatively stable once one conditions on the type of unemployment. And that is a key and important finding of this paper. The second is that there's been a historically high share of unemployed on temporary layoff who traditionally have high reemployment rates. The third is that separation rates into unemployment from employment have remained high even as the labor market has recovered. And the fourth is an implication of the previous, which is that there is an unusually high amount of churn. These figures are adapted from a recent paper of mine with John Coglianese that I'll refer to a couple times in this discussion. I think they do a good job of sort of summarizing what's happened in terms of job finding and the importance of composition. So on the left panel, I plot the historical average reemployment hazard rates by type of unemployment, and then in the dots and squares, the hazard rates during the COVID recession. So you can see after falling in March and April, the overall reemployment hazard from unemployment, that's these black dots, has risen to a historically high level. At the same time, the reemployment hazard conditional on being on temporary layoff, that's these green circles, has actually been below its historical average. And if you look at all other types of unemployment, it's also been below its historical average. And in my paper with John, we split the others into the permanent quits and entrance components, and they all look sort of similar. Okay. So what's going on that each part is lower than the historical, but the overall is higher? It's all about the composition. On the right panel, I show the share of temporary layoffs among the total unemployed. It shot up to a historically high level and has remained somewhat high thereafter. Okay. So the punchline is the recovery of the past few months is entirely driven by the fact that there were a historically high share of temporary laid off individuals. You'll note that the temporary layoff share has, however, been declining, and I'll come back to that. The GKLN exercise is easy to describe. They write down a standard search and matching model that accounts for heterogeneity among the unemployed. In particular, they allow for different job finding rates for those on temporary layoffs and not searching. I'm going to abuse notation a little bit. I'll call that UTW. Let me note that that's roughly 3/4 of all temporary layoffs who don't search. Okay. Then you have temporary layoffs who are searching, and those are going to be tracked by their duration of unemployment. And you have other unemployed who are also tracked by their duration of unemployment. The exogenous driving forces are the number of vacancies, the separations from employment to unemployment and into non-labor force, transitions among unemployment states and non-labor force, and also the recall rate for those who are on temporary layoff and waiting. So again, that roughly 3/4 of temporary layoffs have an exogenous recall rate. So the key endogenous outcome is a job finding rate of the searchers. And who are the searchers? They're the unemployed by duration, including those actively searching on temporary layoff and the non-labor force. The model fits the data well overall. So Matt showed you this picture that shows the job finding rate for the overall unemployed. In the paper, they split it by the job finding rate for those who are permanent unemployed and those who are temporary unemployed. And remember, the permanent unemployed, these are all endogenous outcomes, and it does a pretty good job, although the levels are a little bit off in places. The really great fit is coming from the job finding rate of those who are temporary unemployed. But remember, this is somewhat by construction because 3/4 of these are waiting and therefore getting fit exogenously by construction. A maybe more generous way of saying that is it's clear from these figures that if you didn't recognize the importance of temporary layoffs, you would be off in your labor market analysis to date, and that really comes through in their paper. Okay. Now, the paper has some stark implications for the future. First, they project a much more rapid labor market recovery than most government or professional forecasters. And basically, this comes from temporary layoffs returning to work at a high rate and new separations out of employment continuing to decline. And I will say a point in their favor is that so far the professional forecasts have proven too pessimistic. So for example, last week, the Fed released a new SEP. The median had an unemployment rate in 2020 Q4 of 7.6%. That's down from 9.3% that was anticipated in June. Second, they foresee relatively less long-term unemployment given how high the unemployment rate went. And I'm going to dwell less on this aspect. I'll note that I agree with it fully. It's consistent with my work with John. And it really reflects just the high amount of churn in the COVID labor market so far. So that brings me to three key questions, the answers to which I think will determine whether their forecast going forward proves correct. The first concerns reemployment hazards of the temporary unemployed, the second, the separation rate, and the third, the general level of labor demand. Okay, so let me start with the recall rate. So as of the August employment report, there were 6.2 million individuals on temporary layoff, which comes to 3.8% of the labor force. The overall unemployment rate was 8.4%, so you can see how rapid reemployment of these individuals would generate a fast labor market recovery. I showed you earlier that the reemployment hazard from temporary layoff during COVID has been below its historical average. The GKLN baseline forecast that Matt showed assumes that this recall rate, again, this is the exogenous part of the recall rate applying to those who are waiting, rises back to its pre-COVID level over the next 24 months. And I'll note that that pre-COVID level was at a historical high. So these individuals under that scenario get reemployed relatively quickly. I'm now going to suggest the possibility that in fact the reemployment rate from temporary layoff could actually fall instead. Why might this occur? As the share of the unemployed on temporary layoff has declined, the average duration of unemployment for those still on temporary layoff has risen. So I show this in the left panel separately for those who are classified as waiting and those who are classified as searching. It's pretty similar. In both cases, the median duration of unemployment has gone from less than 4 weeks pre-COVID to 18 weeks in August. In other words, the median person on temporary layoff in August first became unemployed as part of that huge separation surge in April. Now remember, GKLN account for duration dependence among those who are temporary layoff and searching, but they don't account for it for those who are on temporary layoff and waiting. And the right panel shows a counterpart to the picture Matt showed of the duration hazard for those who are on temporary layoff and searching. I show the temporary layoff and waiting. You can see that there's a similar declining duration hazard. And I plotted this both for the full sample going back to 1994, as well as just the most recent COVID July to August transitions. If anything, the red dots are below the blue dots, suggesting that the duration hazard has been more important and the gradient steeper in the COVID recession than historically. Okay. And so, again, to emphasize, this is not going to enter into their forecast of what happens to the recall rate going forward. And I think, for a paper that really shines in its attention to duration dependence among the unemployed, this is a potentially important lacuna. And accounting for it would suggest that the overall reemployment rate from temporary layoff is likely to decline rather than rise in the coming months. Next, on separations. An extremely unusual feature of the COVID labor market has been the continued high rate of separations from employment into unemployment, despite the fact that the overall unemployment rate has been falling. So that's what I plot in the left panel. The blue dots show that typically the EDU hazard, so the separation hazard, is lower when unemployment is falling. The red dots show the COVID months. I'm ignoring April 2020 because that would be, somewhere over here. What we can clearly see is that separations have remained well above the historical norm despite the declines in unemployment. And this finding is echoed by the fact that we still have historically high UI claims every week, despite the fact that the unemployment rate has been coming down. So forecasts of the overall unemployment rate that are more pessimistic implicitly assume these high separations continue. This could come from aggregate forces, which I'm going to discuss next. History dependence may also contribute. So GKLN do not model history dependence among the employed. There's a recent literature on this topic, and it finds that those with recent spells of unemployment return to unemployment more quickly. Of course, the key question is whether this history dependence reflects true causality or selection. That also applies to the previous discussion of exit hazards from unemployment. We don't know, it's hotly debated. One thing John and I did in our paper was to estimate this history dependence separately by whether the unemployment spell was temporary or permanent layoff. And that's what I'm plotting on the right panel. Okay, so to do this, we look at separation hazards of respondents who are employed in their 7th CPS interview and conditioned by their employment status in the previous 6 interviews. And actually, a bit surprising to me, we found, if anything, larger history dependence if the spell was temporary. And this isn't just an artifact of seasonality. Okay. So you can clearly see this in the right panel. The exit hazard into unemployment is higher for those with more previous months of unemployment. And the red dots, which are the temporary, are above the blue dots. So incorporating yet another dimension of heterogeneity, which would be among the employed, might suggest that these high separation rates are likely to continue. Third, probably the most important driver of what happens to the labor market going forward is overall demand. And this is not a question this paper is particularly well suited to answer, since the driving forces, which are the recall rates, vacancies, new separations, all depend on the overall level of labor demand. Nonetheless, we can speculate. An optimistic scenario is simple. We get a fully functional vaccine quickly, or else some dramatic improvement in testing capacity or treatment. A pessimistic scenario might involve a new wave of infections as flu season ramps up and diminished policy support during the interregnum. How likely is such a scenario? If you haven't looked at these forecasts, they're a bit appalling. So this is the IMHE forecast. It's just one particular forecast, but it's one that a lot of people have looked at. And their baseline forecast is that COVID deaths start to rise again in the winter. They reach a new high in the US in December, and they only start to come down because new social distancing measures are imposed. Okay. So it's one forecast, but suggests that this renewed contraction in the economy is at least possible. Okay, so let me conclude by saying I found the paper to offer a very nice summary of the COVID labor market and a very useful forecasting exercise. It clarifies a number of things. I fully agree with their emphasis on temporary layoffs. I should mention, and Matt did too, there are some other papers that come to the same conclusion. Once you start to look at these data, the importance of temporary layoffs really hits you in the face. And I offered a few reasons to be a bit less sanguine about the path forward than their baseline forecast is.
Okay, thanks. Thanks. That was a terrific presentation and a very clear discussion. First comment would be Bob Hall, who has something queued up. Can we, Anna, can we unmute Bob?
He's coming in.
Okay.
Okay, Bob, you're
well, okay, finally. Okay, well, this is a great session. And there's a lot I agree with, especially, well, a lot I agree with, including Gabe's discussion. So I'm only going to talk about the things I disagree with. One is the paper omits one important branch of the evidence, which is from the employer side, the duration of a vacancy, which is something that can be gotten directly from the JOLTS survey, is an independent measure of labor market tightness according to DMP standard theory. And it took a hit initially, but it's completely back to normal. So it's an even stronger indication of the message that the part of the labor market that involves actual direct search is almost normal. It's job finding rates are down a little. Duration of vacancies not down at all. There's what I regard as unnecessary diversion is the discussion of trying to embed this issue in the beverage curve. So the beverage curve is not organic to DMP theory. It's not part of the model. It's only a way of displaying the data, but I think it's quite confusing. I've written about this elsewhere, I'll go on. One thing that concerns me deeply is the vocabulary that's used in this paper. Just trying to distinguish these two kinds of unemployment, which we all agree on, a very important distinction. Calling it temporary and permanent unemployment is completely wrong and confusing. And I would ask for a change in that. And my paper, which has been cited with Mariana Kudliak, introduces a different vocabulary, which I think is much better. All unemployment is temporary. No unemployment is permanent. So to distinguish these two types by temporary and permanent is just wrong. I convened a little panel of experts in this area, and we after turning over many ideas, currently we're calling this recall in unemployment and jobless unemployment, and that captures the key distinction. And I have no intellectual property rights on those names, or the names could be different, but temporary permanent is just wrong, and really needs to be changed. I'll leave it at that. The rest of it, I think, is, my general feeling about the paper is quite positive, but you must change the title.
Well, I've heard the terms short-term and long-term before. Steve Davis.
Thanks. Two comments. First, I want to endorse the view, and Bob just did it in one way, but in general, the labor market's a lot tighter than it appears from the headline. I like Bob's focus on the vacancy rate. I do think that a vacancy duration that comes directly out of the DMP perspective, but there's lots of other evidence, some of which was cited in the paper. But then I want to draw attention to another thing that I think, which I see as a pretty big elephant that was ignored in the discussion, and which has potentially important implications for the future path of unemployment. So if you look at monthly flows from employment to out of the labor force, there were an extra 6 million people who transitioned from employment to out of the labor force in April and May of this year, compared to, kind of looking at the baseline. To put that number in perspective, that number is 5 times larger, actually more than 5 times larger than the run-up in the measured number of people who are on permanent layoff unemployment in the CPS from February to July. So it's a huge deal. And the last point to make, just in way of context, is nothing like this happened in the Great Recession. In the Great Recession, and historically, I don't think anything like that has happened in any post-war U.S. recession. So this is a very different phenomenon. Its magnitude is huge, and we need to think about what it means for unemployment going forward. So the obvious concern is what will happen when these folks, if they do flow back into the labor force and start looking for jobs again. Will they follow dynamics more like the people who expect to be recalled according to the CPS, or will they look more like the let's call it the jobless unemployed, to adopt Bob's suggested terminology? Unless I missed it, that the analytical framework just totally ignores this issue. And but if I'm wrong, please correct me. But I certainly didn't see how that gets captured. And it seems to me a first order concern, not so much for what's happened thus far, but as we go forward and these people are drawn back into the labor force looking for jobs, what will it be like? What will that mean for labor market tightness? Thanks.
I'm sorry, thanks. Jason Furman.
Thank you. I had 2 questions for the authors or the discussant. The first was, this recession had a substantial supply shock component to it that changed the way we could produce things. As a result, we've seen a shift to all sorts of ways of doing things without humans and with less contact. To the degree that that's persistent, how would that affect your model? Certainly not something that's captured, historically. As you calibrate it, how real do you think it is? The second question is, I don't think you said anything about policy, unless I missed it. If you had unemployment insurance being $0 a week or $600 a week or somewhere in between, how would that affect what you're forecasting and how you think about it as well?
Okay, barring any other questions from the audience, we're back to the authors.
Thank you. Thanks, Gabe, for the great discussion. I will reply in order. So I think Gabe makes a very good point on duration dependence for the temporary unemployed who are waiting. That is something that we could try to incorporate into the model. What I have now is in appendix figures A53 and A54. If you go to that, you'll see that we have a scenario where the job finding rates of the temporary weighting fall by about a third. That's basically, I think, in the ballpark of what you'd see through the duration dependence. And you see that you do have a slower recovery, but it still is relatively optimistic compared to the forecasts. What seems to matter more is actually what happens with job separations rather than vacancies and the recall rate, assuming the recall rate doesn't crash all the way down to zero. As for Bob Hall's comment, we are not wedded to this terminology. We don't like it either. So we will think about using recall and jobless unemployment instead. For Steve Davis's comment, so we allow for transitions between employment and non-participation, as well as between non-participation and unemployment. We don't have micro foundations for what generates those, but it's part of the forecasts. So what we do have going on in the model is a big flow into non-participation. And what we're also seeing in the data are meaningful flows from non-participation into both temporary and permanent unemployment. That in turn leads to congestion. So that force is there. But of course, we're assuming that the people who flow from non-participation into unemployment are going to behave like the people who were in those states in the past. And I totally agree that that's important and there's more that we should do there. For Jason's comment on policy, we don't have a lot directly to say about policy at this point, except to the extent that UI policy is affecting, say, the decision of temporary unemployed workers to wait versus actively searching. That would be something that at least I think our team is pretty interested in studying in more detail. One hypothesis that I have, for example, is that one reason why so many temporary unemployed were willing to wait is perhaps because of the income support they had during the substantial extension of UI. I will turn it over to Gabe for the last word.
I will make two quick comments. On terminology, I never want to get into disagreements with Bob. I do think, as long as we're measuring this in a survey, the CPS, that has a term called temporary layoff, I don't see why we would want to adopt a different term from that. It seems like having two terms for the same thing might be more confusing, and they're pretty stuck to their terminology. Second, briefly to Jason's sort of question on the supply shock component. And I think one way to think about that is, there's always some churn. There may be more now, but one interpretation of the declining hazard rate for those, say, on temporary layoff is it's partly a selection effect, and you're finding the people who are in industries that just aren't going to come back. And so I think that interpretation of the declining hazard speaks a little bit to that aspect.
Okay, great. Thanks very much. We are going to, so we're going to end this session at 1:10. We have some breakout sessions for lunch. I am actually going to get my lunch and eat it in a breakout session. And I would encourage you to, if you're in a time zone for which that makes sense. If you are in the Zoom participant group, you should have just received a few minutes ago an email from Anna Dawson at Brookings that has the links. So the first session, the monetary actions and business dynamic ones, the papers that are relevant to that are the Hanson, Hubbard, and Greenwood session papers, epidemiology and the economy, that would be Arnon and Fernandez-Villaverdes, Fernandez-Villaverdes and Jones. And then the labor markets and fiscal policy, that'd be the Gallant, Auerbach, and Ilsecki papers. Okay, so see you in a few minutes. And if you're in the webinar version of this, then we'll see you back at 1:55 sharp.
I want to welcome everybody back from the lunch discussions. Judging from the one that I was in, it was interesting and lively, and covered both some of the topics we discussed this morning as well as previewed some of the afternoon papers. So for the session 3 this afternoon, we'll be looking at fiscal policy as well as some international aspects of the crisis. The first paper is Fiscal Effects of COVID-19. And it looks like Alan Auerbach is doing the presentation. So over to you.
Thank you very much, Jan. Actually, Louise and I will be sharing, I'll sharing the presentation. I'll be starting. This is trying to look at the fiscal impacts of COVID-19, and we're doing it in 2 pieces, hence the joint presentation. I'm going to be talking about the impact that we estimate that COVID-19 has had on the federal budget outlook over the next 10 and 30 years, sort of separate pieces. And then I'm going to turn it over to Louise to discuss what the short and medium term impact on the fiscal conditions on state and local governments is both in the aggregate and across states. So let me, in talking about the federal outlook, let me talk about our basic approach. We consider 3 separate baselines for fiscal policy. We look at a pre-COVID baseline based on current law, a post-COVID baseline based on current law, and then a post-COVID policy baseline based on what we call current policy. So the reason for these 3 baselines is that we want to answer different questions. Comparing the first and the second gives us an impact of the COVID shock itself. And that's not just the direct impact of the decline in economic activity, but also the policy responses. So the all-in fiscal effect of the shock, taking into account government responses. And for this, we're fortunate to have estimates by CBO that were produced in January, just before the shock, and in September, very recently, which more or less encompasses the shock so far, as well as projections for what will happen in the future. That data from CBO, or the projections from CBO, also go through 2050. We start with that, but then we make a series of small adjustments to what CBO has produced. The third baseline, that is the policy baseline, is intended as a more realistic measure of what we actually are. By convention, when CBO does projections, they do it based on current law, except in cases where current law doesn't give you enough information. But very often current law includes a lot of expiring provisions and other things that typically are extended, and it's very difficult to know exactly where to draw the line, but we include a variety of extensions in what we think current policy trajectory actually is. So let me turn quickly to the key results for the federal section of the paper. First, the COVID shock in the short run is enormous. Non-interest spending is up 11% of GDP in fiscal year 2020. A little bit of that is due to the decline in GDP, but most of it's due to the increase in spending. Revenues are down 0.5% of GDP, and of course they're down more because GDP is down. The primary deficit, taking account of where it was projected to be before, is now projected to be over 14% of GDP in the fiscal year, current fiscal year, which ends at the end very soon, at the end of September. According to the projections, the impact on primary deficits is expected to dissipate rather quickly, certainly compared to, say, the last recession. By fiscal year 2022, so 2 years, basically 2 years from now, the primary deficit is projected to be up only 2%, rather than over 11% of GDP. But even so, even with this fairly concentrated recessionary impact on primary deficits, the magnitude of the short run increase is so large that it still gives us a very high debt to GDP ratio. So that in 2 years, we would be at a debt to GDP ratio of 106%, and versus 184%, which was projected in January. That 106% is where we were in 1946 at the end of World War II, but of course the future looks very different now than it did then. Projected interest rates were low in January, and at least in the next several years are projected to be substantially lower, the relevant interest rates on the national debt. There's a comparison of the current law and the pre-COVID baseline from CBO. And you can see that they're projecting interest rates that'll be substantially lower through the early 2030s, and then actually a little bit higher thereafter because of the high debt level leading, by their estimate, to crowding out. And as a result of these lower interest rates, there's a surprisingly small impact if you go out to 2050 under current law on the terminal debt to GDP ratio. By our estimate, 190%. That's slightly different from what CBO is projecting, versus 180% which is what the projection was in January. And that, given the size of the short-term shock and the much higher debt to GDP ratio in the short run, that is perhaps surprising without thinking about the interest rates. But of course, given this level of debt relative to GDP, the interest rates are pretty important. On the other hand, under current policy, and I should say that our estimate are what we add to the budget under current policy is pretty conservative. And I'll come back to that at the end. The debt accumulation is higher. So here you can see the projection of these three baselines starting in 2020. And what you see is that in the short term, you just have this big jump in the debt to GDP ratio, but then this dashed line converges toward the original projection in January because of lower interest rates. On the other hand, under current policy, it takes off and it gets up to 222% by the end of the period. Well, and finally, in terms of what will these projections mean, they may be pessimistic in some respects. For example, since CBO came out with its economic forecast this summer, the 2020 recovery looks better than it did then. But there's a lot on the other side. Interest rates might pick up faster. There might be much slower growth even after the recession, as was true during the global financial crisis. That is, CBO may be underestimating the long-run productivity shock of the recession. And finally, our policy changes, the ones we add to the estimates, are, as I said, quite conservative. And one can imagine many changes in policy beyond that, and they pretty much all go in one direction. So with that, I'll turn it over to Louise.
Okay, do you see my slides? Great. Okay, so thanks, Alan. So yeah, now I'm going to turn to the fiscal outlook of the state and local sector. So the big difference between the state and local sector and the federal government is that state and locals are subject to balanced budget requirements. Now, the stringency of balanced budget requirements does vary across the states, but by and large, we can think that revenue losses must be offset by spending cuts or tax increases in relatively short order. So these are obviously a drag on the economy, impeding the economic recovery, and they also make it hard to provide essential services. There is a wide range of projected state and local revenue losses in the literature over the next 2 years. They vary from 130 billion to 875 billion. Now, to some extent, those vary because of different economic assumptions, differences in whether talking about income taxes or income and sales taxes or a wider array of taxes, and the methodology. But still, most of those estimates are from historical relationships between macro variables and tax collections, like a regression of the change in the unemployment rate on change in tax collection. But this recession is really different. First of all, unemployment is unusually concentrated among low-income workers. That means for any given level of unemployment, the wage losses and hence the revenue losses are lower. Second, a lot of the aid that we just heard about in terms of the federal aid has been in taxable forms. So not all states, but many states do tax unemployment insurance. So that extra $600 a week was also sort of shoring up taxable income for states. And PPP, which we'll hear about more later, but to the extent that PPP didn't increase employment, if it did increase employment, it's in our unemployment statistics, but to the extent it just went to firms that would otherwise have kept going, it's going to shore up profits, which will also shore up taxes. On the other hand, there's really very different consumption patterns. Consumption fell really sharply in some areas, not because of insufficient demand, but because of social distancing. That has implications for sales taxes and fees. And importantly, so far at least, there's been no stock market downturn. Of course, there was a huge downturn, but that recovered swiftly. So if this holds, that means that capital gains revenues are going to hold up. So we think that rather than looking to the past, we would do something what we call our bottom-up approach. And what that basically means is we're trying to calculate what's going to happen to each tax base and then directly calculate the taxes that should come from that. We use data from Opportunity Insights, among other sources, which track state by state, consumption by category. That means like consumption at grocery stores, hotels, restaurants, stuff like that. And employment by wage group. They have the lowest quartile, the middle two quartiles, and the high income quartile, which will give us some pretty decent estimates of the distributional impacts across states of the unemployment. We extend these data using CBO economic projections for the degree of social distancing, unemployment, wages, and consumption. What I mean by degree of social distancing, some of the consumption items that fell really, really sharply, we think are not related to sort of overall consumption, but to social distancing. In CBO's projection, they have that basically sort of phase out by the middle of next year. We do the same with our tax base, and basically end up being more like a typical recession rather than something special. So what do we do? So for income shocks, we basically are creating a small micro simulation. We take the CPS, we run it through the NBR's tax sim to calculate pre-COVID tax liabilities, and then we shock it with our unemployment and the lower wages and capital income in CBO's projection. We compute unemployment insurance for each state, taking account of the extra $600 and the duration of unemployment and how many people would have gotten that, and feed it again through tax sim to calculate post-COVID tax liabilities. For sales taxes and other taxes and fees, we basically look at the data on consumption so far and extended by CBO, look at each state's rules for what's taxed and what isn't taxed and their sales tax or their fees, and compute the actual tax collections and how much they're going to fall. And then we also account for federal aid to state and local governments. Okay, so this is a summary of our results for the nation as a whole. We are, in everything I show you today, excluding higher ed and hospitals. The paper has them. We think they're sort of different and separable, which we explain in the paper. But for now, I'm going to show you excluding higher ed and public hospitals. So our projected declines in revenues are $155 billion this year, $167 billion next year, $145 billion in 2022. You can see that these don't decline very much over time. That comes from our taking on the CBO projection, and Doug will have more to say about that, so I'll leave it to him. If we look at the components, you can see the personal income tax revenues declined $22 billion this year, $37 next year. That's a lot smaller than what many people would have expected. On the other hand, if you look at the sales tax revenues and the other taxes and fees, those are quite large. One of the things that we found was interesting is if you look at other taxes and fees and look at what is related to transportation, that's tolls, gas tax, airport fees. We lose $45 billion in 2020 related to transportation alone. We have a line in this table called additional demands on spending, and we have no numbers for it, but we wanted to put it on there to make clear that you need to think about that. So you can think about revenues, but spending is also different this recession, and we need to know what that might be to understand what kind of fiscal stress. I'll return to that. Then we have state aid. So state aid amounts to $212 billion this year, 19 next year, 9 the year after. Most of that aid is coming from the Coronavirus Relief Fund, which is $150 billion. We have K through 12 and transit aid. And then what we have for Medicaid is basically our estimate of the difference between the higher Medicaid funding coming from a higher match, less the higher Medicaid spending that states should be expected to spend because of the recession, because of unemployment. So are these numbers crazy? We think not. So here we have recent data collected by the Urban Institute. This is from 41 states of tax collections thus far for the three big categories: personal income, corporate income, and general sales. If you look in April and the spring in general, you see these collections plummeted. And there were a lot of stories in the media about how collections had plummeted. That turns out to be mostly because of timing. There were a lot of delays. So when the federal government delayed their April 15th, that the states took it on. There was also delays in estimated payments. So there were a lot of delays that the states took on, the federal government had done, and those were mostly made up, or they were made up by July. So if you look at July, that's giving you a better read. And if you look at July, you can see that personal income and general sales taxes are about 4 or 5% below last year, and the corporate is about 10. So the corporate's bigger than ours, the sales is smaller, but it's really very similar. You see, these are moderate declines. They're not nothing. And remember, this is relative to last year, not relative to a pre-COVID baseline. Our numbers are relative to a pre-COVID baseline. But so they're moderate numbers, but they're not the huge numbers that some people have talked about. Now, we do this state by state and tax base by tax base, and all of that detail is in the table. And you can see that the overall revenue losses vary tremendously across the states. So the states with the largest declines have between 6.5% to 10%. You know, some of these numbers look familiar to what we saw this morning about sort of the activity that you've seen. So they're related to what's happened to activity in the state, as well as some other things. So Nevada, Washington, California, Florida, New York. The states with the smallest declines: Wyoming, Mississippi, New Hampshire, and Kansas. This is declines in general revenue, own source revenues. The federal aid also varies tremendously, and you can see that states with the most aid are the small states, and the states with the least aid are some of the ones I just mentioned as having the biggest revenue losses. Why the states with the most aid, these small states? Because that $150 billion coronavirus fund specified that at a minimum states should get $1.25 billion. And so that was a lot of money for these smaller states. And so you can see that they basically got grants of 15 to 22% of their general revenue, so very large grants. Okay, so really to wrap it up in a much about how we should think about this to measure fiscal stress. So federal aid enacted to date does cover revenue losses this year, but not next year or thereafter. And knowing this, states will likely cut back on spending. Furthermore, aid is much more generous relative to needs in smaller states, leaving some states facing shortfalls even without accounting for future years or spending needs. Now, from a macroeconomic perspective, maintaining spending means the sector is not a drag on the economy. So that's a reasonable thing to look at from a macro perspective. But we think from a public service perspective, the ability to maintain pre-COVID spending is not the right metric for measuring fiscal stress. So if spending needs go up significantly for public health, virtual schooling, remedial schooling after the social distancing is over, then states will be under stress and have to cut necessary services. The state and local government seeing fiscal stress in coming years without additional aid may not be willing to spend adequately. So you can't really look at what states are spending to say, well, they don't need any money because they're not spending any money, right? So one of the reasons we don't give a bottom line of like, this is the measure of fiscal stress is we don't know enough about those spending needs. But we hope we have presented enough sort of pieces of information that can contribute to that discussion. So thank you very much.
Thanks, Louise. And Alan, that was really informative. We'll have comments now from Doug Holtz-Eakin.
Thanks, Jan. I want to thank, Alan, Bill, Byron, and Louise for providing two outstanding papers, both of which are extremely detailed, very careful, exhaustive looks at the fiscal conditions at the federal and at the state level. They're also incredibly timely for policymakers. And it's not out from the case that you get the combination of detail and excellent empirical work with the timeliness. So I think they really are to be congratulated. As Alan said, they look at these three different baselines, before and after on current law, and then the current policy baseline, to try to get the answer to two questions. What is the fiscal outlook, and how much did COVID-19 change the fiscal outlook? The short version of this is exactly as he said. The outlook is bad. Over the next 10 years, we saw this sharp swelling of the near-term deficit due to the response in the CARES Act in particular. Primary deficit over 14% of GDP. We go past the levels of debt relative to GDP that we experienced in World War II. And all of that sort of begins to snowball as you go forward, so that you see the primary deficits rise toward the end of the 30-year projection to a little under 5% of GDP, but you see the interest costs exceed 7% of GDP, even with the low interest rates that Alan mentioned. So as you go forward, they get the debt to GDP ratio rising to 190% of GDP. All of that is unsustainable. It's continuing to rise even at the end of the projection period. If you then turn to the issue of a current policy baseline, I just want to emphasize what Alan said sort of quietly, which is they've taken a fairly conservative view of what constitutes extending current provisions that would increase the deficit. My own view is that the current policy of the Congress is to only pass laws that expand the deficit and raise the debt. And so the current policy baseline is essentially unbounded. We have no idea if they continue current behavior, how large it could get. Now, the second part of the question is, how much of this do you get to blame on COVID-19? And I think the paper really has two really important results that just jump out to me, at least. The first is essentially the fact that the Congress reacted in an appropriately large fashion to the shock in the second quarter and ballooned the deficit. But it didn't do what Rahm Emanuel would have encouraged them to do, which is to take advantage of this emergency to do things that they want to do on a permanent basis. It's a genuinely transitory impact on the federal budget, gone within 3 years, with both spending and revenues returning to baseline. Now, they may yet pass more legislation, we'll see, but I think that's actually a really remarkable result and something worth highlighting. The second is this is a huge demonstration in the power of lower interest rates. Alan showed you that chart about how CBO lowered its interest rate projections. It has an enormous impact on the outlook. Over the first 10 years, the interest rate reductions offset the cost of the CARES package. They're just as big a response from COVID-19 as was the policy response. And I think that's a really important point to take away. The paper sheds light on two very important policy issues that are intimately related. Alan didn't talk about their measures of fiscal gap, which are how much do you have to change the primary deficit now and in every year to hit a debt to GDP target in some future year, say 2050. They demonstrate these. They're very large fiscal changes necessary to hit these debt to GDP targets, say 100% or something like that. And so they are a good way to parameterize the cost of delay, the cost of doing nothing, because that fiscal gap measure goes up the longer you wait to hit any particular debt to GDP target. And we're going to have a serious discussion about at what level the US will stabilize the federal debt relative to GDP. In the 21st century, it has not stabilized the debt relative to GDP, and a minimum condition for a sovereign nation is to be able to do that. And we're going to find out that doing that is hard work. And the paper lays that out, I think, very, very clearly. In a related fashion, the more you wait and the larger the debt gets, the more sensitive this entire exercise is to the interest rates that are in there. And so the U.S. federal budget is now extremely sensitive to interest rate fluctuations. And if you're at all risk averse about how that outlook will turn out, you might want to stabilize the debt at a lower level to reduce that interest sensitivity. But on the whole, I would love to have some horrible Achilles heel to this analysis that I could point out and tell you don't bother to read it, but you should read every page. It's a fantastic paper and very timely to boot. Let me turn to the state and local piece that Louise walked through. I think this is also a great read, and here's why. I thought they did a great job of sort of identifying how different this economic downturn has been from previous 21st century financial bubbles wreck the real economy or 21st century industrial style inventory recessions. This is a different phenomenon. Its dynamics are very different. Its impact on tax bases as a result can't help but be different, and they really do lay that out. They also do some very simple empirical work that sort of teaches you, yeah, you really don't want to just extrapolate from past history, and instead you ought to buy into the bottoms-up approach that they have. I thought that was all entirely convincing. The bottoms-up approach is exhaustive. The large microsim model that they put together is incredibly impressive. To do that on a state-by-state basis, I just congratulate them. It's an enormous amount of work. The care with which they do the sort of exercise of figuring out where the $600 went, for how long it went, how long was your spell, where are you in the income distribution, since the progressivity of income taxes differs. I think they should be applauded for it. It really does give them a tool that they're going to be able to use for a long time to come, past COVID-19. This is a fantastic exercise. Comparable effort on the sales tax front. As Louise mentioned, I did want to sort of just highlight something, and that the highlighting is that they rely on the CBO's before January and after July economic projections to give them their measure of the shock that comes from COVID-19. So in the income tax, the primary shock is to the unemployment rate. And, in simple terms, you get more unemployment, those people don't get wages, there's no wages to tax. And so it feeds into their personal income tax microsim. Theirs is much more elaborate, but at the base of it is the sort of nature of the shock. And the thing I want to highlight is that if you just look at before and after, CBO predicted that unemployment would get very high, above 10%, and stay up for quite a while. That's the blue line on the left at the top. In fact, it's so high that even right now it looks like a preposterously large shock, and the authors don't want to use it. And I think they're right about that. So what they did is the orange line. They just sort of took where we are, extended it out till it hit the CBO projections, and then followed the path out for the remainder of their forecast interval out to the end of 2022. I just want to highlight that essentially bakes in very little labor market improvement through the middle of 2021, and then the slow improvement thereafter. And it struck me that you could use the same CBO data and get a different one by just simply saying, okay, we know if you get the unemployment rate to somewhere around the shock to somewhere around 5, then it's going to go forward in a particular way and just sort of shift the whole thing over to the left, and it would give you smaller shocks during every quarter essentially, and would make these smaller. I'm not arguing that I'm right. I'm almost never right. I'm just saying that it seems to me that it could be quite sensitive to what you think about these paths, and given enough time, and they would need a lot more time, you could do some sensitivity analysis to see just how much my concern matters. It might not turn out to be that big a deal. There's a comparable issue going on in the shock to personal consumption expenditures. So nominal PCE is the underlying shock that would drive lower sales tax receipts, and also because of their structure, many of the fees that they estimate, these turned out to be the big tickets in their estimates. And so I just, I got curious. I thought I should just see what this thing looks like. The top line was the January projection for PCE. The bottom line's the July, and the shock never goes away. And so these are over the forecast period, right? So there's a feeling in my gut that these are sort of upper bound kind of estimates because of the lack of improvement that's in the underlying CBO. I do think it was a sensible choice to go to an independent third party for measures of the shocks. I endorse that, but it does give you this result. So it's worth knowing that's underneath these estimates. Things I'd close with, the underlying state-by-state heterogeneity is enormous. If you see it in the revenues, probably driven a lot by whether you were heavily reliant on tourism to collect a lot of those taxes. If you look at those states, those are tourism states. So travel, hospitality, leisure, taking a big hit, they're going to get hurt. And for those small states getting a lot of money, that's called the U.S. Senate, and everybody gets 2 senators, and that's life. But it does mean that the fiscal stresses are going to be very different across these states, and that's important. The one thing that I'll just flag, it gets into the imponderables that Louise closed with about what is the real fiscal stress. If you really have a world that looks like that CBO PCE chart, where you're just never going to go back to what the world looked like in January of 2020, do you want to permanently prop it up, or do you want to say to the states, you know, it's a new world and you need to recalibrate your fiscal structure for this new world, and we can't be reliant on filling in that hole at the federal level. And that's not answerable by the paper, but it sure provides a lot of information about how you want to think about the kinds of dollars that are in play in sort of resolving what we do going forward. So I'm just going to close there, emphasize again that I think these are really well done papers. The broader audience will not know the ridiculous timetables on which they were actually done. So I congratulate the authors for doing that without killing each other. So that was great. And I'll turn it back to you, Jen.
Okay, thanks, Doug. And thanks to Alan and Louise for the presentation as well. Just to remind everyone, if you'd like to ask a question, you can put your hand up in the attendee list, or if you can put a question into chat or into the Q&A. So we have some hands up already. I'm going to start with Alan Blinder, followed by Olivier Blanchard.
Okay, did I unmute myself?
You did.
Okay, in addition to congratulating Louise and Alan, as Doug did, for this incredibly useful, I mean, not all work is useful. This is very useful stuff. I have a sort of semi-specific question, which is this. If you're starting to forecast the near-term economy, I'm not going after 2050, the course of the pandemic is going to be critical, a critical input. So I'd like you, if you just say a word or two about what that, what the CBO assumed in the near term and whether that's reasonable. But more pointedly, picking up on what Doug said, for Louise, one thing we have seen very dramatically is the course of the pandemic has varied enormously state by state, really enormous. I show this to my students in lecture. It's really quite incredible. The curve for New York looks like the mirror image of the curve for Florida, for example, like they were other ends of the world. And what are you assuming about that, or can you take that into account? Thank you.
Okay, Olivia?
I was struck by an apparent tension between the numbers that Alan gave and Louise gave. I mean, Alan said, if I got it right, that we would be down to 2% deviation for the deficit at the end of fiscal year 2020. And Louise showed three numbers for the decline in revenues, for 2020, 2021, and 2022, which were more or less constant. And there seems to be a tension there. Maybe it's because in 2020, there's a lot of federal subsidies to the states or something, but we need to clarify. In one case, it looks like we're going back to something fairly good. In the other case, it looks like it's forever. So I may be missing something, but if you can clarify, it would be great. Thank you.
Okay, and the next question from Bob Gordon.
Can you hear me now?
Yeah, we can hear you now. You should be unmuted.
Okay. I wanted to call attention to an issue that has to do with the state and local governments. If you look at personal consumption expenditures as a leading indicator of tax revenue, in July, PCE was only 5% below February. And that looks like the problem is fairly minor and is soon to go away. But if you think about mass transit, if you think about public transit, There are systems from the New York subway to the New York commuter railroads to the Chicago commuter railroads where business is down 75 to 80%. And this, of course, dries up revenue by an equivalent percent. So these are smoking time bombs in terms of who is going to bail out the nation's public transit. And I would urge the authors to make a special, at least short section on this additional problem and whether they consider this part of the state and local deficit issue.
Okay, and we have a question in Q&A from Mark Mazer that is asking about the data on federal revenues. So this is a question for the federal side of the House, focused to Ellen Auerbach. So says that the figure that you showed that has federal revenues dropping by 0.5% seems like a small change, but Mark wants to compare that instead of to the previous year, compare it to expected revenues. So that expected revenues were increased to, or expected to increase by 4%. So he thinks, we should be thinking of that as a larger drop in revenues than what your data said. So I know you answered that in the chat, but it seems like a question for the larger group. Okay. Why don't you answer some of these questions that we have so far? They're pretty detailed, and if we have more questions, we might have a little time to go back.
Okay, let me go first. In answer to a comment Doug made about it being unfortunate that we didn't take Rahm Emanuel's advice and take advantage of the crisis, I think if we had done so, it would have gone in the other direction. I assume you were thinking about some sort of restructuring of entitlement programs or something like that, or maybe tax reform or something that would have closed the longer term primary deficits. But if I think about what kind of a push would have been coming from the crisis, it would have been for much stronger social safety net spending. And not just in the short run, which is what we had, but in the longer run. Because of a perception that these programs like Social Security, Medicare, and Medicaid, which were already popular, would be even more popular in light of the kind of shock that we've had. So I think in a sense, it's probably a good thing that we kept the response to the short run.
I wasn't clear. I agree with you.
And just in Mark Mazer's point, yeah, I mentioned in passing that the denominator went down, and so both the increase in spending and the reduction in revenues relative to GDP weren't measured exactly right. But it's still true that in fact, the decline in revenues is probably smaller, as Louise mentioned, at the state level. The decline in revenues is probably smaller than we would have expected given the increase in the unemployment rate, because the composition of job losses is different in this recession than in other ones. So it's still true that compared to other recessions, the changes are much bigger on the spending side than on the revenue side, certainly in absolute terms and also relative to the past recession.
Let me just add one thing quickly about Alan Palander's point about the course of the pandemic. We have some sensitivity analysis in the paper. I'm always surprised at how little variations in the growth rate affect future deficit. And the reason they have relatively small effects is that if the growth rate goes down, the interest rate goes down, and so you save on net interest payments. In contrast, the budget outlook is very sensitive to the level of the interest rate. So the course of the pandemic definitely, the uncertainty definitely has an impact on certainty of the budget outlook, but most of it comes from the level of interest rates rather than the level of output.
Louise, did you want to respond to any questions about the state and local, or Byron?
Byron's going to respond.
Yeah, I'll take it first, and I can pass it off to Louise. First, I just want to say a major thanks to Doug for the very kind and generous comments. I'll respond to his major concern with the state and local section of the paper, which is that the CBO projection, the economic projection on which we're pinned to, is too pessimistic. The bottom line here is I think we agree. There are very good reasons to use the CBO projection. It's the gold standard. It's very detailed and granular. And as a good part of the aim of the state and local portion of the paper was to develop this bottom-up methodology, the granularity helps. It's also the case, I would note, that although the CBO projection has kind of gone off the rails quickly in the near term, over the broad 3 years that we use it for the state and local portion of the paper, that could well prove to be more accurate. For instance, a second wave scenario might generate that. But again, we very much agree with Doug. The CBO projection currently is well outside the sort of consensus of most private sector forecasters. And the first order of business for the paper is some sensitivity analysis. And the first item there is to, use something closer to the private sector consensus right now. So thank you for that. We'll do that. I'll just mention in response to Alan Blinder's comment about the course of the pandemic, the CBO does have very specific assumptions about that in terms of its effect on social distancing. They have it gradually abating away and totally being gone by the second half of 2021. And for many of the state and local estimates, we've pinned to that very precisely. So for things like transportation spending, motor fuel taxes, and so forth, we're pinned to those CBO assumptions pretty tightly. I'll pivot from there to what I think it was Bob Gordon's comment about the transit authorities. The transit authorities are indeed in many places have suffered just historic collapses in their revenue. We're doing everything at the state level combined for state and local governments together. We do capture these collapses. In fact, one of the most surprising thing about our results is if you look at the other taxes and fees, which are usually not a focus of analysis in terms of cyclicality of the state and local sector, those declines have been massive. And that's almost wholly driven by the decline in transportation activity. And the biggest place you see there are some of the transit authorities. So we could emphasize that more because the comment that was made very much does line up with what the results in the paper. I'll leave it at that unless Louise would like to say anything further.
I have a few comments. So going back to this idea of the transit and the variation across the state, I just want to emphasize that we start with data through August or September about actual consumption and actual vehicle miles driven. And so we start with the very big differences across the state and then just have sort of the shocks kind of like go down as social distancing goes down so that so New York is definitely hit more, much more, and we capture that. So the only thing we're using CBO is to get back from where we start to sort of where we end. Number one. Number two, this will also address Olivier's point. So one of the things we do is we're using nominals. So CBO has lowered inflation a lot. So although nominal consumption never gets back, real consumption, real GDP do, but nominals never do because we just have this 2 years of really, really low inflation. So you might think that in some sense our numbers again are an overestimate if you think the price level of the things that state and local governments are buying would also go down, and therefore you really kind of want to look at the reals. And we first started with the reals and then I went to the nominals. I wasn't sure which way to do it, but that really is a very big difference, and that's part of the reason. So when Olivia noticed that difference, ours are nominal dollars, and Alan's is relative to GDP. So first of all, GDP is lower, but nominal GDP is so that gets rid of the nominal issue once you divide by something. That's part of it.
I think we have 2 minutes at the end here, and Martin Bailey was waiting to ask a question. Martin, are you still there? Or did your question get answered?
I wasn't sure there was any time. Since we've got 2 minutes,
I have 2 minutes. Yeah, go ahead.
Quick. So during the Great Recession, I was on a panel with Doug, and somebody in the audience asked the question, was there any concern about whether foreigners would be willing to continue to buy US debt? And Doug responded that we were the favorite horse in the glue factory. Which is a line that I've used myself on subsequent occasions. So my question is, did you sort of look at to what extent? I mean, it's fashionable these days to say, that not exactly that debt doesn't, or deficits don't matter, but they don't, as long as interest rates stay low. But there could potentially be an unstable cycle where we were not able to finance as easily the deficits over such a long period, and interest rates start to rise. So I wondered if you had examined the other international side of it. Who is providing all this money? Is that a blessing as it keeps the world economy going, or at some point are we going to run into a constraint?
For raising that. 1 minute for the lightning round. Who wants to take on that question?
I'll say something about that. In the early 2000s, foreigners bought a fairly large share of incremental debt. The last decade, they bought a much lower share, and it's been mainly purchased by Americans. I don't foresee likelihood of a fiscal crisis or us being unable to finance our debt anytime in the horizon that we've looked at. If there's an issue, it's a political issue, not an economic issue.
All right, thanks very much, everybody. That was a really interesting session, great discussion, great paper. We're gonna flip over, so we'll turn over the panel to the next paper. And while we do that, we'll give Ethan a chance to share his slides here. And the next paper will focus on international issues. The title is Whether or Will the Secular Decline in Exchange Rate and Inflation Volatility Survive COVID-19? The presentation will be by Ethan Ilzetsky.
Thank you. Can you see my slides now?
We can, and we can hear you.
Okay, great. So thanks, Janice, for the invitation. This is joint work with Carmen Reinhardt and Ken Rogoff. And in previous work, we've shown that there has been a decline over the first two decades of the 21st century in the volatility of core global exchange rates. And when we first proposed this paper to Janice and Jim, we thought we'd be talking today about how this stability has collapsed. And in fact, it's shown remarkable resilience. So this paper instead will be talking about will be documenting this trend in exchange rate stability and the decline in exchange rate volatility, and take a first stab at trying to understand where it comes from and how it successfully survived the enormous volatility in the real economy and in other asset markets. So this first slide shows the absolute value of the month-on-month percent change in the US dollar euro exchange rate, where the euro is replaced by the German Deutschmark before 1999. So that was a mouthful, but to make it simple, this is simply an indicator of exchange rate volatility for that exchange rate. And what we can see is that from 1975 till August 2020, there has been a secular decline in the degree of exchange rate volatility. But this figure shows two other more recent phenomena. One is that since around 2014, and I'll revisit that date later, we see a further sharp decline even relative to that secular trend. And second, US recessions are indicated in gray bars here, and you can see that in each US recession, exchange rate volatility goes up. During COVID-19, although this was the sharpest recession on record, we see no resurgence of exchange rate volatility. So that's the source of our surprise here. This figure shows the same facts for the US dollar yen exchange rate. Again, the trend decline in volatility, the further sharp decline in volatility since 2014, and the lack of volatility during COVID. These facts are even more striking when we compare the volatility in exchange rates to the volatility of other asset prices, so that this is not something about asset prices more generally, it's specifically about exchange rates. So this gives the euro versus dollar exchange rate volatility, this time compared to, relative to the volatility of the prices of other assets. So when we compare to oil prices or a basket of commodities or stock market valuations, we can see again the secular decline in exchange rate volatility in relative terms, an even more striking sharp decline in volatility since 2014, and an even further decline in volatility, in relative volatility during COVID-19, to the extent that March of this year was the lowest reading of exchange rate volatility relative to other asset prices. And in recent years, we've been seeing levels of relative volatility that are very similar to those seen in the 1960s when we had a system of fixed exchange rates under Bretton Woods. So you might think that the Chinese renminbi will buck this trend. And indeed, if you look at the green line here, that shows that same metric now for the US dollar renminbi exchange rate. And the renminbi had a hard peg to the dollar in the early 21st century, and that peg has been loosened over time. So not surprisingly, we do see an increase in dollar renminbi volatility. The less obvious fact is that that increase in renminbi dollar volatility has been matched roughly 1-to-1 with a decline in the volatility of the renminbi relative to other core exchange rate currencies, like here in blue shown the euro, but also the Japanese yen, which isn't shown on this figure. So when we look at the what we call the G4 currencies, the dollar, the yen, the euro, and the renminbi, that reflect more than 50% of world GDP, we have remarkable exchange rate stability at the core of the system, which has been showing a gradual decline in volatility and enormous resilience to COVID-19. The paper provides some of the more technical details. I won't get into them right here. I'll just point out that the trends I describe are statistically significant in panel regressions, and that when we try to date that break in 2014, we find that it's in August 2014, a date that I'll repeat later, using formal Bayen-Perron breakpoint tests. So just to summarize kind of the initial observations, we refer to the 21st century exchange rate system as the extended Bretton Woods II, extended because it encompasses a larger part of the globe than the original Bretton Woods system did. And we find that in the core currencies in the system, volatility has trended down, seen a further decline in 2014, and has been remarkably stable during COVID-19. So the obvious question is what has caused these trends? And our main hypothesis is that the decline in exchange rate volatility is a side effect of a decline in the variability of inflation across countries, and a decline in the variability of short and long-term interest rates across countries. So let me document those facts in the following slides. This first chart in red shows the median inflation rate for high-income countries since the Second World War, and it documents the very familiar fact that inflation rates have declined and are now at very low rates. The gray bars documents a slightly more subtle point, which is that also the variability, it shows the standard deviation of inflation across those same high-income countries, and it shows that the decline in the average rate of inflation has been matched with a decline in the variability of inflation across countries, to the point that, you know, in historical terms, there's essentially no inflation differentials across countries. Now, if you think about exchange rate determination through the lens of a purchasing power parity theory, if there's no changes in price levels across countries, there's no pressure on the exchange rate to adjust to restore parity in relative prices across countries. Now, purchasing power parity in the data holds only really in long terms, and even there the evidence is somewhat mixed. And so we don't think this is the main story of what's going on. Rather, we think that the declining interest rate differentials across countries, possibly as a consequence of those declining inflation differentials across countries, plays a more important role. So in the black line here, we see the standard deviation of the monetary policy interest rate across the central banks issuing the top 10 currencies in terms of trade volume. And we can see that in the global financial crisis, the variability of policy interest rates was very compressed substantially, but this has declined even further in the decade that followed the crisis, and collapsed even further during COVID-19, to the point that essentially now there's really no variability across policy interest rates across countries, because 9 out of 10 of these central banks are at 0 or negative rates. But these facts hold not only for short-term interest rates, they hold also for longer-term interest rate differentials. So this figure shows histogram, so the distribution of 10-year bond yields for high-income countries, and each of these lines shows a different time period. If we take the 50s and 60s of Bretton Woods as sort of a benchmark, we can see that in the 70s, there was a large increase in long-term interest rate variability across advanced economies that persisted well into the 90s. Now, as we enter the 21st century, there's a massive compression of long-term interest rate differentials in advanced economies, to the point, again, that when we arrive at the latest readings, we see essentially no differences in long-term yields across countries. And this is partially, of course, because many of these yields, 50% of these yields, half of these countries, have 0 or slightly negative 10-year yields. Now, if you'll recall that August 2014 date at which we've dated the downward break in volatility, that is roughly the time, June 2014, when the European Central Bank started experimenting with negative interest rates. And the following year saw core Eurozone bond yields and Japanese bond yields start hitting 0 and eventually even negative territory. So now if you think about exchange rate determination through the lens of an uncovered interest rate parity relationship, whereby exchange rates are adjusting to compensate for interest rate differentials in bonds of different currencies, then with no differentials in long-term interest rates and no expectation that interest rates will change, there is little scope for exchange rate volatility. So in the paper, we entertain a number of alternative hypotheses. I'm sure these will come up in the discussion later on, but I want to dwell for 1 minute on the implications of these findings for economic theory. So exchange rate models of the 1970s and 80s put monetary policy at the center of the discussion of exchange rate volatility, following Dornbusch's overshooting model. these have been notoriously difficult to verify empirically. And so the past decade or so has seen a move in economic theory to exchange rate models that focus on financial risks as driving exchange rate volatility. Now, we view COVID-19 as a sort of casual, but I think very powerful natural experiment where financial volatility and real volatility has been enormous, but there's been very little interest rate variability across countries. We've seen that exchange rate volatility is extremely muted in this period, which may be, which can be seen as lending support for the earlier vintage of theories of exchange that put monetary policy in the center. I want to spend my last minute or so on what could go wrong. So if the stability of Bretton Woods II has been undergirded by low inflation variability across countries, then the obvious risk to the stability of the international informal international monetary arrangement is a resurgence of inflation. And so we should recall that Bretton Woods, the Bretton Woods I, the original Bretton Woods, fell apart when inflation started to spike in the 1970s. So we should at least entertain the risk that inflation could cause a resurgence in volatility. We have to recall that alongside successes of monetary policy and monetary policy independence, the past couple of decades we've been riding with some very favorable backwinds of downward price pressures due to globalization and expansion of the effective labor force that may be coming to an end. And finally, I just want to end on a cautionary statement of not making false analogies to the global financial crisis. This figure shows the growth of monetary aggregates. During the global financial crisis that was deflationary, we did see that the massive quantitative easing of the time largely stayed on banks' balance sheets and didn't really translate into broader measures of money, of liquidity and credit. In contrast, in this cycle, QE has translated into a unprecedented increase in credit and liquidity growth. And so with this liquidity sloshing around, we view that as something we need to consider in the set of risks going forward. So we talk about some other risks in the paper, but I've run out of time. So let me just summarize that we document a secular decline in the volatility of major exchange rates in the 21st century that has accelerated since 2014. And our initial view on this is that it has been caused by a decline in the volatility and variability of inflation and interest rates across countries. Thanks.
Thank you, Ethan. Very clear and informative. Our comments and the discussion will come from Silvia Miranda Agrippino. Of her.
Oh, I have to stop sharing.
Hello? You're good, Ethan.
1 second. Yeah, let me just.
Ethan, I already did it.
Okay.
Okay, so can you all see my screen and hear my voice?
And we can hear you.
Great, thank you. So I want to start by thanking the organizers for inviting me to discuss this very insightful paper from which I learned a lot. And before I say anything, I actually want to stress that none of this is going to reflect in any way the official views of the Bank of England, but these are my very own personal views. So as you've just heard, this is a paper that really addresses a hugely important topic that is likely to stay with us for some time. And really the question that they're asking is whether the COVID shock was large and potent enough to actually threaten the stability of the international monetary and financial system the way we know it. And the way in which the authors build their argument is essentially in three steps. So first, they document that the FX volatility among the major currencies has been trending down, and that this trend accelerated in 2014 and then again with COVID. Then they argue that essentially this is the result of somewhat a paralysis of monetary policy, and in particular, as you've heard, of the fact that inflation rates, short-term rates, and particularly long-term rates have been trending down and converging. Now, of course, this poses a risk, because if you think that you know, the large effects of this COVID shock are going to be like a supply shock, then this will come with expectations of rising inflation, and then perhaps due to that, expectations of monetary policy divergence. So this could, you know, could threaten this apparent stability in exchange rates. So I was going to organize my comments around two main points. In the first, I want to offer perhaps a complementary view around the drivers of FX volatility over the past 20 years or so. And here my conclusions really are going to be that perhaps discarding risk cycles altogether may be a little bit of a risky strategy in this setting, because it risks leaving aside what is perhaps an important part of the story. And I would argue then that far from being affected by paralysis, monetary policy actually was very active in taming risk, particularly during the COVID crisis. In the second part of my discussion, I'm going to focus a little bit more on the past few months. And here I'm going to argue that while in many respects, the transmission of the COVID shock so far is not too different from any other previous recession in the US, one thing that I think is actually quite different is the fact that this time around, the US dollar is depreciating, and against a broad basket of currencies. And I'm not going to go so far as to identify the causes of this depreciation, but I would show you some charts that probably point towards more US specific reasons for this depreciation. And so perhaps, I mean, even if we remain in a low inflation, low interest rate world, there might be sort of shorter term risk to the stability of the international financial system nonetheless. So let me start by looking at the FX volatility dynamics at the core. And to do this, I'm going to actually step away a little bit from the longer term averages that are used in the paper. And I'm actually going to use data on estimated FX volatility that come from the volatility lab at NYU. So what I'm plotting here is the estimated FX volatility of bilateral exchange rates of the euro and the Japanese yen, both against the dollar. And these are in green and in red. Whereas the blue line on top is the Deutsche Bank currency VIX index, which is essentially the VIX, but very specific for currencies. And I think what stands out here is probably two main things. The first is that actually the past 10 years or so have not been exactly, at least according to this estimates, a low volatility regime. And in particular, that, as you can see here, the COVID episode was actually quite important. The second thing is that, in fact, this currency VIX tracks the low frequency movement in this time series actually quite well. And now, if you were to add to the chart the more famous VIX, which is the purple line, you'd see that, I mean, of course, there's a lot of noise in the daily data. There's an obvious difference in the scale here, but by and large, the correlation among the time profiles of this volatility indices is quite apparent. So in this sense, I would probably caution against discarding this explanation altogether. Now, of course, I mean, the fact that I think risk is important doesn't mean that domestic fundamentals are not important, or it doesn't mean that monetary policy is altogether irrelevant. And in fact, I would argue that the fact that the COVID episode wasn't as dramatic in terms of volatility of exchange rate, as dramatic and as long-lived as previous episodes, has to do with the fact that this time around central banks were actually ready, and they responded in a large and prompt way to the crisis through a variety of programs. There is some evidence already that some of these programs have been actually quite successful in easing conditions and in lowering risk levels, especially in debt markets, both public and corporate. But what I think is perhaps more relevant for this discussion is the fact that one of the programs was the reintroduction of swap lines. These were originally introduced during the global financial crisis. And as you can see here from the left-hand side, since their reintroduction in March, they've been used massively. And now, of course, I mean, we don't know enough about their effects on exchange rate, and by no means they've been introduced with the explicit aim of managing currencies. But one might argue that by effectively relaxing supply constraints in currency markets, they can have second round effects on exchange rates too. And as you can see here on the right hand side, I mean, this is very, very simple, but at least visually it looks like these are all bilateral exchange rates against the dollar. At least visually it looks like these markets were paying attention to the announcement. So in a sense, I mean, if you think of monetary policy as being sort of a broad set of tools, then it's not clear that there hasn't been that it was affected by either paralysis or inactivity, and that in fact these interventions may have played an important role. So in what way do I think that this crisis might in fact be a little bit different from what we're used to, if you can ever get used to a recession or a crisis? But so if you were to actually compare the way in which the COVID shock has transmitted so far, it looks like, in fact, the transmission, I mean, it was obviously a very large shock, but then it doesn't look like, at least so far, that the transmission has been any different than previous recessions. And so even if at the origin it's really a supply shock, it looks like the second round demand effects are actually dominating. And this is a view that seems to be shared also by professional forecasters. So for example, if you look here, I mean, we've heard before about the projections of the CBO, but if you look at the SPF as well, it looks like low inflation states are actually being attached somewhat higher ex-ante probability of realization, both in the shorter term in 2021, but also if you go all the way to extend the forecast horizon to 10 years. So at least, from this standpoint, it doesn't look like inflation risk might be that strong. And in a sense, even if you thought differently, the fact that the Fed is now operating under a different framework sort of arguably breaks the link between expectations of higher volatility, higher inflation, and expectations of a monetary policy tightening. So taking all this together, my sense is that perhaps inflation risk and risk of monetary policy divergence due to inflation might not be perhaps the primary source of concern. There is one thing that I would like to highlight, though, that I think is actually quite interesting, and is that contrary to previous recession episodes, this time around, the US dollar is actually depreciating quite markedly and against a broad basket of currencies. So you see it here, this is the dollar index. So you see it quite clearly here that after the rally in March, then the US dollar sort of lost ground against against the currencies that enter the index to quite low level. And of course, this is in large part, this is really a euro story. So if you look here at the bilateral exchange rate with the euro, you see this dramatic appreciation of the euro against the dollar, which has been occupying many headlines over the past couple of weeks, and perhaps many central bankers' thoughts. But really, this isn't just a euro story. So if you were to look at the bilateral exchange rate with the British pound, you would see that in fact the situation is actually quite similar. So the dollar is depreciating also against the British pound. And I would think that quite unlikely that markets aren't paying attention to the challenges related to the negotiation of the exit of the UK from the European Union and all the risks and that this comes with. So in a sense, this is even more striking because the British pound is appreciating against the dollar despite this very large UK specific risks. So in this sense, I think that perhaps the story behind this US dollar depreciation is really quite US specific. Of course, you could say maybe this is just completely temporary, maybe this is just due to some speculative positioning and we shouldn't make too much of it, which is fair, but perhaps there's equally some perhaps tiny but non-zero probability that this is actually signaling some sort of a shift in investors' appetite, perhaps away from US assets. So really, where does that leave us? Well, it leaves us, I think, in a world which is actually quite different from what we were used to. So typically during recessions, during times of crisis, we are used to think of the US as the world banker. I mean, this has been studied before, that typically what happens is that in times of crisis, you have the US dollar appreciating while other asset prices are losing value. This time around is actually quite the opposite. And we have stock markets which are trading at a record high. And on the other hand, the dollar is depreciating. So perhaps, I mean, it's too early to say whether this is anything to do with a loss in confidence. But I would argue that, perhaps even if the immediate risks do not come from inflation or accommodative monetary policy, which is probably gonna stay with us for some years, there might be others, and perhaps US specific. I mean, think geopolitical scenarios, think politics, which may threaten the stability of the system, even might nonetheless. So this is all I had. Thank you.
Thank you, Sylvia. It's very clear and really interesting. We have some questions from the audience. Let me start with Alan Blander.
All right, did I unmute myself?
You did.
Okay, that worked a different way than before. Very quickly, one is just an observation, a technical but simple observation, which is the basic explanation for the lower exchange rate volatility is the lower volatility of inflation and interest rates, which makes sense. But is it really true? And isn't it basically inevitable as the mean of a series goes down and down and down, which is true of the inflation and nominal interest rate series, the standard deviation, which is what you use, must go down and down and down. It would be wild if it didn't. And wouldn't it be more illuminating maybe to look at the coefficient of variation? I did my mental calculator on a few of the numbers you put up, but the mental calculator is not so accurate. It didn't look like the coefficient of variation of interest rates was changing very much. It was that the level and the standard deviation were both going down pari passu. So that was one. The second is maybe I could draw out, Carmen or Ken, I've been wondering, as Sylvia has, about why no flight to quality. The panic flight seems to be going not to the United States as it always does, and I don't know why, but I'm just wondering if anybody thinks they know why. Thank you.
Thanks, Alan. Why don't I give the authors a chance to respond to Sylvia's remarks and to answer Alan's question, and we'll see if we have any other questions from the audience.
Sure. I'm actually going to share my screen again. Can you see the exchange rate levels?
Yes.
Yeah. So I mean, on the issue of the dollar depreciation, that's correct. That's a correct fact, and I think it's an interesting question. Maybe I will let Carmen and Ken respond on their explanation for that. But I want to put this in a broader perspective. I mean, this is the level of the exchange rate as opposed to its volatility. And you can, with the naked eye, you can see the decline in volatility. I mean, look at the gyrations of the euro or the yen over the past few decades. And then you come to 2014 and this is flatlined. So, we're talking about this move compared to what's happening during the global financial crisis. It really is a very muted response. So, we have to put it in the perspective. I also think this speaks to the swap line point, which, we discussed swap lines. We think they may have been played an important role. But, recall that our facts are not only about COVID-19. What's happening here is something that starts before COVID-19, well after the swap lines of the previous crisis were gone, and well before the swap crisis of COVID-19, the swap lines of COVID-19 came into play. And so we think that the swap lines alone can't explain what's going on here, certainly not the break around 2014. I also wanted to just quickly sort of revisit this question of implied volatility that Sylvia brought up, which is this is the same currency VIX, implied volatility of currencies. And Sylvia emphasized the correct fact that this is very highly correlated with implied volatility of stocks. But what we emphasize is really the level of the volatility, right? So while the stock market shows one of the highest readings of volatility in 150 years, we see a little blip in currency volatility, but it's comparable to what happened around the unmemorable month of February 2016. I mean, it's really nothing to speak of. So we do think there is something to say that monetary policy stopped the volatility. We would have to explain something that's specific to currency risk as opposed to generalized risk, which swap lines fit that bill, but again doesn't explain why, say, January 2020 is the lowest period of implied volatility on record in in currencies. I'll pass it on to Carmen and Ken to take up some of the other points if they'd like.
I think I unmuted myself. If I can just answer briefly.
Very good.
First, thank you very much, Sylvia, for the excellent comments. We certainly wouldn't say central bank policy hasn't been doing a lot. We've been hearing that all day. But we draw a distinction between conventional monetary policy, interest rate policy, where I think of central banks as having independence, and stuff which really they're operating as an agent of the Treasury rather directly. We heard that this morning. And so, of course, these policies have a big effect. And I just could emphasize one other point. I think a big thing that's happened in COVID-19 is not just that central banks have hit the zero bound, but that markets basically view the neutral rate, equilibrium policy rate to be kind of significantly negative right now. And they just don't think it's ever going to go to zero. So it's not the exchange rate theories, the old Dornbush ones don't just depend on today's interest rates, but the whole future. And they just see it as gone. And we're emphasizing that point. Thank you.
I would like to connect something Sylvia put up in one of her slides and Alan's question, sort of working backwards on the conjecture part, on what follows. I was hoping, Sylvia, you'd say a little more about the modern day Triffin dilemma and what it would look like. I'll just make a comment on that. But Alan, I think the answer the honest answer to your question, I have no clue why the dollar's depreciated over the period. Currency cycles being difficult to predict. But on the bigger question, which is the era of dollar dominance, if you will, going to be changed by COVID, which I think connects to your question. Let me just quickly work backwards. One is, at the moment, major alternatives to the dollar are difficult to contemplate. There may be scope for the euro regaining ground if there's a unified debt market that grows, organically over time. Or there's the issue of lack of renminbi convertibility. We have seen more of a flight into gold, but the main issue remains that it's difficult at the moment to consider what that alternative may be. Although this goes back to the Triffin dilemma, we pointed out in our 2019 paper that, in the modern context, the outstanding debt in the US relative to the US share of global GDP, the global share of GDP has been declining for the US, not as rapidly as for Europe, but it's been declining, and particularly declining when you consider the increasing share of China. So there's the issue of whether the what could undermine the Bretton Woods II system it's related to the modern version of the Triffin dilemma. Going back to one of the reasons we also highlight that the decline is a secular one. In the past 12 years, I don't want to talk about central bank policy coordination. We really can't talk about coordination, but it so happens that I think first in the 2008-2009 crisis, and certainly during the COVID crisis, I think the synchronicity of policy changes in the major economies also have played an important role in the reduction, in the observed reduction, both secular and more pronounced over the near-term period of the major currency exchange rate volatility. Let me stop there.
I think we have a minute to take another question from the audience. Shebnem Kalimli-Ozkan had a question earlier. Want to go ahead?
Yes, so Ken and Sylvia partly touch upon this, but this is a beautiful paper and very insightful discussion. I would like to ask authors' conjecture in terms of the emerging markets. So not to the extent of high-income countries, of course, but emerging markets interest rate differentials were also going down, and their inflation volatility were going down sometime. So should we conjecture from this that their exchange volatility might go down? We didn't see this yet because I think it goes back to this intersection between financial risk and monetary policy. The difference between the emerging markets and high-income countries, emerging markets monetary policy, of course, responds to exchange rate volatility, where high-income countries don't do that. So maybe it is the essence of that monetary policy credibility and the confidence Sylvia is talking about when you use it as a tool to respond to exchange rate volatility. So I would like to get your thoughts on that.
Who wants to take that?
Shebnem, I think, we are in new territory on EM monetary policy. I mean, this is really the first time that we have seen counter-cyclical monetary policy in the EMs pretty much across the board. Actually, you know, what you typically see during bad times and during a crisis is a rise in the rates to defend the currency. I think I'm very leery, Shebnem also, but this also goes to Sylvia's point regarding what to expect on the inflation front. I'm very leery. I understand that over the very, the near future, the collapse in aggregate demand swamps everything. But I think that there are unknown supply shocks or lasting effects of supply shocks we still do not know. And I think, Shebnem, whether that comes out more imminently in emerging markets, that would be my expectation. So if you're going to see a turning point on the inflation side, I think you'd see it there first. But let me stop.
Great. So thanks to the authors for a really interesting paper and to Sylvia for a good discussion, and as well as the follow-up with the group Q&A. We'll take a break now for 5 minutes. We'll be back at 3:30 Eastern for the last session. Thanks a lot.
Well, welcome back to our final session. This afternoon, we have two papers. The first is on the Paycheck Protection Program. And the second is on corporate restructuring. So we're going to start off with Glenn Hubbard.
Okay, thanks, Jim. Mike and I are certainly grateful to the organizers for the chance to participate. I spent my morning teaching the MBAs in a political economy class. This morning was Hayek, and I could hear his voice saying, "What's a nice boy like you doing working on the Paycheck Protection Program?" And I think Mike and I will hope to have an idea for that as we go through. So let me try to share my screen with you. Okay, do you have it?
Well, we've got something that says Zoom on it.
That's not good.
Might be the wrong screen.
Let's see. Let's try that. No, it's not coming through.
That's looking good, and you could maximize it if you want.
Okay, great. All right, if you have it, I can't see it, but that's great. Okay, well, if you can see it, I'll just put it in slideshow and go from there. Yep. So the Paycheck Protection Program is obviously an interesting and relatively new and bold idea. And in taking a look at it, what Mike and I wanted to do was really get at the basic question of the title: did it succeed? And it turns out that is a much harder question to answer than one might think. Partly that's mechanical, the age of the program, but partly is the program's design. So the program, as everybody knows, is forgivable loans to small and mid-sized businesses. And it came in the context, obviously, of the very severe downturn accompanying COVID-19. The COVID-19 shock, of course, contained both supply side elements that shut down businesses in the lockdown and demand side because of credit constraints affecting many small and mid-sized firms and from losses in employment and business failures. So we look at heightened vulnerability of small and mid-sized firms, particularly because of worker-firm relationships that may be valuable and value of a time to restart for firms that fail. It's also a very large program for evaluation. In the 2008-9 crisis, the number 700 billion sent shockwaves through Washington. This program alone, as part of the CARES Act, will wind up costing that, and there's discussions of extension. We find, using Dun & Bradstreet data, that if you look at standard difference in difference models to estimate the effects of a small business applying for a PPP loan, we can only see them at a certain size that I'll mention, and of a small business being eligible for that loan based on size, we find higher employment, we find greater financial health, and we find survival. Nonetheless, Harry Truman's picture there, has it succeeded? On the one hand, yes. On the other hand, as we'll show you, it's a little bit harder to know. Now, the political process here moved very, very quickly. The original design work of the PPP did involve some economists. Both Mike and I had worked with some of the GOP congressional leaders. And again, the issue here is about balancing aggregate supply effects and aggregate demand effects. The general recommendation was for a revenue replacement program, which, as you know, is not precisely what happened in the PPP. The rationale, also in work by Eric Zwick and others are discussing, is that that provides small businesses the requisite flexibility. It would preserve also the value of worker firm matches and continuity for a quicker recovery. There are tensions, hence Hayek's voice in one's ear. If this is a shutdown that's very temporary, that kind of a program could make sense. For a longer term shutdown scenario, the question is whether it delays needed reallocation. And how do you compare the worker firm matches on the one hand with the lost reallocation? There were also implementation challenges. Nothing like this really existed for the United States, as you know, because the IRS wasn't able to do direct payments for businesses. This went through banks. not because of the quote loan element that's largely forgivable. Banks were a conduit. Other countries, as we talk about at length in the paper, I'll just mention it here, have taken somewhat different approaches. Most European nations used a wage subsidy in which workers saw hours or pay reduced, with government picking up much of the employment costs, as in the German model. The original estimates Mike and I had given congressional leaders was a revenue replacement program would cost around $1 trillion. This is somewhat less, largely because it wasn't as generous and because its take-up was 70%, not 100%. So what do we do here? We're going to use data from Dun & Bradstreet, an old firm. In addition to RA, President Grant, President Lincoln have also mucked around in these data. We have evaluated in the paper the effects of the PPP on employment, what Dun & Bradstreet calls PAYDEX, which you can think of as a financial health score. Loosely, it's a time of repayment kind of score, and measures of continuity of the small business. We do have an issue in that in the D&B data, we can match with loan applications, and then we'll talk about eligibility with SBA, but only for applications of loans greater than 150,000. And that's because SBA released the names of businesses that applied for loans at that size, but not below, and SBA denied our FOIA request. So we don't have those very small loans. We'll talk about that in a moment. And so what we're going to do is estimate a difference in difference model of the effect of either the PPP application or eligibility based on size using several treatment and control groups. Now, there have been a number of studies that have tried to look at the PPP in various ways. Time limits, I won't mention them here. The one I will highlight, because it's probably closest to what we're going to try to do, is by David Otter and others that used ADP data, the payroll processor. And there they use difference in difference comparing employment at firms above or below the 500 employee threshold under the program and find substantial employment effects. And again, we're going to focus on these larger loans. We will also use a dynamic effect of PPP application and eligibility using event studies. Our basic estimating equation, we put a sandbox here. That's what D&B calls their data, which turned out to be somewhat harder to use than one might always imagine. But within the sandbox, one can estimate for a very large number of firms, and we have all establishments in the D&B database that are active as of December 19th that have between 1 and 1,000 employees. This is a very large sample. And we've been able to identify the businesses that applied for and are eligible for the PPP loans. And so what we're going to use outcome as a measure like employment or log employment in our case, like the PAYDEX score, or like whether the business closed. We're going to look over a 6-month period, that is months prior to the PPP and after, so a total of 6 months, 3 before and three after. We're going to have an indicator variable, whether you applied for a loan. I'll talk about eligibility in a moment. And then we're also going to look at state by month controls, industry by month controls, and so on to make sure we're not having state and industry clustering effects driving what we do. For dynamics, I won't put it up here, but equation 2 in the paper is our basic difference in difference event study. We also estimate an intent to treat model for separate demand in order to separate the demand for the PPP application from the PPP itself. Eligibility. So here we're just going to condition on the eligibility based on size as opposed to the application itself. Just what are our basic results? In table 4 of the paper, we focus on employment. And so if you use as a control group establishments between 501 and 1,000 employees, so larger than the threshold in the data that we have, and use as your treatment group establishments with less than 500 employees that applied for the PPP loan, and again, applied for means this particular size for us. There's this fairly significant PPP employment effect. It's 1.07%. That's likely downward biased, of course, because we don't observe all of the small loan applications. They are not available to us. If you look at the intent to treat estimates, that is conditioning on PPP size eligibility, the effect is about 0.51% for that same test group. In the fifth column, around the 500 employee cutoff, we look just below and just above. And there the effects are much smaller, suggesting that what's really driving the PPP employment effects is coming from smaller firms, at least through June. And we are finding larger effects over time as the program ages, as I'll come back to. These results are a little different from Autor et al. Because they find employment effects for larger firms as well as for smaller firms using the ADP data. In terms of dynamics, these figures look at employment, the PAYDEX score, and whether the firm has gone out of business in the D&B data. And so what you see is on the left-hand side, these are 1 to 500 employees is the group applying versus 501 to 1,000. The right-hand side, same cut, but now we're going to look at eligibility. You can see the pattern I mentioned before of rising over time. The numbers are also large. So to interpret the magnitude, if the average establishment employment fell by 0.6% January to June for 1 through 1,000 worker firms in the Dun & Bradstreet data. So when we talk about estimates like 1.1% or 0.51%, those are very large relative to the changes that happen. I don't have the slides on this, they're in the paper. If you were to look at financial health results, table 5 in the paper, this is the so-called PAYDEX score. It's a proprietary score from Dun & Bradstreet. Similar to the results for employment, the PPP seems to have had a larger impact on relatively smaller firms. And as with the employment effects of PPP, the financial health effects, at least as measured by PAYDEX, grows over time. If you were to look at all firms with 1 to 1,000 employees, again, to calibrate what's big and what's small, the average monthly PAYDEX fell by 0.32 percentage points in the entire sample. So when we have a positive effect of 0.13, that is a very big number. Finally, business continuity results we have in table 6, the 4th and 6th columns there are similar to the kinds of results that I spoke about for employment. And we find, as with the other two measures, the PPP did decrease the chance of closure, and that decrease grew substantially over time, meaning program is passed originally in March. We have data through June. Subsequently, we hope to go back and update that. So where does this put us? On the plus side, it does appear that applying for a PPP loan, at least at the size threshold we're able to consider, and PPP eligibility as determined by firm size, both of those measures raised employment, improved financial health, and improved business continuity. And those findings are robust across a lot of treatment and control groups. The PPP either took time to work its way in, that's the pattern that we observed, or was simply more effective in a partially reopened economy, the June economy. We can't really distinguish between those. There are question marks though. This program's young, and we're only looking at the first 3 months of experience. The goals in the program included both short-term employment maintenance and medium-term business continuity. And so as the effects of the PPP unfold, it'll be important to see what happens. I would caution you, it's very hard in a project like this to look at what's marginal and what's inframarginal. It's not so easy as estimating things like a cost per job. The program had multiple goals. It was business continuity and employment. And even if one were to estimate a quote cost per job, one would have to back out avoided unemployment insurance calculations. So those are difficult in this case, and we don't have a silver bullet answer. In terms of lessons, the alternatives, at least for the US, of quickly expanding unemployment insurance were not likely to be successful, largely because of administrative issues that we're seeing in the States. Standard loans wouldn't work. What these firms needed was really equity type financing or grants, not loans. Some things to consider maybe going forward. Hopefully there's not a next time, but if there were, maybe more reliance on things like short-time compensation programs, which operate in a bare majority of US states and could be effective. Also, perhaps modifications of business interruption insurance, a la the terrorism risk insurance model, conditioned on some policy determination, like a governor closing businesses in your state. And then finally, we would urge, a rethink of the design to focus again more on revenue replacement, as well as a better designed Main Street lending facility, which in the interest of time I won't talk about, but we can come back to if anybody would like. Quick lessons for practice. This program would have gotten off to a much better footing had there been more coordination in the government. Computer systems, as the picture there indicates, were significantly outdated. That sounds like an administrative detail. It really held this program back. And of course, as one would expect any economist to say, more research is needed. So what's the answer to the question? Has the Paycheck Protection Program succeeded? We would say yes, with a question mark, but I think others might have the more Zhou and Lai too early to say.
Thanks, Glenn. The comments will be given by Eric Swick.
Okay, can you hear me and see my slides?
We can.
Great. So thanks so much for inviting me to discuss this paper. I have been a longtime reader of influential Glenn Hubbard Brookings Papers, and so it's a pleasure to actually participate in the production process, even a very small contribution. So I really like this paper, not just because of the empirical analysis that Glenn summarized, but actually because it tries to take a step back and introduce kind of a verbal framework for thinking about why we should have such a program, and also does a very detailed sort of legislative almost history of the passage and implementation challenges through the first few months, which I think will be useful going forward. But I thought I actually would continue that by asking, what kind of public policy is PPP? I think as Hubbard and Strain rightly point out and argue, this is not a fiscal stimulus policy. The goal is not to increase economic activity immediately. Perhaps even the goal is the opposite, to allow people to stay home and promote a different goal socially. But this implies that the cost per job metric is either wrong or at best incomplete. Same with something like a fiscal impact multiplier. Is this a capital market support? Largely no, and I think I'll just refer to the paper that Adi presented this morning. This is not a lender of last resort style program. Output has evaporated. Loans are unattractive because they're not viable for many firms, and banks are more unwilling for private profitability of those loans to lend than they are because they're unable because of capital restrictions or something like that. I think the closest public policy analog is something like disaster relief or disaster insurance, something like after a hurricane or tornado or something like that. The reason I put here is because there's a severe non-economic shock. There's a relatively low correlation between the short-run performance of firms and the long-run performance, which I think we use to motivate our VC interpretation of credit programs. there's a risk of losing firm worker matches and also fixed startup costs, and there are potential aggregate demand or congestion externalities that give another justification for supporting firms through this temporary period. Unlike a hurricane, the disaster has uncertain duration, so there's maybe more need for kind of a continuing program, and also there's lost revenues instead of lost capital. I think the key takeaway is that the framework does affect how we think about the design and evaluation of this program, and also the design principles. So, given that that's sort of the rough framework, how should we design and implement such a policy? Glenn didn't talk about this part of the paper, but I think it's actually a really nice feature of the paper. So I'm going to compare the Hubbard and Strain revenue replacement idea with the ideas that Sam, Adi, Jeremy, and I circulated back in April on business continuity. I think we agree on roughly 80% of the design elements, but let me focus on 3 big differences, which I think will be useful for research and policy debate going forward. First is whether or not you should include payroll. So the argument to include it is to retain the firm worker batch and to avoid further overwhelming UI systems. The argument against is it makes the program much more expensive. Maybe match quality is not as important for a lot of the firms that were affected by this shock. Firms aren't used to paying workers to idle. And so actually the mechanics of the program at the firm level when the firms weren't operating is somewhat difficult for some sort of small business owners to even wrap their minds around. UI, despite its warts, did reach 30 million workers over a pretty short period of time. And so I think we shouldn't throw the UI system under the bus, but think about ways to improve it. And this reallocation point that I think Hubbard and Strain emphasize sort of as we go into recovery mode, if you're including payroll, you're kind of deterring that relative to a more limited program. Should we use the banks as conduits? The argument for is there are pre-existing relationships, so it's easier to reach firms, and there's an underwriting infrastructure. The arguments against, well, there are misaligned incentives in the banking system relative to maybe what the social planner would want. We had to pay the banks billions of dollars to put the PPP programs out despite them being fully guaranteed. Main Street has had even more issues with getting banks to participate or help borrowers apply. There are many firms out there without banking relationships or significant banking relationships, and these are harder to reach. The banks themselves were disrupted during the initial period of the shock. And the IRS, despite its warts, has a history of implementing large-scale fiscal policy, economic impact payments, NOL carrybacks, the homebuyer credit, just to give some examples. I think we agree that the SBA was probably not the right agency for a large-scale short-term program like this. Last and maybe most controversial, on targeting. Should there be little to no targeting? The argument here is that there's unknown shock severity and timing. There's political economy considerations in choosing winners by industry. And there's potentially marginal tax rates from a forward-looking revenue target. So you might deter firms from opening if they get more forgiveness if they stay closed. The cons is that if you do little or no targeting, it might be expensive. Benefits might not be deployed to those who need it most, sort of by definition. The marginal tax rates are like the EITC. There are tax rates, but maybe they're not prohibitive. And maybe there's a perception that with little or no targeting, the program would be unfair. That's just a brief summary of differences. I would say this is an area that's inviting more formal economic study. This is an area of the pandemic where I think economists have a lot to contribute because we're good at thinking about the welfare, design, and impacts of social programs. And this is, I think, a nice, rich environment. It's a relatively new program. Okay, so moving into data. How should we grade the PPP? It's not really the cost per job, but it's something like the insurance value relative to program cost. Now, what is the consumption smoothing equivalent for firms? That's something that I'm not going to do, that we haven't done, but I think that's kind of what we need to do to really think about this program. But what I will do is ask a simpler question. If we look at who received funds, were these the, quote, high insurance value types? Do we think of that as the case? And then what did firms do with the money? So I'll come back to the empirical results at the end. First, this was a very timely program. $500 billion distributed in 6 weeks is kind of staggering. So on timeliness, A+. On targeting, so here's some results from a paper that I've worked on with some colleagues at the University of Chicago. For folks who are interested in an updated draft, please email me. We're 99% towards an updated draft with more results. I'm showing some today. Initially, the less hard hit areas actually received more funds, partly as just sort of an artifact of idiosyncratic abilities to process loans across regions. It's hard to make the case that I think that these areas deserved more funds. Ultimately, combining both rounds 1 and 2, we see a weak correlation between the initial shock and funding, which I think is evidence of broad access to the program. It's possible that Arizona, Florida, these regions with late waves may have received funding at the wrong time. You know, what are the welfare costs of that mistiming? I think it's a question that I don't have an answer to, but it's something to raise. Here's some survey data from Facebook that folks released in an MBR working paper on Monday. So this is real-time data. What share of businesses surveyed, small businesses, experienced sales declines? This is, I think, in the month of April. So sort of post-COVID shock and shutdowns during that period of time, 30 to 40% did not experience sales declines. Within those that did, there's a lot of heterogeneity. So some weathered it relatively better, and a lot of this is sort of luck as opposed to, you know, skill or something like that. Note that a lot of firms didn't apply for PPP. A significant share of those are probably firms that weren't, you know, facing harder or revenue declines probably. So the incomplete coverage, I think, reflects a bit of this. Firms are struggling about equally to pay rent, wages, and debt. So on the left graph, it's just, what are you struggling to pay survey question. This suggests the initial payroll weight was definitely too high if we think about trying to help firms meet payments they're struggling to pay. The current payroll rate is probably also too high for the same reason. Notably, half of the firms are not struggling to make payments in April. Maybe they eventually become, you know, are struggling, but I think this also points to potential targeting issues. On the right, I think it's just interesting to note that half of the firms surveyed did not have pre-existing relationships as borrowers. They have checking accounts, but it's not clear that that's enough of a connection to a bank to make using the banks the right mechanism, because of course the IRS has the bank account information for all these firms as well, because they file taxes and put their bank account information there. In looking at the big banks, their performance in the first round was sort of underwhelming relative to what we would have expected. They improved considerably in the second round, but a lot of the second round's increase in coverage came from reallocation of borrowers to lenders that were more willing to participate or help people apply. And last, as an artifact of sort of differential bank participation or rules, larger firms receive funding first. It's not clear that this is the right targeting feature. And this is what I get at when I say maybe there's a perception there was unfair access. So the last 2 minutes, let me talk about empirics. In the Hubbard and Strain paper, what we see are modest employment effects. I think Glenn described them as large. And I think the issue there is what's the denominator you're comparing the employment effects to, and I'll mention that again in a second. But I think, you know, generally elsewhere in the literature, so in my paper, we're finding null effects in April and small effects in May and June. The Otter and 9 co-author paper also finds modest effects, and now Chetty's team has also sort of looking in May and June, and different employment indicators also suggest sort of modest employment effects, which imply a very high cost per jobs, though note that's maybe not the right metric. Modest impacts on financial vulnerability. I think we are finding more significant effects using census survey data on financial vulnerability. And my interpretation of the data so far is that this is actually an important element of the way the PPP worked, is by helping firms strengthen their balance sheets and allow them to flexibly adjust to changing circumstances, more so than sort of increasing employment. And that effects are growing over time. We are seeing that as well. So I just wanted to provide a little more confirmation. 2 concerns I have with the empirics, very briefly. Comparing loan applicants to non-applicants is going to overstate probably the effects, because there are loan demand effects. So some of the specifications have this issue, and I think we've talked a bit about that. I like the eligibility design. I think that's much better using the 500 worker threshold. Second concern is about the Dun & Bradstreet data. So I'm a little worried that they're stale and not updated at high enough frequency. And so that's understating, or it's otherwise affecting what we're seeing in the data. So just to show that in aggregate, these are aggregate employment series for the different groups. There's actually, the y-axes make it look like there's a lot of movement, but it's actually almost no movement in the aggregates for the different groups we're studying, which is sort of unusual, because if you look on the left at ADP data, on the right at home-based data, we're seeing declines of 20 to 60% in employment payroll for these different data sets. And the Dun & Bradstreet data by comparison are showing essentially no decline in aggregates. And I think this is because Dun & Bradstreet just doesn't collect data at the high frequency you need to do this kind of month-by-month study. So I have a lot of comments to send offline. To grade the PPP, I'm going to say incomplete. And to grade the paper, I'm going to say excellent. For me, the incomplete grade has to do with if it prevented a large number of firm failures, that increases the grade a lot. If a large share of the funds were inframarginal, the incidence of that is not so great. It's mostly on the owners. And so I think distributionally and from a cost of the versus the value of the program, that raises concerns for me. The paper itself has this really thoughtful discussion of the framework and narrative of what's going on. And I think the empirics are very sensible, if still a bit of a work in progress. So thanks a lot. I'm looking forward to the conversation.
Thanks for the clear presentation and the great discussion. We have a number of questions. Caroline Hoxby.
Hi, thanks for a terrific paper, Glenn and Michael, and thanks also to Eric for his excellent discussion. It was really interesting. I want to just, before I get on to my main comment, agree with one of Eric's comments, and that's about the Dun & Bradstreet data being potentially, he called it stale. I wouldn't have used that word, but that's, I think that's an appropriate word. It's just not very sensitive relative to some of the other monthly sources of data. So I think that's a non-trivial issue. It's a pretty serious issue. Okay, going to my main comment though, in tables 4 to 6 in your paper, the specification that I always liked best was the one that's always shown in column 5. And that's the one where you are comparing the firms that have 400 to 475 employees to the firms that have 525 to 600 employees. And I think this specification is really most in the spirit of the identification strategy that you have and the sort of differences and eligibility for the PPP that you have. I think we've learned a lot over the past, I don't know, I'll just say recent years about how important it is to have a control group and a treatment group that are relatively, you could say they're balanced on the covariates, they look plausible for one another and so forth. And so the problem is that when you go to these groups, which are not small in terms of observation, so that's really not the issue, they're more comparable, but you also see really nothing in any of these column 5 specifications. So that's a big worry for me because I consider that to be by far the most plausible and well-identified specification. I also just comment that it's unfortunate that eligibility is mainly on this particular margin of the 500 employees, because that's probably not the local treatment effect that we would like to identify. I think a lot of people are really interested in smaller firms than firms that are right on that 500 person margin. I mean, there's a reason why that's the threshold. It's because above 500 employees, they aren't really small firms anymore. They're kind of large firms. And so when we identify the local treatment effect on those firms, we're leaving out the local treatment effect that we would love to see on the small firms, the restaurants, and the small businesses, the small family firms, things like that, which just don't make it into that range. I don't know that there's any sort of eligibility or identification strategy that would get at those smaller firms, but I guess I would just like to say I wish there were. Thanks.
Thanks. I'll read a question from the Q&A from Josh Gottbaum. Does the shift from a wage subsidy program to a revenue subsidy make the distributional effects of the PPP regressive, at least compared to the European programs? So we'll just put that in the queue. Gabe Chodorow-Wright.
Thanks, and nice paper and great discussion, Eric. I wanted to pick up on Eric's discussion of what firms did with the money and mention some ongoing research I have using loan level bank lending data. And one of the striking things we find is large repayments on credit lines by mid-sized firms in the second quarter of 2020. And so, and just suppose that this was tied to PPP receipt, meaning that it's the firms that were getting PPP are the same ones that are paying down credit lines. I just wondered if that were true, how that would affect how you think about the success of the program so far. Is that something that meaningfully matters?
Jason Furman.
So thanks for the paper. In judging PPP, I'd like to know, and I realize why you didn't answer this question empirically, what the employment impact of it is in the month of December. We could have given people unemployment insurance and saved the firms the money from employing them. If we think employment in December is determined by comparing the marginal cost of hiring someone to their marginal revenue product, then the fact that we did PPP earlier in the year will have no impact at all on employment in December. All the employment effects you found are things that we could have more efficiently and cheaply and effectively have just done with unemployment insurance. You need some, it prevented the firm from going bankrupt. As a result, they employed more people in December than they otherwise would have effect. And what do we know about that? And why should we think that a lump sum transfer, in June affects the number of people you would choose to hire after that program ends? I would think that hiring would be determined by whether or not you have a lot of customers then, not whether you got a bunch of money earlier in the year.
Austin Goolsby.
Yeah, I also like the paper a lot. I would caution you a little on potential confounds that are correlated with size. So since the PPP, the eligibility just goes off of size, if you look at this paper that Chad Severson and I wrote, where we got the phone records data of consumer visits to these millions of different businesses, there's a very strong trend correlated with the rise of the disease of people in the same industry shifting where they go shop away from larger, busier stores to smaller, less busy stores. So that will show up in a eligibility separation like what you do in this paper. It will look like the PPP is working because the smaller firms, in fact, are having, unobserved to you, increases in their relative demand. And you're going to attribute that to PPP. So I think you just want to be a little careful about that. We can share with you the phone record data that we have. You might be able to match it by name to some of your firms.
Steve Davis.
Thank you. My first remark kind of follows up on Jason's point. I understand that a cost per job month evaluation of the PPP is highly incomplete, but it would be quite useful for us to get a handle on whether there was a cheaper way to support workers to date. And my impression is that, and correct me if I'm wrong, but my impression is PPP expenditures per benefit that goes to workers is an order of magnitude larger than what the cost would have been to support workers through the UI system. That raises the issue of is there some way that the PPP is better than the UI system at retaining employer-worker matches? And if there is, what is that? And then a related point is, it's not so obvious to me that there's high value to retaining employer-worker matches in the kinds of employers who work for PPP targeted firms. It's worth remembering a couple of things about the displaced worker literature. The large numbers that come out of that literature are from empirical designs that focus on mass layoff events from high tenure workers at larger firms, okay? And often these are high share of these jobs that are at issue in these samples are industrial jobs. There's a very different kind of jobs that are being lost in this setup. And my impression is at least they involve a lot less match-specific capital and match-specific rents than the kinds of jobs that are being isolated, the lost jobs that are being isolated in the displaced worker literature. a related thing, your paper made me appreciate how little I think I know about what the value of business continuity really is, especially in the population that's targeted by the PPP. So if there is great evidence that there's high value to business continuity that extends beyond that which accrues to the business owner, him or herself, that'd be great to put into this discussion. Another thing paper made me realize that I wonder about is how big are any potential crowd out effects from supporting existing incumbent firms and squeezing out new firms. And the Census Bureau has these new data on business applications from administrative record sources at a high frequency. I think they have plans, I don't know whether it's happened yet, to release those data at the local area and industry disaggregated levels. If that's available, it would be extremely useful to know whether in the same kind of diff and diff designs you currently use, that areas and industries that got more PPP support experience weaker business formation, to get some sense on whether this crowd out effects are potentially important. And then the last thing is really a general comment about your paper and many other papers. I've heard frequently in recent months appeals to the need to avoid overwhelming the UI system or to deal with the administrative weaknesses of the UI system in order to motivate very expensive fiscal programs, the PPP being one, partially motivated by that, the other being the $600 federal supplemental benefit system. It kind of really makes me want to know, well, how much would it cost to fix the administrative weaknesses in the UI system? And I realize that's a separate paper, not your paper, but this is for the editors, I guess. It strikes me it would probably cost a lot less than the $1 trillion+ we've been spending on these other programs that are designed to circumvent the weaknesses in the UI system, and maybe a few tens of $billions could fix those weaknesses. I'll stop there, thanks.
I'm not sure the editors know the answer to that question, but it is an intriguing question. Catherine Abraham?
I just want to pick up on the last thing that Steve raised, which is this issue about the administrative capacity of the unemployment insurance system. Glenn sort of hinted at related issues in his presentation. It's just crazy that we don't have, that we're running unemployment insurance systems on COBOL software, and that we can't modify the system to pay people a higher replacement rate instead of a flat benefit amount. But anyway, that wasn't what I originally raised my hand to say. I wanted to pick up on something Jason said, and then Steve echoed it, which is that it might have been cheaper to let people get laid off and then get on insurance than to keep them attached to their jobs through the PPP. I think the one thing that's different about doing those two things, in addition to whatever the value of preserving the business of the business continuity is, and whatever the effect on increasing the likelihood that come December people are employed, is what they're doing in the meantime. And we know that being unemployed is very hard on people. It has all kinds of negative physical effects and mental effects. So it's not just a matter of maintaining their income. It's what kind of state are they going to be in? And if people feel that they have better about having a job, even if it eventually comes to an end, I think that should weigh in to how we think about policy as well.
Thanks. Could the authors respond? You're not going to be able to hit all of that, but do your best.
Yeah, we can't get. I'll do it quick and then turn it over to Mike. Thanks to Eric, and thanks to everybody for great questions. I really like Steve Davis's mood music in the background. It was very comforting as he was talking. So a lot of the questions came together on the issue of unemployment alternatives. And this really does get at questions that we don't know the answer to about worker firm matches and business continuity values. So the question of whether you should have just put people on UI, even assuming the UI system worked well, is one that requires that input. And we wish we had better there. To Caroline's point, we too were really attracted to trying to find something in what's called column 5 in the tables. And we suspect the reason we don't is just that these effects really are about much smaller firms. One question that came up in the chat from Olivier about targeting, be careful. We would all like to know exactly who we could have helped, because that would be the most efficient thing to do. We don't. And in a world where we don't know these match values or business continuity values, it's not obvious really what the alternatives were. But Mike, let me turn it over to you, because I know we won't get to everybody.
Yes, and let me echo Glenn's thanks. These were all really excellent comments, and thanks especially to Eric. We tried to think hard about how to evaluate this program empirically. And if you read the paper, Glenn didn't have time to go into all of it, of course, but we tried different treatment and control groups, and we tried treatment on the treated effects, and we tried intent to treat effects. We do compare firms with 1 to 250 employees to each other, where the treatment is, did you apply for the loan? That gets at some of these concerns about comparing 1 to 500 to 501 to 1000. The flip side, of course, is that we only know if you've applied for a loan of above $150,000. And so the control group is kind of muddled. At the same time, comparing eligibility brings its own issues, because the way that PPP affected a firm with 450 employees is probably really, really different from the way it affected a firm with 15. And these are just empirical challenges. And so we try to do our best with that. To Jason's question and to a few others, part of the goal here, I think, was to preserve the productive capacity of the economy over the medium term until this situation with the virus is in the rearview mirror. The program was billed as an employment program, and so I think it's natural to try and make comparisons to unemployment insurance. But I think of it much more as a continuity program for these businesses, and it very well may be that if you're a restaurant and you survived the downturn, that the PPP loan that you got a few months ago doesn't affect how many workers you're going to hire 9 months from now. I'd be perfectly willing to believe that. I wouldn't conclude from that, however, that PPP failed in some sense, because that business is still around, and maybe that business wouldn't be all if it weren't for the revenue replacement that it received from the grant. When trying to compare the cost of this program to the cost of unemployment insurance, I think that is really crucial. Is the recovery, is the duration of the period of economic weakness shorter because labor demand is supported during the transition over the medium term, because PPP averted millions of business closures that otherwise would have happened? That's an extremely difficult thing to quantify, of course, but any attempt to compare how much this cost to how much UI for all these workers would have cost, I think really has to take into account those sorts of holistic concerns. I think I'll stop there.
Okay, thanks. There is an enormous amount. We could continue this discussion for a really long time. It's really important, but we are now going to switch over to our final paper. The final paper is Sizing Up Corporate Restructuring in the COVID Crisis by Robin Greenwood, Ben Iverson, and David Thesman. And I believe Robin is presenting.
Can you see my slides?
Yes, looks good. We can hear you.
Okay, great. Thank you, Jim. Thank you, Jan, for including us on this program. It's a privilege to be part of so many fantastic papers that we have been hearing all day, including the last one, to which our work is quite related. So let me just jump right into it. Look, it's been an enormous macro shock. We've been talking about that shock all day. It's on par, at least in the short run, with the global financial crisis. This picture is showing you cumulative real GDP growth from just basically rescaling the baseline here and looking at COVID versus the GFC. But one of the things that's surprising is that the pace of bankruptcy filings, particularly among small firms, has been low. Among large firms, it's been elevated, but not substantially elevated. And if you look at the firms, I'll show you a snapshot. It's been predominantly firms that were struggling pre-COVID. So think energy, retail, and so on. So what we do in this paper is essentially ask the question from the perspective of US businesses, what happens next? So we're going to do that in 3 parts. The first part is a series of exercises to quantify how large the COVID shock has hit US businesses. And frankly, this is going to be complementary to some of the things that we've seen today and some of the exercises that we've seen to try to measure the impact on firms. We're going to look at the industrial composition of the shock in comparisons with 2009. I'm going to show you short run versus long run forecasts. So I guess we all know what happened in the short run, but there's some questions about how this is going to play out across the economy, comparisons of small versus large firms. And then the most innovative part of this part of the presentation will be trying to forecast defaults and bankruptcy filings, just trying to understand where those might be headed. Second part of the paper, we're going to talk about the triage process of financial distress. And here it's worth bearing in mind that in a typical year, 400,000 to 30,000 of them roughly file for bankruptcy. And so what we're going to try to do is try to understand what happens to the business when businesses fail, and specifically when they hit bankruptcy, which ones of them are liquidated, which of them are reorganized. And then we're going to try to zero in on 4 types of frictions that are pretty strong today in the wake of the COVID shock. So namely, the question of whether this is permanent or temporary. So what's the long run viability of some of these businesses? That's something that's been going on in the discussion all day today. How congested are the courts going to be? How big are the frictions for small firms in particular? And then how much outside funding might be needed to support this process? So whether that be through banks or through debtor in possession financing. Last, we're going to talk about some policies that have been proposed. So they're basically firms alive. I'm not going to spend time on that because that's been the focus of a lot of today already. And we're going to talk about 2, which is basically avoiding the court system for failing firms. There's been a whole series of proposals along those lines, and then various proposals to improve the bankruptcy process itself. Okay, so let me just jump right in, assessing the damage. So this is a list of the big firm bankruptcies that have happened over the past few months. You can see if you just scan, you'll see things like Hertz, JCPenney, Chesapeake Energy, and then in that other notable list, you'll see a lot of retail outlets. The bottom line here is that a lot of the firms that have failed, they had pretty poor stock price performance going into 2019. So they were already sort of dogs. Now, if you look at the impact on public firms, of which I just showed you a set that really fared poorly, this is a sense of how big the shock is. It's looking at the percent of firms that have negative EPS. And one of the things that you can see in this picture is that there's a spike, but the spike doesn't actually look, surprisingly to us, it doesn't look worse than 2008. And it also doesn't look worse. It's about equal to what was happening in late 2000, early 2001. The most impacted public businesses, I'm not going to show you pictures, but they're in the paper: restaurants, hotels, entertainment, energy, and transportation. So then we turn to forecasts by industry. So we know what happened in the short run. There's a question of what's going to happen if you look out to 2021, 2022, and you can compare that with what people were thinking at the similar moment in 2009. And here you can see in 2009, the longer term forecasts were pretty dire. So people really were expecting the mean there is minus 39% growth in earnings. For example, for the next year, and minus 27% over a two-year horizon. That looks a little milder when you're looking at what analysts are expecting today. You might ask, do analysts have any record at all of being able to forecast this stuff? We've looked at that. So at the industry level, they're pretty good historically at getting approximately right. Okay. You can also look at the industrial composition across firms. In the paper, we look at both large firms and small firms. This is using census data that was already referred to in a prior paper today. This is the Pulse survey. The most impacted small businesses, you can tell I think it's pretty consistent with our intuition: restaurants, hotels, movies, parks. The only one that surprised us here was that educational sector, small businesses, have fared remarkably poorly. Okay. So here what we're doing is trying to quantify the impact on small firm balance sheets. And we're really following a methodology that was put out by Cruzet and Gorio in a series of Fed blog posts. And essentially what they do is they ask, suppose you have a major revenue shock. So what we're doing here is 30% revenue shock to a particular firm, and you hold fixed essentially the expense structure. What's going to happen to the overall leverage? How much are they going to draw down their cash and so on? And by the way, Eric Zwick has pointed out to me that you have to be very careful with these small firms, because when you're using the IRS data, thinking about what exactly shareholder equity is, you have to be a little bit careful. So actually, we've thrown out the very smallest category of firms here in what I'm showing you. In any case, if you look at the numbers that I've circled, the bottom line is that small firms, this is looking at the leverage ratios based on a 30% revenue reduction. Small firms in the economy are going to be especially hard hit. And actually, for us, this was a surprising result, because one of the things that's driving this is actually the expense structure of small businesses. So small businesses actually tend to have larger fixed cost to revenue ratios than larger businesses. You can see that's noted in the table. Also, probably won't surprise you, but small firms tend to be in more competitive industries, and that's also a cause for their financial distress. Last part in this section of the paper is we are trying to forecast what's going to happen both to defaults, which is really happening with the larger, we're using the larger firms here, and we're using firms that have publicly rated debt. And then we're looking at the broader universe and trying to forecast overall business bankruptcies. So let me explain how we do that. For the first one, we're following the work of Angela Ma, one of our graduate students, and basically what she's doing is estimating time series regressions of defaults and downgrades as a function of GDP growth and the unemployment rate. So you can do that for any ratings class. And then what you can do is plug in analyst forecasts of the unemployment rate 1 year forward, 2 years forward, and so on, and GDP growth from the SPF. And if you do that exercise, and you have to be careful because it's relying on historical relationships, it tells you that something like 6% of firms are going to default, which is an extra 5 percentage points relative to today, and 15.5% are going to withdraw their credit rating. Basically, the same exercise here this is based on some other work that Ben has done with Jilan Wang, Jiul Yang, and Ray Klunder. This is looking at the correlation between the national unemployment rate and bankruptcy filings. The left-hand picture shows you Chapter 7 filings. The right-hand picture shows you Chapter 11 filings. They basically show you the same thing, which is to say these series move in lockstep. So when the unemployment rate jumps, then you see a massive spike in bankruptcy filings. We have not seen that yet today in the data, as I already pointed out, as you can see in this picture. So roughly speaking, we're talking about a sort of a 5-fold increase in bankruptcy filings based on fitted values alone. By the way, I was listening to the talks today. If you were to even make an adjustment for what the federal programs have done, suppose you point an estimate of 22% of businesses had been saved. Well, even if you did that, you're sort of talking about a doubling or a tripling of the bankruptcy rate. Okay. All right. Yeah. So to summarize, basically the short run impact on firm balance sheets, I've just described that. We really think we're in this period right now of potentially of calm before the storm. Okay. Second part of the paper, what happens when firms fall into distress? Well, first of all, to me, this was surprising, but 400,000 establishments close every year. More than 90% of them just simply close. So the restaurant across the street simply closes, doesn't go through a bankruptcy process. Roughly 8.5% of them go through a bankruptcy procedure. most of those go through straight to liquidation. So through Chapter 7, some of them and the larger firms go through Chapter 11. Okay. Financial economists have spent a lot of time trying to think about what's the baseline value of financial distress. And what we do here before we kind of get into the frictions of COVID is try to provide a baseline estimate based on the number of bankruptcies that we forecast. So how do we do that? We'll take some of those fitted values that I showed you before and say, okay, we're going to get this many Chapter 11 bankruptcies and this many Chapter 7s. Think about how many dollars of liabilities are going to have to go through the bankruptcy system. And then apply an estimate from Andrade and Kaplan, which is that roughly 10 to 20% of enterprise value gets destroyed. It's simply as a function of being in this financial distress. So if you do that back of the envelope estimate, you get a number like roughly $200 billion, about 1% of GDP. Now, this is probably a lower bound because it ignores the impact on employees, which have been a topic today, and it also job destructions due to excess liquidation, which might have been as much as 200,000, and some of the spillovers that we've been talking about. Okay, so let me get to the triage process. So, much like if you're got a temperature today and you show up at the hospital, the bankruptcy system triages you, with most firms going into Chapter 7 liquidation, and then some going into Chapter 11. Even a big chunk of the firms that go into Chapter 11 end up being liquidated, which again may be news to some of you. So what are the particular concerns that you would have during this COVID period? I think the first one is whether the shock is temporary or structural. So if it's temporary, then you want to have business continuation. If it's structural, then you want to favor liquidation. Second is the judges may be overwhelmed by the wave of financial distress. Third, the crisis may disproportionately impact smaller firms, which are harder to continue. For example, because there's entrepreneurial know-how linked with the owner or the operator of the firm. And then fourth, question of funding needed to support the bankruptcy process. Okay, so we look at reallocation. That's been a topic in some other work, not today, but in work around this crisis. Again, looking at these analysts' forecasts. So if you look at what the analysts say, I won't take the time to explain exactly how we generate these series, but the bottom line is showing you the dispersion of near-term forecasts across industries. And you can see that as we enter this crisis, those numbers rise. Right? People are expecting reallocation away from airlines and towards IT, for example. The top line is showing you the longer-term forecast. And if anything, those numbers are coming down during this crisis, which is actually somewhat surprising and quite unlike some previous recessions. So that is to say, if we trust the analysts, there's sort of going to be less reallocation in the long run than some of us may have supposed. Okay, so all of that favors allowing the bankruptcy process to kind of take care of some of this. Having said that, you have to worry about the small firms. This is a chart that shows you the percentage of firms within different size buckets that get liquidated versus reorganized. The top bucket is the very largest firms. You can see most of those just get reorganized through Chapter 11. The bottom bucket, most of those get liquidated. Okay. One set of concerns that I already mentioned is there going to be enough funding to deal with these distressed firms? For example, you may worry about the banks. What we've done here is try to understand what's a reasonable forecast for the charge-off rates based on where the unemployment rate is today and where the economy stands today. The bottom line is, and this has been emphasized by other people working on this topic, large banks aren't doing as much SME lending as they were before, and so the charge-offs aren't going to be particularly worrisome for equity. Okay, last part of today is just to think about policy responses. Three types of policy response. The first one I'm not going to spend time on, which is really just keep the firms alive. That's been a focus of much of the other work today. So I want to talk about these two other types of policies. One policy here is just try to avoid going into bankruptcy. And there's just different ways to do that. Payment deferral, so for example, moratoria or regulatory forbearance. Bruno Meyer and Krishnamurthy have a proposal about the Fed setting up an SME loan refinancing facility. And then some work that I have with David is looking at how to facilitate tax credit to having private reorganization of debts, in particular focused on rent. Okay, so in terms of more moratoria, actually there's lots of historical examples. You can see it in some states and some cities around the country where they've been encouraged. For just to give you an example, French landlords did not receive rent from occupants by decree going, some period back. In mid-April, the G20 suspended debt payments for many developing countries. And there's currently payment deferral programs implemented in Australia, Hong Kong, Italy, and some other places. Okay. Again, the cost of these programs is they inflict a lot of pain on lenders, which are primarily banks. We're not particularly worried about those based on the other analysis we did, but so in the US, this would be something to think about. David and I have a proposal that we put out earlier in this pandemic, which was really thinking about how you might incentivize private parties to reorganize their debts. And what we had in mind here was a restaurant that owed a landlord some money, and the landlord could forgive that debt in exchange for a tax credit. And the idea there is to essentially share the cost of restructuring between taxpayers and lenders or landlords. Okay. Last set of policies is just to acknowledge we're going to have lots of bankruptcy and financial distress. What are we going to do when these firms go through the system? And tons of different types of proposals here. I'm just going to talk about two of them. The first, and we really think this is the most low-hanging fruit in this whole thing, which is, and this is my last slide, which is that there's only 349 bankruptcy judges in the US. Ben and some other work has shown that you really need to recall essentially 50 to 246 temporary judges to ensure that the workload per judge does not increase to beyond what it was in 2010. Why do you want to do this? Is because judges under pressure tend to liquidate firms, and you'll have excess liquidation, which is in general a concern, and particularly a concern for the smaller firms. Another proposal, which has actually gone into play, is this new chapter, subchapter 5, which is that businesses with less than $7.5 million of liabilities now have a new procedure. But the fact is, it basically hasn't been used yet. There's only been 576 filings when we started writing this paper. So really, this is a kind of process that we're going to have to monitor. And I'm going to stop there. Thank you.
Okay, thanks very much. The discussant is Edith Hotchkiss. Good. You're on mute.
No.
Perfect.
Is that better?
Okay,
yeah. Perfect. Great. Thank you. It doesn't look like the video. Well, my slides are working. I don't know about the video. So good.
Slides are working. The audio is working. So you're good.
Good. Okay, terrific. First of all, I really want to thank the organizers for giving me the opportunity and really the privilege of being able to participate today. So this has been great. I'm especially thankful to the authors for this paper because it's a very broad and ambitious paper, I'll say, and it both draws on a lot of the previous empirical work and puts it all together in one place for us, as well as adding a bit of new data about how things have been going so far or might be different in the COVID area. So in that sense, it's quite comprehensive and a lot to follow. There's a lot in this paper. But what I want to try and do is kind of pick out what I would highlight as the key things that I would take away. And so as Robin said, the paper kind of proceeds in 3 steps. First step is to figure out how big a shock is COVID, and in terms of what's where are we headed, or is there a surge likely to come? And also they do a nice job showing that this is a big shock both to small businesses and large corporations. Second step is what happens to these firms once they're in distress, and how might that differ from what we've been studying for many years about typically what happens to firms in distress. And the general issue, no matter when we're studying financial distress, is you've got this tension between designing a system that doesn't lead to excessive liquidation, but at the same time designing a system that doesn't lead to excessive continuation, and getting that balance right. And I think one of my main takeaways from this paper is that The tendency for smaller firms seems, or the worry is clearly more pointing towards inefficient liquidation, whereas the tendency for larger corporations may be more worry about designing policies that don't lead to excessive continuation. Overall, we already know that, again, the distress costs tend to be very large, but it's interesting to think about, given how that balance is falling maybe towards inefficient liquidation of smaller firms here, what does that imply about how big the costs are and who would bear them? And then, again, Robin only gave us a small taste of it, but lots of policy proposals. What I find useful about the paper is that if you think about what the source of the inefficiency is, that can help guide us into thinking, which policy proposals would be targeted to which types of firms. So I'll comment on some of these. Okay, so step number one is sizing up the problem, where we are. Robin pointed out that we have had obviously quite a large uptick in large corporate bankruptcies, although many of them are firms in industries that were already struggling. On the smaller side, harder to get the data, but the Sense Pulses survey does indicate that obviously there's a large impact there as well. So the kind of novel part of the paper is trying to provide some way of figuring out where we're headed. And they do it in several different ways. And I'll comment on each of these, but I think that the most intriguing way is some of the forecasts that are given based on the expected unemployment. Okay, so again, in terms of sizing up the problem here, we're already, we can see pretty easily that you get these spikes, right? That filings have increased. But what's interesting about where these are happening primarily, kind of two things. One is that small firms or smaller firms are being very heavily affected, but that some of the industries where we're seeing the biggest spikes are the industries that were already struggling. And I think you can see it most clearly from the chart on the right for retail, that bankruptcy filings for small retailers had already started quite some time ago. And also for the larger, which is in the orange bars, the larger retailing companies, we're seeing a big increase now, but this is really a continuation of a trend that happened well before COVID. So this is what I mean when I say these are the industries that potentially we have more of a worry about excessive continuation, and we'll have to think about that when we look at some of the policy considerations. But again, the other issue here is that it's very obvious when you look at the evidence so far that both big and small firms, even within the same industry, have taken a big hit. The other thing that they review in the paper is expectations of defaults going forward. So not just filings that have already happened. One of the things that we have to worry about here, at least for forecasters of defaults, and there's many of them. Robin mentioned the ones they look at in the paper, but Moody's and S&P and Fitch and lots of other folks are forecasting defaults. Everybody's predicting large increases in default rates and expecting, this surge is yet to come. This is all based on the universe of rated or bigger companies for the most part. So it really leaves out quite a bit of the smaller, mid to smaller firms that we would care about that don't have ratings. And I was curious, I went back and I looked at what Moody's was predicting for default rates shortly after Lehman's demise. They were predicting a corporate default rate of 16.4%. And in fact, defaults were high, but not as high as were being predicted. And again, we can think, I'll come back in just a few seconds here. Why was it then that defaults were not quite as high as people predicted and maybe also aren't going to be this time around? Like I said, though, this is missing the smaller end of the spectrum here. And that's where I think the paper has a really interesting approach, which is using expected unemployment and using the expected relationship between business bankruptcies and unemployment. So that also shows, again, a very large response. There's a few caveats I would put in here. These things are obviously, and many of the papers today have talked about this, depends on whether the government support will be continued, renewed, depends on our expectations about the time to recovery, which is very uncertain, and so on. One thing that I would like to see, and I won't have time to get into the details, but Robin mentioned some of their estimates of the aggregate costs. They're no doubt very large. I'm not sure I would follow Andrade and Kaplan and some of the others, again, based on large failed buyouts. as giving us good proxies for estimates. But one thing that would be interesting to see is if you broke this down more by size groups, what some of your estimates for the costs overall would be. Robin also mentioned kind of step number 2. Once firms go into distress or bankruptcy, what happens? And much of this is, again, known from prior evidence that, well, 2 things. One is that a lot of firms that are on the smaller side, they don't even go into bankruptcy. They just stop operating. The other thing we know is that smaller firms, when they do go into bankruptcy, they tend to get eaten up by the fixed costs. So many smaller firms, and this is the number from their paper, many of the firms on the smaller side that go into bankruptcy just end up in a liquidation. It's really only the large Chapter 11 cases where we see significant incidents of reorganization. And I just would add one little piece based on some work we've done. A lot of the estimates here confound liquidations with sales of businesses, but many of these businesses are sales of a going concern. So in that sense, they're being redeployed under new ownership, but the assets themselves are not being redeployed in terms of their economic use. Okay. All right. So what does this mean in terms of kind of some of the interpretations in the paper? For one thing, what could affect these outcomes? There's been some significant trends within the bankruptcy system, not just recently. Prepackaged bankruptcies have been around for quite a while. We see a lot of not prepackaged bankruptcies, but pre-negotiated bankruptcies in the last several years, where firms use some kind of restructuring support agreement. And they've got everybody lined up. They've already agreed to the restructuring. They get in and out of bankruptcy and execute it very quickly. Increasing sales, again, that shortens the time in bankruptcy in a lot of these cases. And you can see the numbers on the right-hand side. The amount of time, and this kind of relates to concerns about potential court congestion, near term may be a problem, but once firms hit the bankruptcy system, they're not as likely to spend as long. And there's even been several recent cases where companies have been going in and out of the bankruptcy courts within 24 hours. And in some sense, these things are all a bit of an endogenous response to congested courts, that if it's going to lead to large destructions in value, it gives even greater incentives to either push for sales of companies, to do prepackaged or pre-negotiated reorganizations and so on. The other trends that I'll mention, and these again are going to affect these outcomes. One thing that reorganizations require is capital, both for firms in bankruptcy, debtor in possession financing, and money to come out of bankruptcy. And also out-of-court restructurings require new capital. We've been doing quite a bit of work, again, related to some of the other papers today. People have noted the tremendous levels of debt issuance, the capital that seems to be available. Interestingly, a lot of that capital is going into refinancing as opposed to new capital for these firms. But in any event, to the extent that the credit markets remain where they are or seem to be for bigger firms at the moment, that's going to ease the ability of many of these firms to restructure. We also, in prior research, us and others, we've noted that private equity firms, because they either sit on dry powder or have raised capital specifically for investing in distressed companies, they can actually stabilize in the sense of providing capital for companies to work through this period. Again, kind of the lesson here is, though, for smaller firms, they're somewhat left out of this process. And it really comes down to whether the banks will not whether they can, but whether they will be willing to extend additional financing to these companies. Okay, and I won't have time, I think, to get into some of these, the details of some of the policy responses, which is the last part of the paper. But like I suggested, I think what's particularly helpful is to think of the source of the inefficiency as the guide to, whether a certain type of firm, certain policies make sense or not. So for example, small firms, huge problem, the fixed costs of renegotiation, the inability to renegotiate or bring in new capital, debt overhang, or just search frictions, financing frictions, and so on. These can kind of guide the policy proposals both for in-court restructurings and out-of-court restructurings. So just as one example that, again, Robin mentioned, this Small Business Recovery Act, making changes to the court system, to the process for Chapter 11 that lower the fixed costs is going to enable hopefully many of the smaller firms to be able to survive the bankruptcy process without being eaten up by the costs. The court congestion, adding court resources and so on, I put a maybe there because again, it depends on this surge being realized, but also some of the offsetting effects that I mentioned earlier. But I thought, again, without getting into the specifics, it's a really helpful way to kind of organize our thinking around the so many different policy proposals that are out there. And I will leave it at that.
Okay, thanks very much, Edith. Questions from the audience? Jan?
Sure. One of the topics that comes up in the paper that we didn't address too much in the presentation this afternoon, but it came up this morning. I think Mervyn King brought this up, where one of the things that Steve Davis and John Haltwanger and others emphasize is the difference between small firms and young firms. So firms tend to start off small, but then there's the firms that start off small and actually grow quickly. And those young firms end up being much more important for those young growing firms for employment growth and economic growth. And then there's firms that are small and they stay small, and those are part of our neighborhoods. Do you think about policy interventions differently for those two groups of firms? I mean, usually we tend to emphasize the high growth firms, and because they seem more valuable, economically, but a lot of those small firms in the COVID world might actually be quite important because there's a lot of employment there, even if they're not rapidly growing firms. So we might have different policies for those two sets of firms, but we might change our policy priorities a bit for the COVID shock relative to other shocks. So how do you think about that distinction?
Thanks. Wendy Edelberg?
So I'm trying to think through whether or not I can construct one coherent narrative that ties together the papers that we've heard today about the efficacy of the PPP, what's happening with the labor market, what's happening with firms and bankruptcies. And I wonder, I think an underlying, I guess, presumption in the discussion of the paper we just heard was that the wave of small bankruptcies is coming, or bankruptcies of small firms is coming. And I wonder if, so maybe that's right. I mean, that's my intuition, but like, is it maybe that we've actually just had this massive structural shock that is creating all sorts of firms that are keeping employment elevated relative to what we thought before, so that we're going to get a whole lot of firm destruction, but a huge amount of firm creation. And the labor market has proven itself to be incredibly nimble, such that, the unemployment rate's coming down really fast and people are getting reemployed. And okay, so if anybody buys that as the narrative, and I'm not even sure that it's right, but if anybody buys that, how much of that is all pandemic related? And do we want all of these firms then that have newly been created when we're post-pandemic, or are we going to like have to undo this massive structural shock that that I think maybe one argument is that we've so nimbly responded to?
At the risk, this is not a glib response. I think the response to that question is one coherent narrative combining all of these papers is that we need to get with a program on masks and testing now so that those temporary unemployment can go back to work and these firms don't go into bankruptcy, and the PPP would have been a success, or at least a modest success. Sorry about that. Okay, Elaine Buckberg.
Thanks.
I didn't hear mention of the 2019 Small Business Reorganization Act, which makes it easier and less costly for small businesses to file for Chapter 11 bankruptcy so that they can reorganize rather than liquidate. And I wondered how that affects your outlook for business bankruptcies during COVID.
Okay, anybody else? Okay, back to the authors.
Go ahead, Ben. I think Ben and David are going to take questions just to say thank you so much, Edie, for a really thoughtful set of ideas, and also to all of you for great questions.
Sure, yeah, I'll jump in a little bit here, but yeah, Robin and David also, I'm sure will have things to contribute. So yeah, same thing that Robin said. Thanks very much to Edie and to the organizers. This is very, very helpful, and it's been fantastic to join in. I'll respond to a couple of things. Let's see, I'll kind of go maybe in reverse order. Elaine asked about the Small Business Reorganization Act. It goes by a couple different names, so maybe this was a little bit confusing. When Robin mentioned subchapter 5, that is the Small Business Reorganization Act. And like basically so far, it appears, I think there's like maybe up to 700 firms that have used it now at this point, but it just really hasn't been used very much. And I don't know if that's because people don't know about it. I think lawyers are still trying to figure out how it even works. But I would certainly group that into the proposals that could be potentially very, very useful to keep some of these small businesses alive. Wendy asked, is the wave actually coming, and is our response too nimble or not? No one knows, right? Like it's really, really hard to predict this type of thing. And, you know, like hearkening back to the earlier paper on like, is unemployment temporary or permanent, or whatever terminology we've decided on for today. It's very hard to say, like maybe, and like Edie mentioned in her discussion, a lot depends on what the government support looks like as well. And that's also very hard to forecast. But I would say, like, my take from reading a lot of the reallocation literature is that there are like fairly large frictions to reallocating both workers and capital. And so this, my at least gut reaction is that like, it's pretty unlikely that we're too nimble, or that, and I guess I would also say, if we have been too nimble, that would mean we should be able to be nimble moving back to how things should be as well. So if you have like either there's big frictions or there aren't big frictions. And if there aren't big frictions, then we can be nimble, and then we can be nimble going back. So for me, that's not necessarily a huge concern. And then lastly, Jan was asking about small versus young firms. I think that's a super good point. And in the actual data that I've looked at, they list the size of the firm and not the age. So like from a data perspective, it's just really hard to like say very much about it. But my kind of gut reaction, at least to that, is that, you know, you asked like, should we treat them differently? My gut reaction to that is, can we differentiate them when they're both small? Can we figure out which ones are the high growth firms and which ones aren't? My guess is to a large extent we can. Like if it's a local like little pizza shop, you kind of know that's a small firm that's going to stay small. And to the extent that we can, I would hope that we could lean on markets to support those high growth firms, because that's what markets I think are good at. So yeah, I've probably talked too much. So I don't, David.
Can I add just one thing that was just fascinating to us? So remember that I showed you that picture with the percent of firms that have negative EPS? The level in general times is 40%. So it's stunning. There's, you know, if you look at, and what are those firms? Those are relatively smaller, but they're young firms that are growing very fast, biotechs. So, you know, the negative EPS, there are hundreds of negative EPS biotech firms listed. And actually, if you look at where the markets are today with, you know, buoyant capital markets, those firms are going to continue to get financing, at least in the current environment. It's the smaller, lower growing firms. And so, yeah, maybe that's less cause for concern. and that's driven by the capital markets. But it's still costly to have the firm failure, even though it's a less growing segment of the economy.
Okay, thanks very much. So we're at the time to wrap it up. This has been a great, I'd like to thank in particular the Brookings staff that has helped out and made this possible. Anna Dawson and Mary King, we're really grateful to you. Brookings, we're in general so grateful for your support and for our various granting organizations, authors and discussants. You did a great job. We would really be happy if we could do this in person on March 25th and 26th. So hope to see you in DC then. Thanks very much.
Thank you very much. Thanks.
Thank you. It was a privilege.
Yeah, thanks.